If you're watching this video right now, you're going to get more value for free than what people pay thousands of dollars for. And I'm not saying this to be dramatic. I'm saying this because I am literally about to teach you everything in this free course that follows the same framework that has generated me over $500,000 in prop firm payouts in 2 years of trading. But before we get into the actual content, I want to set the stage really quick. Essentially, what I have in front of me is an interest over time chart that tracks the keyword day trading. So if we take a closer look at the graph that is pulled up, the interest over time is tracked from 2004 to right now. And we can see that there is a good amount of nothing going on from 2004 to 2020. And then we see a sudden jump. And then now in 2026, the interest in day trading is at an all-time high. And this isn't a coincidence. This is actually for a real logical reason. And I'll be explaining that right now. More people are interested in this skill now rather than 20 years ago after the pandemic due to these things called prop firms. And if you guys don't know what that is, I'll explain it a little bit later into the video. But essentially, all you need is $50 to $150 and a laptop to be able to manage $50,000 to $150,000 in capital. This means the barrier of entry in day trading specifically has never been lower, and the opportunity to make significant amount of money in day trading has never been higher as well. This means you don't need to go and deposit $1,000, $2,000 into a live account and risk all of that money, but essentially what you're risking is only $50 to $100 to $150 to basically essentially make similar amounts to a live account or even make more. Now, with that being said, there is a problem with this. A problem has rows. And that problem is, with the amount of volume and with the amount of demand that we're seeing with day trading, everyone and their mother essentially thinks that they are eligible to teach. They don't have any sort of payouts, they don't have any sort of proof of credibility, and they still decide they can record a few trades that they've taken and then post it on social media and then just have a Discord link in their bio. And I'm not gonna sit here and name names, but you guys know exactly who I'm talking about. With that being said, I do want to show you guys why you guys should actually listen to me and what I'm about to teach you. So I want to go over my payouts, specifically from this year. I've been able to generate over $500,000 in the last 2 years, but in this year alone, I've been able to do over $100,000 in payouts in literally less than 5 months. With that being said, the prop firms that I'm going to be going over is Top Step, My Funded Futures, the live account with My Funded Futures, and Take Profit Trader. All right, let's go ahead and start off with the Top Step account. So I got moved to their live account with Top Step, and as we can see with the payouts over here, I did 12K in April, I did 22.5K in March. Let me go ahead and actually refresh this account for you guys, or this dashboard, so you guys can actually see it's not edited. All the amounts remain the same. This is in February over here. And then if we just look at the total payouts, you can see all the account numbers. This is their live account number over here. And then all of these payouts from the first tab, boom, second tab over here in January. And then boom, we have a little bit of payouts in January. And then we have a few from last year. But almost very close to $100,000, if not even more. I didn't even do the math myself, but you guys can do the math. This is very close, or if not more than $100,000 in payouts just from Top Step alone. And if you guys don't know what Top Step is, they are a regulated, verified prop firm. They've been in the game for around 10 plus years. So they are very trusted and millions of people use this prop firm. Now let's go with My Funded Futures. If you guys don't know what My Funded Futures is, again, it's another prop firm. I also got moved to live with them as well. I was able to trade on their live account, managing real capital from their company. And this is just a few of the payouts that I got. Let me just go ahead and refresh again for you guys so you guys can see all of the payouts that I got over here. Boom, boom, boom. They're all different payouts as well. There's also another tab. All of these payouts are from live, as we can see right here. Okay, this is from My Funded Futures. Now let's go ahead and go to the same. This is actually on their live account as well. They ended up transitioning to their own broker. So I have certificates from their live accounts as well over here. 2 small payouts over here. And then now we go into Take Profit Trader, where I have just taken out a payout with them. As we see, April 5th. The time of recording is April 14th. So 9 days ago, I took a payout with them. So yeah, I did over 30 to 40K in payouts with them. I just ended up trading with them this year.
and I'm looking to scale with that prop firm. Yeah, do a little refresh for you guys as well. Over here, boom, as we see, the payouts still remain. That is all the payouts that I've gotten this year, totaling over $100,000 in payouts. So really quick, I just want to go over my story so you guys know where I come from and how I was able to get to the point where I was able to take all of these payouts that I just showed you. So in May 2023, I was 17 years old. I was in school, in high school. I was learning to trade, kind of, wasn't really taking it that seriously, but essentially to make money, I tried to make beats. Honestly, I was pretty decent at it, but unfortunately, I wasn't able to make money from it, or at least a good amount of money from it. And then I had a friend basically introduce me to trading. Later into 2023, I started to pick up trading. I had strict parents. Basically, all they really cared about was school. And I used to wake up at 6:30 a.m. in Pacific time to trade in the bathroom before going to school. I was working as a referee as well at this time. This is how I was actually able to make money to fund my trading. And I blew over $5,000 in referee savings in a span of a month. December 2023, this is when I was at my lowest point, I would say for sure, where I was down to $50 in my bank account balance. This picture is actually AI generated, that's why it looks a little bit weird. But I don't have an actual screenshot of my bank account. I wish I did, so this will just have to do for now. But yes, this is true. I was down to $50 in my bank account at a point, and I was at a point where I was not even able to fund my trading. I ended up opening up a credit card, which was very, very stupid of me, but it ended up paying off. I got my first payout of $1,000, was able to pay off my credit card, and this is exactly where I realized that this is real. I can actually make a career out of this. Now, February, that's not listed over here, I had one of my best trading months, which was $50,000, not in payouts, but to the bank, actually in the bank account, $50,000 in my bank. That was my best trading month ever. But then a month after that, in March 2025, I had my worst month ever. I was sitting in the back of my college classroom, I was trading pre-market, and I broke every single rule that I have set for myself. And I lost $75,000 in one session. All my balances across all 5 accounts that I was trading with was wiped. And I was eligible for a $25,000 payout, and I ended up not being able to secure it because I crashed out. This is in March 2025, and then a result of this was basically just got out of the classroom. I got up, left, sat in my dorm. I wasn't able to eat or sleep, or honestly just even able to live with myself, knowing the fact that I was in college and I just lost a $25,000 payout that I was able to secure in a couple of days. But the good thing was I never once thought about quitting. Never, not once in my mind I ever thought, there was never a thought in my mind that basically crossed saying that I should quit day trading. Then I came back in April 2025. I took a bit of a break. I took like a week break, came back in April 2025, did a $20,000 month straight to the bank account. And then June to August, that's where I went on a run, did 125K in payouts in 3 months, and I ended up dropping out at 19 years old, basically just going all in with trading and realizing that I can actually go all in. Now we're in 2026, I'm 20 years old, and I have generated over $500,000 in payouts lifetime. Now really quick before we jump in, I just wanted to mention that all the free resources that are listed in the course, all the reference materials, all the Miro boards are going to be listed in my free Discord. So if you want to get access to these materials, go to my description and join the free Discord. I'll leave a link in the description. Before we get deeper into the content, I just want to mention the fact that I did split up this course into multiple chapters. So if you're more of an intermediate trader or an advanced trader, there are topics for you to watch that will be later in the video. So just make sure to go ahead and scroll and then watch the relevant topics that fit your needs. All right, so now let's go ahead and get into it. So to go ahead and get started with futures trading and actually put risk on the table, we are going to start trading with something called prop firms. Over here, I have 4 of the best prop firms, in my personal opinion, that are pulled up right now on my screen. We're gonna go through each and one of the rules, the types of accounts that they have, and you can pick and choose and see which one caters to your style of trading the most. There's different price points as well, and they all have their own benefits. With that being said, we need to understand first what prop firms are. So prop firms are basically companies that supply capital to traders like us, to retail traders like us. They supply capital. So we are trading their own capital first you start with an evaluation phase, and then once you pass the evaluation phase, you get upgraded to a funded account. With Top Step, we call it a XFA. That stands for Express Funded Account. And basically on these accounts, you are able to earn money, but you have to follow the rules and requirements that are overall set by the prop firm in order to get paid out with the prop firm. All right, and this goes for all these different prop firms that I'm about to show you. I'll walk you through each and every one of these prop firms and what they are overall best at. So if we see right here, we have Top Step. Top Step is one of the OGs of the prop firm space. They've been here for around like 10, 11, 12 years now. And they've basically started the prop firm space in general. So with Top Step, they have 3 accounts. They've added a bunch of new things as well. Initially, they only usually had a standard plan where you would buy these accounts for the price point of $50 for a 50K account, which is $50,000 in capital. I also suggest you guys go to their website. Each one of these websites like Top Step, Alpha Futures, Lucid Trading, and Tradeify over here, go to their websites and read up on the rules. Make sure you understand exactly what you're trading and what you're actually signing up for. All right, that is very, very important. Obviously, I'm going to explain everything to the best of my ability, but I don't want to make this super, super long to the point where I'm completely boring you guys. All right, so with Top Step, basically just to run it down, they have standard accounts where once you pass the account, you pay an activation fee. It is a standard activation fee of $149 per account, no matter what size. So you have the 50K account. This has a profit target of $3,000, $2,000 in drawdown. Once you hit that drawdown, you basically breach the account, you lose the account. All right, activation fee is $150. Across these accounts, max position, as you guys can see, 5, 10, and 15. And then these are the different max limit, loss limits, and then these are the different profit targets as well, right? So this is Top Step, this is the standard account. And then you also have the no activation fee account right over here, which is $100, $159, and $209, okay? For the overall beginners, I suggest you go ahead and save money and trade with the standard accounts. The reason is these accounts get a lot more expensive, especially when you don't know what you're doing. Realistically, if you're on no activation fee accounts, you should be more experienced because you will burn a good amount of money. Top Step is very, very simple. They quite literally just have one rule for their accounts. Select their standard accounts whenever you pass the accounts. Do not select the consistency because you have to basically meet a certain threshold. You cannot make above a certain threshold in order to get a payout. All right, stick with the standard whenever you pass it. I'm not talking about this standard. I'm talking about when you actually pass the account, you basically are given 2 options. One is a consistency account, and then one is just a standard with no consistency, basically limiting your profits per day. You can make as much as you want. Now, one thing to understand is with Top Step, they have a payout cap of $5,000 per account. You can trade up to 5 accounts with them. For the beginners, I suggest you go ahead and trade 1 account, get payouts, and then establish the proof of concept, and then look to scale higher and higher and higher. So with that being said, with 5 accounts, $5,000 per account, you can take $25,000 payout. You take 5 payouts and then you're upgraded to a live account. So basically in a live account, you are actually in a real trading environment. Right now, in an evaluation stage or on a XFA/ funded account stage, you are still in the simulated environments, all right? This goes with any of the prop firms that I'm going to be talking about here as well. So basically, the live account stage is the final boss, right? That is the stage where you've basically proven yourself to be a professional trader by the terms that they say, right? So that's the overall end goal, but obviously you need to actually get 5 payouts on 1 account or 5 accounts simultaneously to get upgraded to that area. So that's Top Step. Basically, you can request 50% of your account balance. So if you're taking a 5K payout on 1 account, that means you need to have a $10,000 balance in the account, right? And then you're able to take that 5K payout. Another thing to notice is they have basically winning day requirements. So the minimum amount of money you need to make is $150 per day. It doesn't need to be consecutive, but if you have 5 of those days stacked, then you're eligible to take a payout, all right? That is one thing to notice. Everything else is basically pretty straightforward. Whatever they say over here is whatever they're advertising is basically whatever it is overall true, right? So profit target, max position, max loss limit, all of these things hold true. That is Top Step right there. Very simple. That is the first prop firm. I definitely recommend them going with the standard plan if you're a beginner. For a little bit more advanced, Obviously, you probably know what Top Step is already, so you'll go with the no activation fee if you overall understand the proof of concept. Now, if we go to Alpha Futures, this is another very nice prop firm. I am affiliated with Alpha Futures, so if you do want to save on these accounts, go ahead and use code AB at checkout to support me. If you do obviously want to use my code, go ahead and do that, but who doesn't love a discount, right? So you can get up to 10% to sometimes 25% to sometimes even 50% off on accounts whenever they release a sale. With that being said, they have 3 accounts over here. They have the 0 plan, they have the standard plan, and they have the advanced plan. With the 0 plan, they have a 25, 50K, and 100K. They just added the 25K account. So basically the barrier of entry to futures trading in general just got a whole lot cheaper. On top of this, with the discount code, this takes another 10% off. That is completely standard. That will always be there. Always will be a 10% discount at minimum. So knocking this off, it'll be around $70 a month, right? Now with the 25% discount, it brings it even cheaper to around like $60, $50 a month, right? With that being said, 0 plan, basically this is more of a consistency account over here. On the evaluation stage, there is no consistency. You can pass in 1 day. The profit target is 3K, maximum drawdown is 2K, maximum contracts is 3. And then obviously the resets is $100. And then you can also reset the funded account as well, which I honestly do not recommend to do that. Do not do that at all whatsoever. Just go back to the evaluation stage if you blow the account. Good thing about these 0 accounts is that there is 0 activation fee at all. So this is your all-in price per account, $79, $119, and $239. Obviously this is without the discounts. Now they have other sorts of rules as well. Now when you get to the qualified stage, you need 5 minimum trading days of $200 per trading day in order to get a payout. The max payout for the 50K accounts is $1,500. For the 100K, it is around, I think, $3,000. Again, go to these websites after you watch this portion and actually read through the rules when you're about to go and buy the account. They have it all publicly available. All right, so make sure you're overall studying up and understanding what you're signing up for and understand what accounts you're getting, right? So you don't end up overall messing up and potentially just forfeiting a payout because you didn't read rules specifically. All right, there is no max allocation on the evaluation, so that means you can buy as many accounts as you want. But when you get to the funded account stage, you can only trade 5 accounts at a time. There's a 40% consistency. If you click this button over here, you're able to overall understand how the consistency works. Again, read through it, but consistency, generally speaking, is, let's say you're at a $3,000 balance, all right? If you make more than $1,200 in a single day with a 40% consistency rule, you are breaching the consistency, okay? So with the total profit that you make and on an account and you're about to take a payout, with the consistency rule, you cannot make more than 40% of your total profit of your account, right? So with the max payout of $1,500 with the 50K, since you can only request 50% of your account balance, if you have an account balance of $3,000, your total profit in a singular day cannot be more than $1,200, okay, in a singular day. That meets the 40% consistency rule with the qualified account right here, okay? Everything else over here still remains the same, $2,000 in drawdown, 3 contract sizes for the 50K accounts. And if you look at the 100K accounts, it obviously increases, 25K accounts, it decreases, right? What I would recommend for the absolute beginners, go with the cheapest accounts possible with any firm that you trade with. This case, go with the 25K account. Just understand how to trade in general. Focus on the skill. Stop trying to focus on the shiny object syndrome and trying to get these bigger account sizes over here. This is what I would recommend overall. Now, they have news restrictions as well. I'll be covering in a separate clip what these news restrictions are and what news overall is in the market and how you can utilize that to basically overall incorporate it into your trading, right? The way that you trade. All right, that will be in another clip. But basically, they have news restrictions, so you need to make sure that you're not breaching it. Otherwise, you will not get paid out by these prop firms. All right, specifically with Alpha Futures, the 0 plan over here. Cool. With that being said, they also have a standard plan as well, and they have an advanced plan. I really wouldn't worry about this as a beginner. The advanced plan is really, really good though, in terms of no consistency on these accounts. So just like Top Step, you can basically make as much as you want, but you also have to understand their payout caps on the advanced plan is $15,000 per account. You can have up to 3 accounts. That means overall, if you get a $15,000 payout per account, that means you'll get a $45,000 payout. They also have a 90% profit split as well. That means you make 90% of the total profits of the total payout that you request you keep 90% of that. There is more overall maximum drawdown, or actually there is less. Sorry, I take that back. There is less maximum drawdown, but there is also a overall bigger profit target on the evaluation stages. So it is a little harder to pass, but it is worth it when you get to the funded account because you're able to have no scaling plan. Basically, you can trade up to 15 contracts right off the bat. With these other accounts, they have scaling plans, right? Where you're limited to a certain amount of contracts. And then as you unlock more profit in the account, then you are able to overall trade with bigger contract sizes. All right, so that's Alpha Futures for you right there. Again, use code AB and stick to the Alpha Futures Zero plan for you beginners out there and read up on their rules. All right, now, so we have Lucid Trading over here. They're more of a newer prop firm. Basically, just overall end of day drawdown. They have 90-10 profit split. Yeah, and then they have a transition to their live accounts as well. But this is the overall evaluation stage right here. I do not have a code with them, but you can use their standard codes. Basically, use like code VAULT for a good discount on their accounts right over here. For the best deal, use code VAULT. I think they're 40% off right now on their accounts since they're more of a newer prop firm, so they're doing more discounts. But overall, I would recommend going with either the Pro or the Flex account. The direct account is instant funding, so there's more of a stricter consistency rule over here. But the Flex is basically like Top Step. That's what I would overall recommend. They have very cheap accounts, once again, with the coupon $70, $100, $150, and this is $300. Now, with their accounts over here, they have increased payout caps, basically. I don't know much about the 25K and 50K and 100K, but I know for the 150K, they have basically a payout cap of $3,000 per account. You can have 5 accounts traded with, copy traded with. With their evals, they have 50% consistency. That means, let's say if you go to the 25K account, which is what you guys should be overall going with, either the 25K account or the 50K account, if your profit target is 3K, you cannot make more than 1,500 in a day, or you cannot make more than whatever this is divided by 2, right? So it'll be like, what, $650 per day or something around the area. You cannot make more than $650 in a singular day. Max loss limit is $1,000, $2,000. That is the obvious drawdown that you get before you actually breach the account. And I forgot to mention this, but drawdown type, when they say end of day drawdown, what that essentially means is that, let's say on a 25K account, you are up $700, right? Initially, when you get that account, balance at the start is $25,000, okay? $1,000 left in drawdown. That means if you blow it without making any sort of profit at all whatsoever, your drawdown, your account breaches at $24,000, right? Because you lose $1,000. Now, let's say you make $500 the first day, all right? That means your balance is sitting at $25,500, right? The profit target is $1,250. At the end of the day, after the market closes, the trailing drawdown, or the max loss limit, kind of increases. So instead of now being your max loss limit being $24,000, it is now $24,500 because your account balance right now is sitting at $25,500. Your max loss limit doesn't increase. It will stay with you until you actually overall pass the account, right? Or you make a little bit above the buffer, right? So if you make, let's say, $1,100, that means you're above the max loss limit, AKA the buffer for the account. That means your max loss limit won't trail any further from that, right? So now it goes from $24,500 to $25,000 flat, and then your account balance will be at like $26,100, right? So you now have $1,100 to lose before you end up breaching the account. So obviously, same thing, max size for this is 2 minis. There's no consistency in the funded as well. With these cheap accounts, honestly makes it very, very valid to trade these accounts. Payout caps for the 25K and the 50K, I'm not really too sure. I think it's around like $1,000 or something like that around the area. But again, go to their websites and actually read the rules. All right. Last but not least, now we have the Tradify accounts over here. Again, there's the Pro accounts over here. Again, just look into it before going to Tradify. Look into it as well. But these are similar to the Zero accounts from Alpha Futures, where there's a 1-day pass and there's like no consistency at all until we actually get it into the funded account over here, where we have consistency, which is 40%. Again, it is the same thing as, or pretty similar to the Alpha Zero accounts, right? So you can choose whether you want to go with the Pro or you go with the Flex, right? The Flex is a little bit cheaper, so I would suggest going with the Flex accounts. All right, now we overall go into Tradify over here. This is a very, very underrated firm. And if you do want to save on their accounts as well, they released a new platform as well. Same with Lucid Trading. There is a platform called TradeC. There's a good amount of risk settings and all of these parameters to basically protect yourself from blowing your accounts rapidly, right? With that being said, Tradify is a very, very good firm. As you see at the top right here, they have 40% off on all accounts, and then it's a 5-time use and 30% off consistently, right? This expires in April, but they will keep running sales over and over and over again. I am affiliated with this firm, so you can also use code AB at checkout if you do want to support me and also get a good discount as well, right? With this being said, they have a good amount of accounts. They have a growth account. This is, again, somewhat similar to that Alpha Futures Zero Plan account where they have consistency on the funded, and then they have the select account. This is pretty valid. I like this because you can choose after you pass the account. You can get either daily payouts or you go with the flex where you do the standard 5 days, and you need to make, like, I think, again, $200 per day to be eligible to consider as a winning trading day. Otherwise, you can't request your payout, right? Obviously, if you make more than that, that counts as a winning day, but the minimum barrier is $200. All right, no consistency on these flex accounts right here. And then with the overall evaluation stage, they're a little bit more strict. They have a 40% consistency, so you can pass within ideally 3 days. Everything else besides that is very, very good. Again, they have TradeC, their new platform. They have the growth account, which is the overall good account as well, right? Just kind of mimicking the Alpha Zero account. They also have different account sizes: 25K, 50K, 100K, 150K, select 25K, 50K, 100K, 150K. I would honestly overall recommend to go with the select account just because so you can build some sort of consistency and actually build the skill rather than trying to full port your accounts and going on the growth and trying to pass within 1 day, right? There are benefits and there are negatives to each. Obviously, we have consistency on the funded account over here. Over here, we don't have consistency. And you have the option to take daily payouts, right? So honestly, no other firm is really offering this with Tradify, where there's no consistency and they're doing daily payouts on the stages where, you know, you pass the accounts on the 25K, 50K, 100K, 150K with no consistency, keep in mind. So you can literally take payouts every single day. There's obviously a max payout as well, but you have like a max loss limit and everything like that, right? For the end of day till you blow the account. Again, it all remains the same, but obviously if you choose a daily payout, you have a daily loss limit as well. That doesn't mean you breach the account. It just means that you're locked out for that day. Yeah, so that is basically all the prop firms that I would consider trading with: Top Step, Alpha, Lucid, and Tradify right here. All good prop firms. You basically go and choose which one you want to trade with based off of reading the rules on each website. All right. Okay, you guys, to get started with futures trading, we need to download an app called TradingView. So as you guys can see, I have the TradingView website pulled up. I am going to explain what TradingView really is essentially used for. I'm also going to be walking through how to get an account as well and how to overall get started. I'm going to be walking you guys through my chart colors, my overall settings, and also walking you guys through the indicators that I use to overall enhance my trading. With that being said, to get started with futures trading, we need to install TradingView. So when we're on this website, we go to the Get Started page over here. You do need to essentially purchase a plan. You can purchase the free plan, but the thing is, to actually utilize the platform, get the most out of the platform, you need to purchase at least the essential plan. To get indicators for your chart, at least 5. I only use 2, but to get even 2 indicators on your chart, you need to have the essential plan. You also need to get 2 charts per tab because we are going to be looking at 2 instruments. We're going to be looking at the NASDAQ futures and we're going to be looking at ES futures as well. So, which is why we need to have the essential plan. If you go with the annual plan, you'll be paying $13 a month. If you go with the monthly, it is around $15 a month. They also have a free trial, so you can go and see if you like it. But regardless, you are not realistically going to be trading futures without having a TradingView subscription. All right, that is basically it. On top of that as well, you do need to get real-time data for NASDAQ futures and ES futures. That will run you about $7 a month, because if you do not get this data subscription, then you will be 15 minutes delayed. And obviously you don't want to be looking at price action that's 15 minutes delayed. You won't be able to place trades that are accurate, right? So that is just a no-brainer. You need to get the essential plan, and then you also need to get the data subscription. Overall, you will be paying around $20 to $30 a month. So once you do get this plan, obviously you get access to everything that it says all over here. You get bar replay, which is also pretty important when you want to go and look back at your trades that you have taken in live markets. You're able to go into replay mode and play price action back, essentially. So now we have created an account. We've signed up, we've got TradingView, and now let me go ahead and pull up TradingView so you guys can overall see what we are working with over here. So now we are on TradingView, and in this clip, I'm also going to be explaining more about how futures trading works in general. So as you guys see right here, we have the NASDAQ pulled up, and then we have ES pulled up on similar tabs. Now, for you guys who have just downloaded TradingView and are looking at NQ, go to this symbol search right here and search up NQ1 exclamation point, okay? Same thing if you want to look at ES, look at ES1 exclamation mark, okay? These are the pairs that you're going to be looking at. This is the mini pair, and then you also have another one, which is MNQ, and this is the smaller version of NQ1. So that's micro basically means small, and then you have mini, which is big. I'll explain the difference between each. Same thing with, okay, so this is on the other side, right? You have MNQ over here. Same thing with ES. You also have MES exclamation mark, MES1 exclamation mark, right? So these are the mini versions or the micro versions, the smaller versions of E-mini ES and E-mini NQ. All right, so these are very, very important to understand. Before I do get further into this, I want to break down how these points move or how these pairs move and the overall reason to be looking at these pairs, right? So the futures market in general, what it is, the instruments that it consists of, the main instruments are four pairs. You have NQ, ES, gold, and then you also have oil. All right, these are the four main pairs when it comes to trading futures. Obviously, I only focus on NQ and I only execute on NQ as well. And then I look at ES for some sort of correlation. Will also be explained in later clips how I use these pairs for correlation. All right. With that being said, we want to be looking at how these pairs actually work. Also, we want to be talking about how futures trading works as well. So when you are trading NASDAQ futures, ES futures, gold futures, or oil, you are not actually buying the stock. Okay, you are not actually having any sort of investment in the stock. You are buying the future price that is listed, for example, right here at 25,333. That is the current/future price of NASDAQ. All right, you are trading contracts. The only thing that you own is the contract. You do not own the stock. So you can either make money when we're going long, when we're entering buy positions, or you can make money when we're shorting and we enter sell positions. Obviously, if the candles go down, you will be in profit if you press sell. And if the candles go up and you press buy, you will be in profit, okay? With that being said, we want to be also describing how you're going to be making money and how much money you make per contract size. So I'll break down E-mini NASDAQ. That's the only real thing you need to focus on right here. Not even ES, just focus on E-mini NASDAQ right here. With one mini contract, if price goes up 1 point, so from $25,333, if it goes to $334 and you're in one mini contract, you gain $20, okay? You also need to understand there are ticks and then there are points and understand the difference between each. The ticks are on all the way to the right over here. There are 4 ticks in 1 point and they go in increments of 25. 0.25, 0.50, 0.75, and then 1 that goes to the next point. Now with these ticks, basically they move $5 per tick and that equates to $20 per point. So again, using the example where we are in one position right here, if we are in a buy, right? And then price is at 25,333. If it goes up to 25,333.25, that means I am up $5 on the trade. Same thing if I'm in that buy position and it goes down 1 tick to 25,332.75, then I am down $5, okay? Because it moved 1 tick increment. Now, if you move the whole point down, then I'd be down $20, okay? Now, when you keep multiplying, obviously the amount of money that you make multiplies and the amount of money that you lose also multiplies as well, okay? That is for E-mini NASDAQ futures, all right? You will have $20 per point increment per one mini contract that you end up trading, all right? Now, we want to be looking at the micro NASDAQ, okay? So that is also very important as well. Now, the difference between micro NASDAQ and normal mini NASDAQ is that micro NASDAQ is divided by 10. So that means with one micro contract per point increment, again, if you're buying or if you're selling, it moves up either $2 or moves down $2, all right? Now, Now, if you're obviously multiplying your contracts, you make more, but basically divide everything that you see on NQ1 exclamation mark. So the other one that I was talking about, divide it by 10, and then that you will get your point increments and your monetary increments, the P&L increments on MNQ. All right. So MNQ is usually used when you don't have a lot of balance in your account. If you're trading on actual live accounts, there's something called margin requirements. That's basically the amount of money that you can have in your account that allows you to trade a certain amount of contracts. So I'll give you an example. If we go to this trade button right here, there's all these different brokerages that are available. I will go with Tradevate because that is the one that I trade with whenever I do have live accounts. So their margin requirements are $1,000 needed in an account to be able to trade one mini contract. All right. Now it's the same thing when you're looking at MNQ. So to place one micro contract in a trade, you need to have at least $100 in your account and your balance, right? So again, I'm dividing it by 10. Same thing with the contract sizes. You're dividing it by 10 or you are multiplying it by 10, depending if you're going through mini NASDAQ, which is again NQ1 exclamation mark or MNQ1 exclamation mark. All right. Now, when we're looking at it from a prop firm perspective, let's say you're trading a 50K account, you have around $2,000 in drawdown, right? So you probably don't want to be trading NQ1 exclamation mark, but instead you want to be looking at MNQ1 exclamation mark, all right? And then you place contract sizes accordingly to your overall risk management plan, all right? So that is basically just overall NASDAQ that's broken down. How it moves essentially is, again, through ticks and then through points. Keep that in mind, ticks and points. All right, now I want to walk you guys through my settings that I have before I get into the indicators. Here's what I have. Here are my candle colors right here. I basically have the bodies, borders, and wicks enabled. I have white and then I have black. Everything else is all black. I keep it very, very analog. It just helps with the psychology because I'm not looking at red, I'm not looking at green. When you guys initially download TradingView, it will be basically plastered with red and green candles. That is very, 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 very emotionally tied to your psychology and how you behave on the charts, right? Nobody likes to see red, in a position. Same thing with green. People love to see green in a position, right? So we eliminate all of those psychological effects by basically, or at least mitigating it, right? The whole goal is to mitigate the amount of psychological effects that you're feeling on the charts. So we mitigate it by putting on these settings, right? White, black, 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 black. For my canvas as well, I have it grayed out. So for the background, I have the third tab right here. There is no watermark. I don't like having the watermark in the back. And yeah, this is basically it. If you look at the trading, is there anything else here? I have one-click trading that is on as well. Basically, whenever I can press buy or sell, there's no confirmation button. It instantly places an order. Yeah, so that's it for that. And then we also have the scales and the lines. This is just pretty simple. There isn't really anything else to change over here. And then for symbol, yeah, we already covered everything. So that is overall my canvas settings, just very, very plain, very, very simple. And this is exactly how I get this chart color in the background. I also want to walk you guys through some of my templates as well. So as we see right here, this is the rectangle box over here. My style, I have the middle line as black. The background matches the canvas background as well. Yeah, so this is the way that I like it when I'm marking out my fair value gaps and all of those things. I like to have this right here essentially, right? With that being said, that is what I have. And I also use the fib tool as well. I'll explain a little bit more about obviously the fib tool, and I'll also be explaining on how to use the fib tool. I'll also be explaining more about how to use fair value gaps as well. If you don't know what they are, don't worry. I'll explain it in a later clip, basically what fair value gaps are and all the concepts that I use in my trading. But these are the main two tools that I use, basically this fib tool, and I use these rectangle tools as well. I'll walk you guys through my fib settings really quick. I just have three things that are on 0, 1, 0.5, and 0.786. All right. This is very, very important. I use this to basically mark out ranges. Obviously, I will explain that in later clips as well, but it's just good to know the tools that I use right now so you guys are prepared in the future. All right. With that being said, I also want to go over my indicators really quick. So I have two indicators. I don't really use this one. That's why I have it hidden. I have two indicators right here. Number one is FX4. So what does FX4 actually do? You can look at, these are the settings that I have. Basically, it marks out previous day high, marks out previous day low, and it marks out midnight open. Basically what midnight open is, just to talk about it very briefly, is that it is what it is, right? I'm describing basically what is said on the screen. Midnight open. So at midnight open, you have a new day basically that forms, right? Goes into the next day. It is a very, very reactive area. When price likes to tap back into midnight open, we see some sort of reaction out of it. I don't know exactly why, but it's just more about the time-based opens that we end up seeing that are the most reactive, all right? Just to briefly touch upon it as well, time-based opens include London open, Asia open, and then we have New York open as well, right? These are all reactive areas, and these are time-based opens that price likes to overall respect or just react off of these areas. Obviously, I'll get a lot more in depth into it in later clips, but this is just within the context when you guys are seeing all of these foreign terms like Asian range style, accumulation range style, previous day style, all of these things, right? It gets a little bit confusing. But these are the settings that I have. Hide the table. There's a table that basically shows, you know, if you don't turn it off, it's right here. I don't really use this. There's no point. Yeah, so these are the settings. Feel free to copy it once again. I find it really clean. So what this actually ends up marking out is over here. It marks out previous day high, previous day equilibrium, previous day low, and midnight open. So I keep it very, very clean. That is the first indicator, right? For the second indicator, I have ICT kill zones and pivots. So what this marks out is not only, obviously, since in the past or in the what I was talking about previously with the first indicator, is it marks out some session highs and lows. So previous day high, previous day equilibrium, and previous day low are very, very important parts to look at in the market because they are key liquidity points. Basically, price wants to go and take out those areas when they end up presenting. Previous day high, previous day low, previous day equilibrium, they will happen every single day, obviously, because that is how the market moves, right? We create new highs and we create new lows. We also create equilibrium of the range between lows and highs, right? So just to kind of foreshadow what equilibrium looks like is between previous day low and previous day high. It is the middle point from those areas, right? It doesn't just need to be previous day low or previous day high. It can be the lowest point of a pivot point, and it can be the highest point of a pivot point. And you can mark out your low to the high over there with the fib tool that I was talking about, and then mark out the equilibrium of that range. But this indicator does that already for us, just for previous day high and previous day low. All right, enough of me yapping. Let's go ahead and talk about the ICT kill zones indicator. So just like FX4, it marks out session highs and lows. So on the 15-minute time frame, if we look over here, we can get a little bit more exact with it. It marks out London low, Asia high, Asia low, and London high, and New York AM low, and New York AM high, and PM high, and PM low. Those are the settings that I like to look at. There's also obviously other settings on here as well, right? I don't really mark out the lunch high. It's not really that important to me, but these session highs and these session lows and the session opens as well are very, very important to consider because that is where major liquidity pools lie. I will be explaining a little bit further, obviously in another clip, talking about these different sessions and why they are very, very important. But with that being said, copy these settings really quick. It tells you the time when they open as well. And yeah, you can just look at everything. I don't have any of these set up right here, but this is all that I really need. Just these kill zones, Asia, London, New York AM high, and New York PM. That is all I need for my trading. So these are the two indicators that I use. And yeah, that is basically it. All right, you guys. So now we are going to be talking about news in the futures market, specifically news events that are implemented to drive volatility in the markets. So we are on this website called forexfactory.com. I know this is Forex and I'm talking about futures. Why am I on a Forex website if we are trading futures instruments? Well, news is still distributed not only on Forex, but on futures as well. And this website is very, very popular and it accurately describes the news events that are released, and it still affects the futures market in general, right? So if we look at the time right now, it's currently 12:36 a.m. Tomorrow is Friday and we have these news releases, okay? They are classified under 3 folders: red folder, orange folder, yellow folder. All right, yellow folder being the least amount of impact in the market, Orange folder is somewhat of a medium impact on the market, and then red folder is the biggest impact in the market. All right, so this drives a good amount of volatility, and you always want to be looking out at the start of the week for red folder news events, mainly that happen throughout the week. All right, so you have different types of red folder news events, multiple. You have CPI, which is the most volatile, NFP, which is also the most volatile as well. NFP stands for non-farm employment change, basically. And that's what happened at the start of the month. If we overall look at the more section over here, what do we end up seeing? Over here, we have non-farm employment change. So this happens during the first Friday, typically, of each month. And then CPI usually happens towards the second or third week of each month. Sometimes it's on a Wednesday, sometimes it's on a Friday. But overall, if you look at Forex Factory in general, you will be able to understand and see when these news releases are. All right, so red folder specifically, you always want to be looking out for. These are the most volatile releases in the market and they impact price heavily. All right, there are PMI, as you see right here, there's PMI for red folder. There's also FOMC, which is the federal chair. They all come together, the committee, and then they have meetings. That's when the market moves towards around like 2 p.m. or 3 p.m. That's around Eastern time over there towards market close. That is usually days that you want to be avoiding to trade. All right, I'll get more into depth about that later on when we're actually on the charts. But overall, when there's FOMC days, you usually do not want to be trading because the New York AM session is usually not that ideal. It doesn't move that well. We usually like to accumulate on a FOMC day, and then all the volatility is being put into the market during FOMC release, basically. And that happens at, I think, again, 2 p.m. Eastern, and then there's a little bit of a break, and then Powell basically speaks 30 minutes after, and that's when the market also moves as well. So overall, if you were to avoid any sort of day two trade, it would be on FOMC day. Now we have PMI, which is another good red folder news event that I talked about. NFP, this happens at the first of every month, the first week of every month. CPI, very volatile as well. And then you have unemployment claims, all these other different red folder news events like JOLTS, job openings, as you guys see right here. And then now since we're trading in, Trump markets, he'll just randomly speak at some random time. We'll have a scheduled time and the market goes crazy, right? So the markets are just being overall manipulated by Trump himself. So that's why it's classified as red folder news. All right. So now if we talk specifically more about yellow folder and orange folder, these don't really impact price that much. So you don't overall have to worry about it. But like I was talking about in the last clip, talking about, the zero plan and all these different prop firms, they have news restrictions. They usually like to restrict it on red folder and some orange folder news events as well. All right. So with those releases, basically you cannot execute positions either 2 minutes before or after the news release on either an orange folder or a red folder, okay? So be very careful when you are trading those zero plan accounts or those accounts that have specifically news restrictions. Make sure you're not executing within that time frame. Otherwise, when you're eligible to take a payout and you request it, they will deny it. All right, and sometimes they might actually overall breach your account. So whatever profit that you make, they take away and then they close your account for good. And then you have to start over, buy a new evaluation account, etc., and go through the whole process again. So make sure you guys, especially as beginners, get this down now rather than later so you don't have to suffer the consequences of technically forfeiting your first ever payout. All right. So yeah, this is pretty simple. News brings a good amount of volatility into the markets in general, especially on the red folder news events. They also form special candles that form data high wicks and data low wicks. And this is exactly what I'm going to be talking about when I pull up the charts in the next clip, when we actually go and break down all the concepts that I specifically use in my trading. With that being said, that is how we read news. I will also be marking out some specific news candles that occur at these specific times so you can understand more about how news works in general. All right. I will see you guys on the charts. All right, you guys, welcome to the first concept that we're gonna be going over. And as you guys can see on the screen right here, we are gonna be going over candlestick anatomy. So this is what makes up trading as a whole. You have bearish candlesticks on the left right here, and then we have bullish candlesticks on the right, as we can see. Now, candlesticks form in two ways. They either open high and low close, or they open low and they close high, which is what I have marked out right here with this diagram up on the screen right here. Open high, low close, and open low, high close. So how a bearish candlestick forms is opening price will be here. All right, the candle forms a high, flipping bullish momentarily. So this will be a green candlestick that puts in the high of this candle. and then price tends to revert, and then we create the bearish body. As we can see right here, we put in the low of the candle, and then we have the closing price. So that is what forms a bearish candlestick. And on the opposing side, we have a bullish candlestick. So this is the opening price of a candle, of a bullish candle. We end up forming a candle low, which momentarily puts us in a bearish state, and then the candle ends up flipping, and then we close over here. But before we end up closing bullish, we put in a candle high. Finally, we close. All right. Obviously, candlesticks aren't going to look as perfect as this. You will have longer wicks on either the top or the bottom, and you might have shorter bodies as well that might look something like this, right? Or even like this. So there's different types of candlesticks. There's doji candlesticks, there's engulfing candlesticks. All of that, you will understand what they are. Those are just candlestick patterns, that's what they call them. But those aren't really that important to really know about. That's just names of candlesticks, but we don't really focus that much on the names. We focus majority on price action, right? So this is how bearish candlesticks form, and this is how bullish candlesticks form. There is a popular saying that wicks, they do the damage, and bodies, they tell the story. So what that means essentially is that when there is liquidity in the markets, with these wicks basically forming, price tends to take out highs, takes out lows, and this is what forms liquidity. I'll get more in depth about that in a later clip when I actually explain all about liquidity. But basically, when you have longer wicks on either the top or the bottom of these candlesticks, they basically take out previous price levels. All right. And when you go to the bodies, if we get a strong body close, that means there is a lot of momentum in one side. It can either be bearish or it can be bullish, depending on if the candle closes red or if it closes green. All right, now I want to show you guys some examples in real time so you guys can understand exactly what candlesticks look like. Ignore all of these sessions right here, all of these lines, don't worry about that. I'm actually going to turn off the indicators for right now until we get into the concept where we actually look at these indicators and actually look at these sessions, right? These all mark out liquidity. Obviously, I will explain that in a later clip. So if we zoom in and if we actually look at specific candlesticks, as we see right here, because my chart colors are different, the white candlesticks in this case, they mark out bullish candles. As you guys can see, the wicks are different lengths and the bodies are also different lengths as well, right? So when I was saying previously, wicks do the damage and bodies tell the story, I'm going to explain that right now. So with this entire move higher over here, let's take a look at this price action versus this price action. As you guys can see with these white candles, they are bullish candles. Look at how these bodies close, right? There is barely any wick and there is strong body. What does this indicate? This indicates strong momentum. There is a lot of volume, basically. That means buyers are taking control over here. So there's two participants in the market. This should be very, very obvious, but there are buyers and then there are sellers, right? That's how we get bearish candles, and that's exactly how we get bullish candles. You can tell by the strengths of the bodies, and you can tell how much buyers are in control versus how much sellers are in control. Okay, so this is a textbook example of buyers being in control right here since price is pushing up. All right. Now, if you look at these candles, right, or these wicks right here, you can see that this is a textbook example of a open low, high close candle. So this is on the 15-minute time frame, but this appears on the 1 minute, 5 minute, 15-minute, hourly, 4-hour, daily, on any single time frame. It doesn't matter what time frame you're on, you will still always have open high, low close, and open low, high close, because that is what forms bearish and bullish candlesticks. So as we see right here, this candle was bearish for a good amount of time, and then we ended up flipping, and then we closed over here, putting in that bullish close, right? So this is now a bullish candlestick when it ended up closing. Obviously, this wick is a little bit shorter than this, but you can see how the candle formed basically in hindsight. But if you visualize it in real time, you can see within the 15 minutes of this candle forming, it was bearish, and then we flipped bullish. Okay, now if we look at another example over here, now we see bearish candlesticks that form, right? And then the bodies are very, very strong. We are trending in one direction. This is where sellers essentially take control, right? Compared to buyers, okay? Now, if we look at all of this, as you can see, the candles, the size of the candles are also very, very small. That means there is not enough volume, basically. Buyers can still be in control somewhere over here, but there is not big movements as you see compared to these candles where price basically moves if we compare the candlestick movements, it moves a good amount. All right, if we look at this, for example, we move 500 points in one 15-minute candle, as we see right here, compared to something like this, another bullish candlestick over here, where we move not anything that significant, right? 123 points. All right, there's a big difference, right? Which is basically what shows the size of the candlesticks, right? Over here, this is a 54-point candle. In the 15-minute time frame, this is bearish. All right, another thing that I will be talking about is when price tends to move sideways, this is what is basically classified as accumulation. Okay, so this is consolidation / accumulation, and that is essentially when price moves sideways. I'll get a lot more into depth about that in a later clip when I actually explain the 3 phases of the market: accumulation, manipulation, and distribution. But I want you guys to basically notice this and keep this in your mind, so when we get to that area, you're going to be well versed, or at least you'll be able to recognize it visually, right? Accumulation is when price moves sideways, and then you have distribution, right, where price just moves in one direction after manipulating, of course. This may, again, all sound like gibberish right now, but obviously our main focus is on candlesticks and candlesticks only. With that being said, again, these are bullish candlesticks, bearish candlesticks, bullish candlesticks, bearish candlesticks, right? And then you see all these different sizes, which indicate a lot of different volumes. All right, so this is really just the basics, the absolute basics of trading. You have bearish candlesticks, bullish candlesticks. Remember, open, high, low, close, and open, low, high, close, right? That is what makes up a candlestick. All right, next we are going to be talking about trends. So I will see you guys in the next clip. Okay, so for the second concept that we're going to be going over is market trends. So there are 2 types of trends in the market, as we see on our screen. We have a bullish trend, and then we have a bearish trend. We need to focus on 2 things. One, on the bullish trend, we need to see exactly what identifies a bullish trend, and we need to see the second thing, what exactly identifies a bearish trend. So with this little mock diagram that I drew out, a bullish trend consists of highs and higher lows, higher highs, higher lows, and higher highs. When we have a formation that looks similar to this, where we're breaking past the last high, as we see right here, this is the first high that is put in. We put in a low, and then we break higher, we create a higher high, right? That is now part of a bullish trend. That forms a bullish trend right here. Then we go lower. We do not break past this first higher low that we form. We respect this low right here, and then we break past the new high that has formed. Now, again, continuing and respecting the bullish trend that we have. Same thing with the bearish trend, but in the opposing direction. So we have a move lower initially, putting in a low, then we get a retrace point, pulls back initially, and then we don't break past the first low, high, technically speaking, because this is the high that is put in before we put in the low, right? This is a high. So we do not break past this first high, and then now we create a lower high right here. Now we break past this low, creating a lower low. Now we pull back. Again, we don't break past the previous high. We put in this high, which is a lower high, and then we break past this low again, making a lower low. So this is a bullish trend, and then this is a bearish trend right here. Okay, now there is another concept where we have a break of structure. All right, I will be explaining that again in another clip, but basically just so you guys can overall remember and identify it when it actually, when we get to the point where we're talking deeper and deeper about market structure. A break of structure is basically when price breaks above a previous high or a previous low, right? So in a bearish trend, this would be the first or the last, I guess you could say, lower high that is presented, okay? So to form a break of structure, you would need to see price break and close past the first high, I guess you could say, if that makes sense, right? Once we break past the last lower high that is formed, and in this case, since we're shifting bullish, once we close past this high, this is the first lower high that we break past. This is when we get a break of structure. Same thing with a bullish trend turning bearish potentially is when we have the opposite. So we break past this high over here, maybe price will consolidate a little bit, it will move sideways, and then the last structural low that is put in, which would be right here, we now close past, and then that is now a break of structure. I'll get a lot more in depth about this later on, But first, we want to look at real market examples of bearish and bullish trends. All right. With that being said, let's go ahead and take a look. By the way, also another reminder is that with the time frames, I was initially describing that in the first clip that we recorded, talking about candlestick formations, right? This happens on all time frames as well. The markets operate usually the same on all time frames, right? There's something called fractal price action. Basically, price and market structure will always remain the same on every time frame. On the 1 minute, 5 minute, 15 minute, hourly, and 4 hour. These are just some of the important time frames, also the daily time frame. These are all important time frames because they align with each other. I'll also be describing a lot more about time frame alignment and why it is important in another clip. But for right now, let's focus on what we have in hand in front of us, which is bullish and bearish trends. So right now we're on the 15-minute time frame. So if we look at a bullish trend, we can identify that really easily right here. We've put in a low. Now looks like we put in a high. What do? We create a low, but look at what this low does. It does not break past the first low that we put in. There we go. Higher high. Once we break past this high over here, perfect. Where's the next retrace? Over here, we now put in this higher low because this low did not break past this low. So now we are in a bullish trend. Obviously, price is moving up, right? I'll show you guys a few more examples of bullish trends on different time frames as well, right? If you look at the hourly time frame, it will be the same thing where we have bearish trends, we have bullish trends that are overall forming just on more larger scales, right? Same thing with the 4 hour. We have more price action, but we are forming bearish and bullish trends all along, right? Now we can also go down to the 1 minute time frame and it will be the exact same, just on more of a micro scale. I'll also be teaching you guys how to use these different time frames, how to use time frames for looking at your bias, your drawn liquidities, etc., doing your analysis, and the time frames to look at for your actual execution. But of course, before we get into that, we need to understand basic market structure first, right? If we look at the 1 minute time frame, we see there's consolidation over here. Now, if we look at more of a bearish trend on the 1 minute time frame, we can see right here as well. So we put in this high. Look at what we do after this. All right, let me zoom in a little bit more. We go lower. Okay, so this was initially a bullish trend, and then we get a shift in market structure. So we get a break of structure lower. Obviously, I will explain that a little bit more in depth. I'll actually go back to this exact example when we get into that, when we actually explain the concept of break of structure. But just focusing specifically on trends, we have a push lower. Initially right here, we get a little bit of a retrace. So this is a low, and then this is a higher low that is put in, and then boom, we break lower once again, creating a low. Where is the next retrace? Okay, now we're pushing lower all the way over here. Now we get a little bit of a deeper pullback right here, which creates again a lower high. And then what do? We break past this low once again, creating a lower low over here, right? And then now price starts to go back higher once again, failing to break past this high, right? Pay close attention. We fail to break past this high over here with this retrace. Again, still overall respecting the bearish trend, right? Now we break past this low over here, again, continuing the bearish trend. And then now we put in this low over here, right? That is a bearish trend. And then obviously with a bullish trend, I just want to see a good example really quick. Maybe with this example on the higher time frame, on the hourly time frame, we will look a little bit further into that and see what is a nice bullish trend that we form. All right, so we'll look at this bullish trend right here. So this is the lowest point of price action, right? We put in this low right here. What do? We get an instant move up. Okay, so this is now putting in a high. If we zoom in a little bit further, what do we see? Price is moving lower a little bit, and then we break past this high over here, right? We finally break past this high, creating a higher high, and then now we move higher, right? So this is now an entire move higher. Now, again, this low doesn't break past this low, and it doesn't break past this low, right? On the higher time frame, look at what we're doing. We are overall trending higher. Obviously, it won't be as perfect as this little diagram that I drew, but again, focus more specifically on the lows that we are creating and the failure to break past these lows, right? We are overall creating bullish structure. We get a retrace, boom, shoot back up, making another micro bullish trend on the hourly time frame where we push up. We have this low that is created over here. We get a little bit of a retrace, and look, we don't go and break past this low, but instead we go back higher and break past this high over here, right? Yeah, and then now we're creating more and more trends. We push up once again higher, retrace. We don't break past this low all the way over here, go back higher, bullish trend, right? Same thing with the bearish trend as well. Let me find more of a cleaner example so you guys can overall understand concept. Cool, we can look at this right here. Clear bearish trend, we move lower initially, get a retrace, again, not breaking past this high, boom, go lower, break past this low, and then we get a retrace once again, doesn't break past this previous high over here, boom, go lower, break past this low, retrace over here, boom, break past this low, and then create a lower low, right? So lower lows, lower highs, lower lows, lower highs, lower lows, and lower highs, right? That is a bearish trend. And then bullish trends we have overall, right? Lows, highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, right? That is overall market trends, okay? So now that you guys understand how the market moves in a bearish and a bullish direction, now we can focus more on liquidity, right? So now we will be talking about liquidity, and we will also be talking about drawn liquidity. So I will see you guys in the next clip when we focus all about liquidity, what it is, what it's used for, and how to spot liquidity, all right? I will see you guys in the next clip. So the $1 million question is, what is liquidity? All right, so I explained it a little bit right here on the screen. Basically, liquidity, just in simple terms, it is orders that are just sitting in the market, okay? Price needs to move somewhere. Liquidity will drive price in a certain direction, right? Either we are bullish or we're bearish. That all has to do with liquidity in the market, okay? We need to take out liquidity first before sponsoring some sort of move, before making a move in a certain direction, all right? Think of liquidity basically as fuel to move price in a certain direction, all right? So I drew out this diagram right here for you guys. There are two charts. There is a bearish chart and then there is a bullish chart, all right? Liquidity essentially lies at highs, lows, and then inside imbalances as well. I will be talking about imbalances, but essentially, we need to understand when we take out highs, when we take out lows in one direction, we will have a shift in the other direction, all right? There are prominent liquidity points that we will be talking about. I will be talking about this a little bit later into this clip, but essentially, we have highs and lows. That is what you need to focus on, at least right now as beginners. When we take out highs, when we take out lows, you will see a shift in the opposite direction, all right? Stop losses and take profits are overall set in these areas. All right, you have buyers coming in, taking out stop losses. As we see right here, we take out highs over here. People are trying to short in this area right here. Maybe they try to short on this impulse move, and then they put their stop loss at what they think is a protected high in the market. Price then comes out, sweeps the high, and then we finally induce the sellers over here, we take them out, and we finally short the move. All right, I'm also going to be talking about how you can basically, understand when you're going to get stopped out or when you're going to get swept versus not, because we need to be looking at key liquidity points. So this has to do with session highs, session lows, and then, session highs, session lows, and then we're also looking at imbalances as well in the market. All right, so now I'm gonna go ahead and turn on this indicator so we can get more into session highs, session lows, all of these things. All right, remember when I was talking to you guys about the indicators, this is where it comes into play now. Okay, now we're gonna be talking about bullish markets where we sweep lows first and then we shift in the opposing direction. So we have our stop losses set at lows where the buyers are basically trying to get in, right? People are trying to buy initially off of this move. Maybe they try to long off of this initial move right here. Boom, they put their stop loss at the low. Looks like price is gonna go in this initial area. We might go and sweep out this high, but looks like we don't wanna do that. Boom, we go and take out the low. We now induce the initial buyers and then we go and run up finally, right? This is also known as a liquidity sweep where price takes out stop losses in the real market, obviously because people are trying to get in initially, they take them out, they grab their money, and then price finally makes that move, right? And then now this becomes the protected stop loss over here when the buyers are entering in these positions, and then this becomes the protected stop loss over here when sellers are entering their position after taking out a prominent high. All right, now your take profit is going to be in the opposing direction, okay? So people are probably gonna go short somewhere over here. Where are they going to take profit? They are going to take profit at the opposing liquidity point, which would be right here, right? Same thing in the opposing direction. People are getting stopped out over here. Buyers are now stepping in. Where is their take profit? It will be at the opposing side, right? At the other liquidity point. it will be another high. If we're obviously in longs, and then if we're in shorts, it will be at this low over here. Even at these points, there will be more sellers coming in. If we're talking about a bullish case scenario, right? Boom, your stop gets hit over here, buyers step in, and then now we take out this high over here. What is the market potentially gonna do? We end up shifting, and then we go lower, and then the cycle ends up repeating, right? Boom, and then we go back higher, take out stop losses over here, boom, shift in structure, and then we go lower. Obviously, cycle repeats, right? Same thing here as well, where boom, we take out the low, and then we revert. Buyers now step back in, take out these highs that we just swept, and then we go back lower, cycle repeats, right? The market will always be going up and down, and liquidity will always be basically getting taken, all right? So this is the overall concept of liquidity. Now we have liquidity, and then we have draws on liquidity as well. Essentially, draws on liquidity are where the market actually wants to go, right? Liquidity can just be random highs, random lows. It can also be imbalances in the market, such as fair value gaps. I did not mention that earlier, but there's also liquidity that is located in imbalances in these fair value gaps. It can be on any time frame. It can be on the 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, whatever time frame that is available on TradingView, you will have liquidity and you will have imbalances. You will have fair value gaps. All right. Obviously, when I talk a little bit further, more in depth about fair value gaps and how to use them, you will understand what are the best fair value gaps to spot and understand what internal liquidity is and external liquidity. Actually, right now, we should go ahead and get into internal liquidity and external liquidity. So I'm going to go ahead and draw out a little diagram actually above right here, talking about internal liquidity. Actually, I can do that right here. So we can talk about internal liquidity versus external liquidity. Where does external liquidity lie? External liquidity is at the lowest point of the market, okay? So I'm just gonna look at this diagram specifically right here because we're looking at a bearish diagram. This is external liquidity right here. This is the lowest point of the market right now, and this would be classified as external liquidity, right? All of these lows that are built, basically that, form the bullish trend over here. We put in this higher low, we put in this higher low. This is now all internal liquidity. All right, price can take out internal liquidity and we can get a little bit of a reaction as we see right here. This little low, we ended up sweeping and then we get a little bit of a pullback, right? This is internal liquidity. I will mark this out right here. It may seem a little bit confusing right now, but when I actually break it down on, in the markets, when you're actually looking at candlesticks, it will make a lot more sense. So we go up, we sweep out this high. This is also external liquidity. Why is this external liquidity? Because this is the highest point of this overall leg, right? This is the leg that we are creating. We take out this high. This is the external point. And then all of these high or all of these lows that are formed right here is internal liquidity. So once we go and take this out, there's a little bit of a pullback. Of course, we don't go and break this high, but we go lower, we take out internal liquidity again, and we take out all of this internal liquidity as well, right? We get a pullback, and now we take out external liquidity, which is this low all the way over here. Same thing in a more bullish case scenario. Where is the internal liquidity that lies? It would be right here, all right? We go and take out this low, which is external liquidity. We go back higher. This is internal liquidity number one. Why is this internal liquidity? Because after we take out external, we now form this high over here, higher low, and then a higher high, right? Since we're in a bullish trend, the only thing that we want to be focusing on are the higher highs that we go and potentially take out when we are creating that bullish trend, right? These higher lows are part of the bullish trend, so this is not really liquidity that we want to be targeting because we have an overall shift in structure over here, right? I will also be, again, talking about market structure shifts and all of those things in a later clip. But for right now, focus on these internal liquidity points for us to be overall taking out, right? This is another internal liquidity point. And also to the left over here in this bearish leg that is created that took out this external liquidity, we also form these lower highs as well, right? So once we have that shift in structure, price is now going bullish. This is now turned into internal liquidity. Boom, internal liquidity over here, and then another internal liquidity point over here as well. This is all internal liquidity. Then what would this be? Since there is probably not that much structure that is above right here, let's say price was forming, this is how price ended up developing, right? We go higher, we put in this highest point right here, then we go lower, and then we sweep out this low, and then we go and revert back to this high over here. This is now external liquidity, right? This is internal, 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 internal. obviously following the trend. Now we go and take out external all the way over here, okay? Now let's actually go and mark it out on the charts, all right? Internal versus external liquidity. Perfect. So if we look at the hourly chart, actually this would probably be a pretty chill example if I can just find one really quick. So external liquidity would be within this leg right here, okay? This high is the highest point basically that put in this low right here, right? Over here, you see price is overall trending to this area when we overall have a bullish trend that is created, right? We push up higher initially, we break past this high, and then we put in this high over here. Again, this is the same example that I used to basically form a bullish trend. We put in this high, boom, we retrace, we put in a higher low, boom, we put in a higher high, higher low. Now, where is the internal liquidity in this situation? Internal liquidity is number one, all right? Over here, this line that I marked, internal liquidity number one. Where are the stop losses basically placed over here? It is placed at this low, right? So this is the same thing that I kind of illustrated with the diagram. Liquidity lies here, okay? So for the people that are trading on the higher time frame and they're maybe holding for longer positions, some people may have been overall induced, right? There are buyers that are induced into this little move over here. They think, oh, the market is probably going to shift because we took out this low, we displaced past it, and now it looks like we want to revert a little bit. In this case, no. Stop loss got hit. The basically potential buyers got taken out over here. Boom, we swept the low, and then now we have the shift of structure once we end up closing past this high. So again, I was going to explain it, a little bit further into this video, what market structure shifts are, but I've been talking about it so much. At this point, I might as well just include it in this overall clip combined with liquidity. All right, so where do we get that market structure shift? All right, what is a break of structure as well? This is what a break of structure is, all right? BOS, that is what we kind of classify it as, all right? This is very simple market terms. As we see, overall, we're in this bearish trend, all the way we put in this high over here, right? If you look at the 4-hour time frame, this, over here actually, if we look at this, right? This is all-time highs all the way over here, right? There is no other highs past this. As we see, we are continuing to go lower and lower and lower. We still create this bearish trend and maintain this bearish trend. Even though we may be breaking past these highs over here, we still revert lower, all right? But we want to be looking at the most drastic moves and the overall legs that follow market structure, okay? So this leg, this higher leg that we created right here, as we see, we have a good amount of consolidation and then we get a breakout over here, right? We break past these internal lows. So actually, when we're talking about liquidity, we can honestly just mark it out right here. We put in this high, boom, we go lower, we go back higher. Again, we fail to break past this high, so we put in a lower high over here. Boom, we go lower once again, but we are consolidating and then we are building up liquidity for us to take. We are generating liquidity. We are generating internal liquidity, right? There is consolidation periods that happen in the market, and on the higher time frame over here, this is more of consolidation, right? Price is moving sideways. We put in this low over here, we put in this low over here. It looks like we're going to fake out and break past these highs and potentially take out this high. But no, this is all liquidity that is generated for us to now go lower. What happens here? Boom, we go lower initially, taking out this low over here, which is internal liquidity. Whereas our external liquidity in this specific leg right here, this is external liquidity, right? Same thing that I drew with this diagram right here. Once we put in this move higher, boom, higher low, higher high, and then now we get that shift in structure. But where is the actual shift in structure over here? The market structure shift or break of structure is when we break past this low right here, okay? So we can have a little bit of a downturn. It looks like we want to go higher and break past this high. We don't. What do we see? Boom, market goes lower right here. All right, this is now your shift in structure, and then we go lower and we break past this low as well, taking out internal liquidity number one. We retrace higher after reacting, and then this is now external liquidity in this leg, right? You want to be, when you're looking at liquidity, you want to be looking at it within the legs. So we have bullish legs over here, and then we have bearish legs that are created, right? So we take out external liquidity, boom, what do we form over here? More external liquidity, because we put in this retrace over here, right? We put in this bullish leg right here that is creating internal liquidity. As you see, same thing here. Compare this bullish leg to this bullish leg. What do? We put in this low, boom, move higher, go back lower, again, creating a higher low, go back higher again, go back lower, these are all higher lows that are created, right? Generating internal liquidity. And obviously this is the lowest point in the overall bullish leg that we created. Same thing here. Lowest point that we created, boom, go back higher, put in this retrace. What is this? Internal liquidity. Boom, go higher, retrace lower. What is this? Internal liquidity. Again, where is the break of structure back lower? Once again, when we break past this low. Again, this is also internal liquidity that we take out. Internal liquidity number one, also aligning with the break of structure. Perfect. Now it looks like we want to go lower. We also take out internal structure number two over here, right? Now it looks like we finally want to go and take out external liquidity all the way over here. Boom. What do we see? Consolidation. Price now decides to consolidate. Looks like we take out these highs, and then we finally go and take out external liquidity over here. In the process of taking external liquidity, what do? We go ahead and take out internal liquidity that is created, right? So that is the overall structure of the market. We will generate internal liquidity either through consolidation, or again, if we're looking for a bearish trend, we will create these basically higher lows, right? Or lower lows actually in this case. And then we go and finally take out, the areas of interest, which is the liquidity that is generated. All right. Hopefully that makes sense for you guys. I tried to explain it in the best way possible. Over here is a little bit clear as well. I don't actually know why I have this drawn out, but anyways, we put in this high. What do? Boom, we go lower, retrace. What do we generate? Again, we push back higher, create a higher low over here, and then we go back lower once again, generating internal liquidity and internal liquidity here as well. Internal liquidity, this is external liquidity. I apologize. This is external liquidity right here, and then we have internal liquidity, again, external liquidity, and then we go and take this out right here. Finally, putting in a retrace, taking out all the buyers in this move up, and this is where we get that shift in structure, right? So now we go back to this example once again. What do we do after taking out this low? Break past this high right here, causing a market structure shift / break of structure. And then what do we do after this? Create a higher low, higher high, higher low, higher high. And what do we finally do? We take out some sort of external liquidity. All right. And where is the internal liquidity that is generated? Number one, internal liquidity number one right here. Okay. Internal liquidity number one. Okay. That is the first internal liquidity point. Number two is right here. Again, with the trend that is created, internal liquidity. All right. Because again, we are creating a bullish trend. So we are going to create a higher high. That is what we're expecting after we get the break of structure over here. Okay. Perfect. Internal liquidity number two. Okay. Now we have more internal liquidity that is created on this bearish leg. All right. You're looking for essentially what you're looking for is swing points that are created in the market. What are swing points? This essentially. Swing points is when you have, it looks like a mountain peak almost, right? That is kind of the formation that you can stick to. As you see right here, it forms a somewhat of a V shape right here. A swing point is basically when you have a V shape recovery like this, and then the lowest point is going to be the lowest swing. Same thing here as well. When we're looking at a bullish swing point, what do we see right here? Boom, we peak higher, and then this is going to be the highest point, and then we go lower off of this, right? Same thing here as well. We have this little 3 candle sequence. Boom, this middle wick right here is the highest point. That is where you are going to identify a swing high, right? Swing high over here as well. Swing high over here, swing high over here. You see how we're creating this overall peak kind of formation? That's the liquidity points that you overall want to be targeting, and you want to be targeting the highest point essentially of the swing of the peak, right? So same thing here as well. We have internal liquidity number 3, right? I'm just going to abbreviate it now because it is getting kind of long to explain, to say internal liquidity every single time. Now we finally have external liquidity. Now, why is this external liquidity? All of this is now external liquidity. Why is it external liquidity? Because this is the highest point whenever we broke structure over here, right? Whenever we broke past this low, this is where the actual bearish trend occurred, right? All of this over here is consolidation. Why is this consolidation? Because once we broke past this low, we retraced super high, and it's not like we overall kept the same bearish trend that was going, right? Compared to this bearish trend, we break past this low and we continue to swiftly go lower. So this is now marked as external liquidity because this is the highest point that put in this bearish leg on the higher time frame. So external liquidity number 1, and it is literally the only external liquidity point, right? What do we see after this? What can we expect the market to do after this? Sort of consolidate, all right? Cool, we have established that. That is overall liquidity. We've identified bearish liquidity points and bullish liquidity points. Actually, I do want to kind of go over more of a bearish example once we take out highs, where we have stop losses basically set. Overall, the market has been in a bullish trend, so I would like to see some sort of example that we can see where highs are getting swept and then we go lower. I just want to show a very clear textbook example. That would be pretty sick. What do we see over here? Okay, this is external liquidity. Why is this external liquidity? Because this is the highest point in the overall leg that we created, right? External liquidity lies over here. We also get a shift of market structure once we break past this low. Boom, we go and take out all of this generated liquidity over here, right? Obviously, I'll get into that a little bit later, but I want to focus specifically on this. Once we take out this high, this is where stop losses and liquidity lies, right? This is where sellers now come into play, right? Buyers were overall in this market over here. Once we put in this low, boom, we go higher, higher, and higher. And then they have their stop losses when they basically see price go short over here, right? They see some bearish candles and they're like, oh, let me get into these shorts right here. What ends up happening? They get swept out of their position because their stop losses are lying over here. And then boom, the market finally ends up dumping. And what do we have in terms of liquidity? We have internal liquidity right here, right? Boom, internal liquidity here as well. And what is external liquidity in this case? Right here. And why is this external liquidity? Because in this initial move that we put right here, we put in a higher low number 1, higher low number 2, and this is the lowest point, making it external liquidity, right? So this is now more of a bullish case example where we have basically highs that are set over here and price goes and takes it out, taking out the stop losses of initial shorters, and then we finally make the move lower. Once we break structure past this low right here, retrace a little bit, boom, go lower, retrace, and then we take out all of these liquidity points, right? After that, we get a huge retrace, and then we still decide to be bearish, all right? So that is overall liquidity in a nutshell, just in terms, we're not even talking about sessions or any of those things yet, all right? Now, when we include sessions, that's where things get a lot easier, right? Because you're not focusing on these random highs or random lows to get taken out, right? I only really use that as an example, but basically going back to what I was talking about initially, how do we know where to put our stop losses then? How do we know when we're gonna get swept out versus not? Well, that is a very good question. Now we are going to be talking about the important liquidity points to be looking at, all right? This is where you want to be targeting in terms of putting your stop losses, in terms of putting your take profits. You want to be targeting these areas that I'm going to be talking about, all right? Because that is where stop losses are potentially going to be lying, right? You're basically going to be, I guess, quote unquote, taking money from other people that are in positions or filling their orders essentially, right? With that being said, let's go ahead and explain these two indicators right here, FX4 and ICT kill zones, all right? If we go to the 4-hour time frame right here, or actually the hourly time frame, you see that we have three things: previous day high, previous day equilibrium, and previous day low. In this case right here, we will be only focusing on previous day high and previous day low. Why are we focusing on these two only? Because these are strong liquidity points. Previous day high essentially means if we go on the daily candle, if we look at the previous daily candle, now let me actually go ahead and remove all of these drawings because I don't need them anymore. If we look at the previous daily candle, we have the high and then we have the low. Again, referring back to open high, low close and open low, high close, what would this candle be? This would be an open low, high close candle, right? That means this is a bullish candle where price opened low initially, put in previous day low, put in this wick at 24,953, and then we reverted structure. We made a bullish body and then we put in this previous day high and we close at this area, right? Just to refresh your memory on what open high, low close is an open low, high close, right? Same thing with these other pairs, with these other candles right here. We initially had an open high and then we had a low close. So, with each one of these daily candles right here, we have previous day low and previous day high. These are very strong liquidity points, all right? This is where orders are going to be lying at previous day low and previous day high. Now, the thing is you cannot get this twisted, all right? Sometimes we might not take out the previous day high. Sometimes we might not take out the previous day low. Obviously, we're not gonna expect that 100% of the time, right? We're not expecting the next day immediately to potentially take out the previous day high or the previous day low. Obviously, because since within the daily candle we move a good amount of points, anything could really happen. We could have price potentially just doing nothing. We could consolidate when New York session ends up opening at 9:30 a.m. Eastern. We could just be moving sideways essentially, right? And then we don't take out previous day high. We don't take out previous day low. We don't do any of these things, okay? Now, the thing is with previous day high and previous day low, once we see a trend in that direction to previous day high, then it looks like a good target for us to take, right? If market structure overall aligns and we're creating higher lows and higher highs, higher lows, higher highs, and overall we look like we're trending to previous day high, that is a good liquidity point. Same thing with previous day low as well. If we are creating lower highs and lower lows, and then eventually we're getting closer and closer to previous day low, what do you think is going to happen? We are probably going to take out previous day low, right? That is how I like to look at previous day high and previous day low. All right, as we see over here, this is a very, kind of clear example where we put in previous day low over here. What do we do as soon as we put in previous day low? Okay, looks like we go and edge this low. We don't go and take it out. But what do? Once we put in previous day low, we create a higher low number one, boom, higher low number two, and then we go higher and then we take out these session highs right here. And then finally, it looks like we are trending towards previous day high. What ends up taking out previous day high over here? Asia session. Asia session opens up and then we go and finally take out previous day high. All right, because again, we are super, super close to previous day high. All right, so with that being said, those are two major drawn liquidities. Now let's go ahead and focus on sessions and what they are, when they end up opening, and why they are important, right? Previous day high, previous day low, pretty simple. Again, that is just the highest point of the daily candle and it is the lowest point of the daily candle as well. That marks out both previous day high and previous day low. Now, when we actually get to the sessions, it becomes a little bit different, okay? So if we click in this indicator right here, these are basically kill zones or just session times, all right? So if we see Asia session, when does it end up opening? This is all in Eastern time, by the way. 20 o'clock in 24-hour time, so that means that would be 8 p.m. Eastern. That is when the Asia session ends up forming. London session. This is at 2 a.m. Eastern time. All right, New York AM session. This should be the most obvious. It is at 9:30 a.m. Eastern, and then it ends up closing at 11. New York session has 3 mini sessions in there. New York AM, New York lunch, and New York PM. All right, this is the most probable session when it comes to trading NASDAQ or when it comes to trading ES as well. Me personally, I only focus on trading NASDAQ, so I'm only going to be looking at that. But essentially speaking, we have 9:30 to 11, and then we have 12 to 3. Lunch hour, basically what it is a period where price usually dies down. We're usually consolidating, we're generating a little bit of liquidity to set us up for New York PM session where price goes out and takes these liquidity points, and then we make another move. All right, this happens during 1:30 Eastern, and then it closes at market close, which is at 4 p.m. Eastern time. Actually, no, I apologize. It actually closes at 5, technically speaking. It closes at 5, and then it reopens at 6 p.m. Eastern. So there is a 1-hour gap. But if you're trading with prop firms, you have to close all your positions by 4 p.m. Eastern time. Okay, so with that being said, why is this important? Okay, this is important because these are key opens. Key opens basically means when a new session forms, you want to be knowing what are the times of these session opens, and you will be able to mark out lows and highs that end up occurring in these sessions as marked out by the indicator right here. Okay, these are also key liquidity points, especially if you're trading New York AM session from 9:30 to 11 a.m., which is what I recommend you guys all do. As beginners, only trade from 9:30 to 11, only trade New York AM session because it is going to be the most volatile price action, which is good, and it is also going to be moving well, right? So price is gonna move with a lot of volume compared to Asia, compared to London. Why is that the case? Because New York session and NASDAQ is driven by New York session, all right? That is what runs NASDAQ, New York AM and New York PM, and obviously lunch as well, because it is a US-based stock, right? So Asia and London, it won't really move that well on a typical basis. You will have these abnormal times, basically, where Asia or London ends up moving more than New York AM session or New York session in general. And that is usually due to basically third world conflicts that go on, or just like real world conflicts that go on. such as right now in the time of recording, there is a war that is going on in the world, right? Basically between the US and like Iran, there's a bunch of conflicts going on between the two, which is why you see Asia session have these crazy moves, because news basically comes in and then we just move the markets a good amount of points, right? Usually that's not what happens, but right now, since we're in these conflicts, we overall have to adapt to market conditions. But with that being said, I am getting a little bit off topic over here, so let me reel myself back in. We are focusing on liquidity points, okay? We have Asia low, London low, Asia high, London high, New York AM high, New York AM low, New York PM high, New York PM low, okay? This indicator will mark out all of these things, and as we see, we go out and take out these highs and these lows, right? Why do we do that? Because these are key liquidity points. So when you are looking to trade New York AM session, basically, key liquidity points, again, besides previous day high and previous day low, can really be London low or Asia low. So let's look at some examples right here where price goes and basically takes out these areas, okay? Actually, I can only go back this far, unfortunately. But let me see right here where we have New York AM session that basically comes in and takes out London high, okay? So as we see right here, we created London low over here, and then we get into pre-market before 9:30. What does price end up doing? Boom, we take out London high, right? New York PM session high from yesterday, not yesterday, but from the previous day as well, that is another strong draw on liquidity, right? New York AM high from the previous day is also another strong draw on liquidity. What does this New York AM session do over here? As we see, look at the date at the bottom, Thursday, 09 April. What is these liquidity points right here? Wednesday, 08 April, right? Wednesday, 08 April. This is liquidity that is lying from the previous New York session, and then we consolidate a little bit with Asia and London, and then we end up overall expanding, making this expansion move over here with New York AM session over here, right? Boom, we take out the high of day initially from this session, and then we go and take out the previous day session highs, right? Yeah, essentially, these are very key liquidity points, okay? Look to target these when we go into New York AM session, when we have trends that are overall suggesting that we want to go to and take out London or take out Asia, or again, New York PM low or New York PM high. All of these things will be marked out with the indicator, and if the trend overall corresponds with it, you are able to potentially take an entry to these areas, all right? But that is basically liquidity broken down in a nutshell once again. And then we also talked about drawn liquidity, where the market overall wants to go, where it tends to go, and where it is drawn to, right? Just to briefly summarize, drawn liquidity, we are focusing on more of the key liquidity points, which is session highs, session lows, right? PM or previous day high, previous day low, and then everything that is marked out by the indicator, right? Those are very strong drawn liquidities in the market. Price tends to go and takes out the previous session highs and lows before making, a move. Or again, that can be the initial move, right? The overall big move can be to these session highs and to these session lows, all right? With that being said, we will now, in the next clip, cover more about imbalances, fair value gaps, get a lot more depth into that, because we covered basically everything else besides fair value gaps. So we need to be talking about the importance of them and what they actually are. So I will talk about that in the next clip, and yeah, I will see you guys then, okay? All right, you guys, now we are going to be talking about fair value gaps. So fair value gaps are very, very essential with the way that I trade, and it is just very, very good to know how fair value gaps work. Essentially, fair value gaps, very, very simple. You do not need to overcomplicate it. The only thing that gets a little bit tricky is what fair value gap to use, and I will obviously be going through that in this clip right here. So fair value gaps, the essentials, the basics of it are basically it is imbalances in the market, okay? So when we were talking about liquidity, going back to what we were talking about liquidity, where orders are resting, they rest at highs, lows, and also in fair value gaps, imbalances in the market. How do they form? By a 3-candle sequence. So we have these 3 bullish candlesticks right here. Between the top wick of this candle and the bottom wick of the highest candle, this is where we form a fair value gap, okay? This is a bullish fair value gap because obviously we are trending higher. What does price like to do? it likes to potentially go back and revert into these fair value gaps first before continuing the bullish trend higher. This is called a pullback, essentially known as a pullback, right? This is where we create those higher lows. If we have basically bullish fair value gaps that are forming, we like to see price overall revert back to this area to where then we can get an entry potentially, right? If we take our risk to reward tool, we can potentially get an entry. You can put your stops, at the lowest point of the bullish trend over here, or you can put it at the rejection point. Obviously, we'll be talking about entries and overall the way that I like to trade as well a little bit later in the video. But for right now, this is what we're overall looking at in terms of what these fair value gaps are used for in the market. We end up retracing into it and then we create the higher highs, right? Now we go to the bearish fair value gaps, same thing essentially, but just in the bearish direction. 3 candle sequence, we're looking at basically the bottom wick of the first candle in the 3 candle sequence, and then the top wick of the third candle in the 3 candle sequence, right? And then in the middle, we have this gap, this imbalance that forms. And then what does price like to do? To go lower, we initially go back up first, and then we tend to go back lower, right? So this is a bearish versus a bullish fair value gap, all right? This happens on all time frames. And obviously, when you're entering on different time frames, usually you will be like entering on the 1 minute or the 5 minute time frame. But overall, you want to be correlating the different fair value gaps in the different time frames, then finally getting your entry based off of certain fair value gaps, right? On the 1 minute or the 5 minute. Obviously, we will be talking about all of that a little bit later, but very, very simple. Again, we don't need to overcomplicate it. Now we can just go ahead and talk more and spot examples in the market, all right? So fair value gaps, very simple. Bullish fair value gap, where do we find it? Easy, right here, right? 3 candle sequence, 1, 2, 3. What do we see? Top wick of the first third candle sequence right here, of the first candle of the 3 candles over here, boom. That's the top wick, and then we have this candle right here that forms this imbalance as we see in the middle. I'll zoom in even more just so you guys can really analyze it. Boom, right? We have this over here, and then we have the third candle that puts in the bottom wick. We don't overlap this wick, so we create a gap, which is why it is called a fair value gap. And then there you go. That is your bullish fair value gap that is created in this area right here. Obviously, we see price does not go back and tap into it. Again, we do not need to go and revert into every single fair value gap, right? There are only certain ones that we do go ahead and revert into, and that is shown right here, all right? We like to revert into fair value gaps whenever we take out internal liquidity, as we see right here, or external liquidity as well. And we want to go to these other drawn liquidities that are presented, right? Other liquidity points that are presented. As we see right here, what do? We take out a high. Where does price revert into? Into the liquidity, right? So liquidity as in fair value gaps, right? We have this fair value gap that is presented as well. Look at this candle, boom, 1 candle right here. We put in a top wick, second candle, we leave a little gap over here because this third candle right here, we don't have even a wick that forms that overall laps this first initial wick right here. What ends up happening? Boom, fair value gap. Now, I want you to pay attention to price right here. Okay, look at what we do. After we take out New York AM session high, which is a liquidity, right? A point of liquidity, we end up rejecting, retracing into this area and then pushing back up, right? Creating overall the higher high. Obviously, we end up resweeping this first. We sweep out this liquidity point, but look at how we respect this fair value gap, right? We don't close past it. We don't violate it. We just overall respect it. We wick out of it as well. Like I said initially, wicks, they will do the damage and then bodies will tell the story, right? There is no close, there is no strong close past the fair value gap, which will overall create an inverse fair value gap. That is what I'm going to be talking about a little bit later as well, where basically you can see invalidations of these fair value gaps that I'm marking out, obviously paired with sweeps of key liquidity points for you to get an entry into the opposite direction, right? So for example, we took out these highs over here. Boom. If we ended up closing past this fair value gap with a good amount of volume and a strong body closure, we could potentially get an entry to a lower area. Obviously, this may seem confusing to you guys right now, but once we get deeper into more of the advanced concepts, after we cover more of the beginner concepts, you guys will be able to understand essentially what I'm talking about. right? So as we see right here, boom, we respect this fair value gap. And since we're talking about inverse fair value gaps right now, I might as well just point this out. What do we create? A bearish fair value gap right here, okay? This is an example of a bearish fair value gap. Boom, first candle over here, we put in a wick. Second candle over here is the body. Third candle, boom, we put in another wick that does not overlap this wick, right? I want you guys to really, really look closely over here, right? Because there is a lot of cluster. Okay, cool. Look at what we see over here. Fair value gap. This is a bearish fair value gap. Now, look at this candle that forms, right? We end up closing past this fair value gap right here. And then now that is what you call an inverse fair value gap, right? Once you see a candle close past a bearish fair value gap with a bullish candle. Same thing with a bearish inverse as well. Bearish IFVG, that's what you call it, right? That's when price closes past a bullish fair value gap that forms. I guess I'll briefly cover that right now since we're just on the topic. What do we see right here? Okay, we have a bullish fair value gap that forms. Again, the 3 candle sequence that we were talking about. 1, 2, 3, bottom wick over here, top wick over here. But as we see, oh look, this is a bearish candle. How is this still a fair value gap? Again, it is still a 3 candle sequence. This can be a bearish candle, this can be a bullish candle. That doesn't matter as long as this wick isn't overlapping this first wick right here. Same thing in the other scenario as well. If we have bearish candles and then we have like 1 bullish candle somewhere, there is still going to be a fair value gap, all right? I will also point out a mini fair value gap right here. Look, 1, 2, 3, but this is a bullish candle, right? But there is still a fair value gap between this wick right here and this wick, because this wick does not overlap this wick. We create a little gap that forms right here, right? Boom, fair value gap, right? There are tons of fair value gaps that form, but obviously we need to figure out which ones to use. But going back to talking about these inverse fair value gaps right here, look at how many candles we take to basically invert this gap, right? You can also tell, when I was talking about candlesticks as well, you can also tell based off of volume how likely we are to continue lower, essentially, right? Once we see this sort of hesitancy right here, this is not really a good sign in order to take shorts. When we're looking for inverse fair value gap entries, we want to see a good 1 to 2 candle closure around that area past the fair value gap, the opposing fair value gap, right? So this is a bullish fair value gap, so we would like to see a bearish, like 1 to 2 bearish strong candles that have, major bodies that end up closing past the bullish FVG. That would be a good entry potentially, right? Obviously, we're thinking very, very mechanical in this case, but overall, that is what fair value gaps are. Now, in terms of the time frames, we're only looking at the 15-minute time frame over here, right? Now, if we look at the hourly, it will be the same thing. We have these hourly fair value gaps that form. Boom, 1, 2, 3. And what do we end up doing? Tapping into this hourly fair value gap right here, and then we overall push higher, right? This is a wick that retraces into this area, and then we push back higher, and then we create new highs, right? We can also look at it over here as well. Bearish fair value gap that forms, boom, what do? Retrace into this area. Yes, we have bodies that close within the fair value gap, but look what we do. We don't end up going higher past this, right? We're still overall respecting this, and then we go lower, right? Same thing over here. This fair value gap right here, we have a 1, 2, 3 candle sequence. This wick, boom, fair value gap. What do we end up doing? Bullish fair value gap, we end up respecting it. Again, now pushing us higher, right? Tons of fair value gaps on all time frames. Now I want to overall teach you guys how to use these fair value gaps and what time frame fair value gaps are used for what. I just want to see basically one more example before, there's tons of examples, bro, right? There's an example right here where we have this bearish fair value gap, right, with honestly 2 different candles right here. We have a bullish one, bearish one, bullish one, but at the end of the day, what do we see? Boom, wick over here, gap is created. What do? This is still a bearish fair value gap because again, we're going lower. What do we end up doing? Retracing into this area, and then we go lower, and then we take out this internal liquidity right here, right, before pushing back up higher. Okay, now we have a few examples of fair value gaps in general. How can we, what can we basically take away from this, right? In terms of using them for, your bias, in terms of your direction, conditions, etc. So what I like to talk about, or what I like to use these higher time frame gaps for, the hourly, 4-hour, daily, these are all higher time frame fair value gaps. So we don't find entries off of this. We don't enter positions based off of this usually. We use this as more of a condition base, okay? So going into the day, as we see, we are looking to target some sort of area of interest, right? Let me see other examples that are kind of pre-market so you can kind of understand a little bit better how I use them as conditions. We actually might just end up going back to that first example, honestly, since it's just right there. Should be very easy to explain. As we see right here, we create this bullish gap, right? So for the bias for the day, basically, since we've taken out this high, if we see a candle go past this gap right here and invert it or displace past it, or we have heavy candles that look like this, right? This fair value gap is used as a condition, essentially. If we end up going past this fair value gap completely, we can look to target previous day low. Why is that the case? Because we're showing very clear signs of rejection after taking out this high. All right, we use the higher time frame gaps as conditions. If we displace past it, if we disrespect the fair value gap, what am I looking for? Am I looking for lows to target? Am I looking for highs to target? Based off of either if A, we respect it, or B, we displace past it. As we see right here, we tap into it, we respect it, reject off of it. What can we see now? Oh, look, let's go ahead and target higher. What drawn liquidities do we have to the left? Well, we can look at the higher time frames. What do we see over here? Okay, we have these highs that are forming over here. Cool, let's potentially go and target these highs. Obviously, we did not end up really taking out this high just yet. We created equal highs with it, or relative equal highs, because we failed to take out this high. But overall, what did we end up doing after tapping into the 1 hour fair value gap? We push higher, right? So we use that as overall conditions to basically see where the market wants to go. All right, I want to show you guys some more examples on the higher time frame, just so you guys can overall understand the overall thought process behind using these higher time frame gaps as conditions. All right, as you see right here, what do we end up doing around this area? It's a Sunday right here. So this is before 9:30 market open, right? What do we end up doing? Boom, we tap into this 4 hour gap right here. We respect it, and then we push higher. What do we do at 10 a.m.? We end up resweeping this liquidity point that taps into the 4 hour gap, and then we reject off of it, and then we push higher, right? This overall 4 hour gap is still being respected, so you can use this as some sort of confluence for us to push higher and target internal liquidity that is forming all across here. Right? So yeah, higher time frame gaps will usually be used as basically condition-based areas where, let's say we end up moving past this 4 hour gap. What can we target in the opposing direction? We can target this low instead, right? And if we break past this low as well, we can target this low, right? With all that being said, fair value gaps on a higher time frame are very, very essential to be used as condition-based, more logical based areas of interest, right? Now, this is just the higher time frame. Now we want to look at the lower time frame. You know, we covered the 4 hour, we covered the hourly. It's the same thing as the daily as well. It's really just overall what applies in the current market conditions, right? And just based off of what we actually overall retrace into. In this case right here, we retrace into the daily gap, all right? Another thing to talk about as well is that there are all these different time frames and all these different fair value gaps. How do you know which one to use for your conditions? Let's say there's a 4 hour gap right here in this box that I drew out, okay? If we go to the 4 hour time frame, what do we see? We have multiple 4 hour gaps. Now you may be wondering, which one do I use? Do I use this 4 hour gap or this little tiny 4 hour gap that is presented? Let me actually just zoom in really quick so you guys know exactly what I'm talking about, right? There is this tiny, tiny little 4 hour gap that's presented, right? If you guys can see pretty closely, these wicks do not overlap, so that is a 4 hour gap. Or there is this 4 hour gap right here that's a lot larger, right? You also may be wondering, does the size really matter of the fair value gaps? No, the size doesn't overall matter. And with fair value gaps, what matters is the overall reaction that we get from it and what is the highest time frame fair value gap in the overall leg that we are trading in. So what is the leg that we are trading in right here? We put in this low, we put in this high. Obviously, when we push up all the way like this, we create fair value gaps in the process. But if we have one singular fair value gap in this leg on the highest time frame that is available, we are going to be using that highest time frame fair value gap, okay? And that will be on the daily. So These two little fair value gaps that I marked out with these rectangles, this all compromises, or the daily gap, this daily time frame overall compromises these two little rectangles that I marked out, right? So we can erase this, and then we can overall draw a big rectangle from this candle high to this candle low, therefore forming the daily fair value gap. And as we see right here, this is what price respects into with this new daily candle, and then we push up higher based off of that, right? So when you're using fair value gaps as condition based and more logic based, you want to be looking at the highest time frame fair value gap that forms within a leg, right? And it needs to be singular as well, just for the highest probability chances of, that fair value gap being respected versus getting disrespected, right? Because there will be scenarios where you look at the lower time frames, like the 4-hour, and you look at the hourly, and then you may see some fair value gaps getting disrespected, right? Maybe we might inverse some fair value gaps, but the overall trend is what matters. We can still be bullish and inverse or disrespect some fair value gaps, but we can still go higher in the overall direction. I want to show you guys one example, if I can find it, where the trend is overall bullish, but we still overall go higher, right? This is an example right here. Look at this fair value gap. What do? Oh, look, it looks like we are inverting this fair value gap, right? We're inversing it, we're disrespecting it and going lower, okay? But the overall trend is still bullish, right? Why is it still bullish? Because we have this daily gap right here. This is the highest time frame gap that price wants to overall retrace into and respect, right? We've already put in this low all the way over here. We have a strong bullish candle that closes right here, and overall we tap into this daily gap, respect it, and go higher. This is where narrative comes into play. Higher time frame narrative is super essential. If you focus on specific fair value gaps, that will basically allow you to get better success in the market, right? Higher chances of success. Now, if you're trying to look at all these different fair value gaps on all these different time frames, that just does a lot more harm than good, which is why I'm telling you guys to overall focus on the singular gaps within a leg that is presented to get the higher chances of success, and just remove the clutter from your mind and make things a lot easier to analyze, right? So we need to combine liquidity and basically the reaction points with the fair value gaps that form. What do we see overall on the daily time frame? Okay, we are in a consolidation phase right here, and for those of you guys again who need a reminder on what consolidation is, it is when the market moves sideways. I'll explain it a lot more when I talk about ranges in the next clip, but basically we are going to be consolidating, right? We're going to be moving sideways. So if I draw it out with my path tool right here, this is what the market is doing. It is moving sideways. There is no real clear direction that is picked, right? So if I kind of take this and I draw it over here, as we see, it's a lot more easier to basically analyze that price is moving sideways, all right? With that being said, now we break past this low over here. What do? We now are running this liquidity. We are taking out all of this liquidity. Boom, we have this move lower, and we take out this liquidity to the left over here. Now, if we even go to the ultimate higher time frame, let's say we go to the monthly in this case, this is a pivot point over here as well. What do we see? On the monthly time frame, we have a monthly fair value gap that is presented right here, okay? Look at this reaction. We have this monthly as well. Now you may be asking, oh, why didn't we tap into this monthly fair value gap, and why did we reject off of this one? That is the point that I'm trying to make, right? We do not need to tap into every single fair value gap. The reactions are what matters as well. We tap into this first monthly gap over here. What do we see? An instant reaction on the hourly time frame, or the 4-hour time frame. This is the monthly gap, by the way, for those of you guys who are kind of confused. What do we see? 4-hour, boom, break of structure higher off of this, right? We end up closing past the first swing high and displacing past it over here. Okay, cool. Now we are creating bullish structure, right? Break of structure has formed over here. Boom, we're putting in the high. We get a retrace. There we go. Now we are respecting this bullish 4-hour gap right here, right? Obviously, like I said, we want to be looking at the highest time frame gap. So that 4-hour gap that I was talking about over here is actually the daily gap, right? And this ultimate daily gap right here that I was talking about. This is the singular highest time frame gap that is presented after we made this initial move up, right? On top of that, what do we end up doing? We also see this bearish fair value gap that is presented. We end up closing past it, right? So this is a sign that price wants to overall shift and go higher. All right, with that being said, what do? Again, we respect this and then we push higher, and then now it looks like we want to take out all of this internal liquidity that is forming, right? Internal high, and then we have all of these internal highs on the daily time frame, and then external high over here, right? Now, once we break it down to the lower time frames, of course, it becomes a lot easier to read, right? That is overall conditional based fair value gaps on the higher time frame. Now, when we get to the entries, to the 5 minute, 1 minute, etc., we are obviously trending. We want to overall see a higher time frame trend, and then we want to see an entry on the lower time frame based off of fair value gaps that are forming in order to take a trade, right? An example right here is on Friday. What do we end up doing? Look at this high specifically. This is a point of liquidity, right? Boom. We go out and sweep out this high on the 1 minute time frame, okay? This 1 minute time frame is correlated with other time frames, 5 minute, 15 minute, hourly, 4 hour. All the time frames move the same, essentially, right? The 5 minutes worth of price action right here on the 1 minute consists of one 5 minute candle, right? So if we correlate these time frames, we're able to take our entry specifically on the 1 minute time frame, where over here, we take out the stop loss at this high right here, right? Basically, sellers, they have their stop losses set over here. Boom, we go and take out stop losses, and then now we move lower initially. This is our first move lower. What do we end up creating? 1 minute gaps that form. These two 1 minute gaps. But again, the question you may be asking is, oh, why did we not retrace into this higher gap initially before moving lower? Again, I will say, it is about the reactions that you get out of the fair value gaps that will basically determine whether we want to go back higher into this gap or not, right? Not only in this scenario, but it is the same thing with different scenarios as well, all right? So what do? We retrace into this 1 minute gap. Look at the candle that we get out of it. We get a strong displacing candle, that has a strong body close. There isn't a big wick or anything like that. And that is where potentially you can get an entry, right? We take out liquidity higher. And also, what do we see over here as well? A bunch of consolidation. Again, in the next clip, I will be kind of teaching you guys more in the advanced concepts area on how to trade ranges. So there might be some terms that you guys haven't heard about yet, but I will be explaining it more in the advanced concepts portion. With that being said, you can get an entry like this, for example, all right? Then you want to be putting your stop loss somewhere. I'll also be talking about where to put, protected stop losses and where to have good take profits as well, right? So where do you want to put your stop loss? Again, I drew this out in the liquidity diagram when I was explaining it. This is the high that was put in that swept out this high over here, right? The liquidity point. We took out, what did we take out? We took out stop losses, right? So once we see this initial move, and now we're respecting bearish structure after having that overall shift on the lower time frame. When did we get the shift and break of structure lower? Once we broke past this low right here, right? This is a micro shift in structure because we got this overall displacing area, this displacing close past this low over here, right? This is another sign of bearishness, right? Immediately after taking out this high, we get a very nice reaction, forming lower time frame bearish structure. We retrace into it, and then we get a volume, a very heavy volume candle out of it. There we go. We get a entry over here. Now you can put your stop at the high that ended up sweeping the previous high over here. Why do we want to do that? Because again, with the overall volume that you're seeing with these candles, it does not make sense for price to go and retake this high because this is the high that took out liquidity already, right? We already took out this high. Now, once we see this, we respect bearish structure. Your stop loss is protected at this high right here, okay? Now, what can we be targeting? Again, we are meshing all of these concepts that I just taught you guys together, all right? Liquidity. What did I talk about when I said major drawn liquidities to be targeting? Session highs and session lows. Oh, well, what do we see right here? We have a nice session low that is formed. New York AM session low. That is a very strong drawn liquidity. What do we end up doing? Boom, we end up flushing lower. We take out internal liquidity that is presented as well right here. And then we finally deliver to this low, which is the session low. And actually, this is one of the trades that I took on one of my prop firm accounts where I actually got more of a earlier entry compared to something like this, where I entered off of an inverse fair value gap that was presented, right? Because this was the first sign that basically says, oh, we want to go lower. But again, you cannot be using every single inverse fair value gap to get an entry, right? That overall comes with market experience. It overall comes with you just taking trades and executing over and over and over again and understanding and going through the trial and error of understanding what works and what doesn't work based off of the overall narrative that you are seeing in the markets, all right? But with inverse fair value gaps, we will be talking about it a little bit more in depth once we get into the advanced. So I don't want to talk about inverse fair value gaps right now anyway. I want to keep it more about just fair value gaps and making you guys understand how they work, right? So this is internal liquidity that is taken out, and then now we're targeting external liquidity, right? With that being said, that is how you can use fair value gaps on the lower time frame for more entry-based scenarios, right, where we see rejections off of them. Obviously, you want to be correlating that with the liquidity that we take out in the market, and then boom, you can take entries based off of that, right? So this is a bearish example, and then you also have bullish examples that kind of form later on, but this is what I overall see right now. Same thing over here, right? We go to Thursday. What do we end up seeing? We have this New York AM high over here. Let me just go out and take this drawing out right here. But look at what we have right here, right? We have New York AM high as a nice strong liquidity. What do we end up doing after we put in New York AM low? We are creating a bullish trend. What do we see right here? Price taps into this area. We did not take out New York AM high yet, and then we can get somewhat of an entry. Look at the 5-minute time frame really quick. What do we end up forming? Oh, we form a 5-minute fair value gap, right? Is this the highest time frame gap in this overall leg right here? It probably is. If we look at the 15-minute time frame, is there one singular fair value gap that is formed in this area right here, or this overall leg in general? Let's look at it. Okay, 15-minute time frame. Okay, what do we see? There is no fair value gap in this area, but we do have a fair value gap over here, as we can see, right? Boom, this candle to this candle, fair value gap. But what do we see? Oh, look, we did not end up retracing into that area, right? Again, like I was talking about, we do not need to overall retrace into every single fair value gap, okay? You are basing it off of reactions, off of the FVGs that are presented in the legs, right? Paired with overall strong drawn liquidities. In this case, we have New York AM session high as a strong drawn liquidity. Cool. So we go to the 5-minute time frame, back to the 5-minute time frame. We've established that overall, we retrace into this initial 5-minute gap that is presented. We get a pullback into this area. This is your drawn liquidity that you're targeting. Retrace into the midpoint, go to the 1-minute time frame. Scroll back a little bit so we can actually see really quick. What do we end up doing? Retrace into the 5-minute, we get some sort of displacement out of it. What can you do? Maybe you can put a limit order. What is a limit order? A limit order is essentially where you're asking price to get filled at this area. You just set a limit. You can set a buy limit at this area, and then price, when it retraces into it, you get filled, and then you can have a stop loss at this lower or higher low that is created, right? What can you be targeting? Oh, look, what do we have over here? New York PM session high. That is another strong drawn liquidity, right? So ideally, you want to be getting at least a 1-to-1 risk to reward ratio. And then this is a potential entry that you could be taking, right? Over here. Yeah, so those were, potential entries, right? I'm just marking stuff out so you can see how fair value gaps work. And this is how you can potentially take it as entries, right? Yeah, so that is how bearish, bullish fair value gaps work. I also talk more about how to use them as entries, how to use them as conditions, and using singular fair value gaps and legs, right? So fair value gaps are very, very important in the way that I trade in terms of taking overall trend-based setups. These are also called continuations, where price has already established a trend. We create fair value gaps. Again, we get the pullbacks like I talked about, and then we overall deliver off of that, right? This is a continuation setup where price ends up, moving higher. Boom, we create fair value gaps, respect it once, respect it twice, get your entry, target the liquidity points. All right, you guys, so now we are going to be talking all about SMTs. SMTs are essentially just when one pair takes out a point of liquidity and the other pair does not. So obviously we are only looking at NQ and ES. We're looking at a divergence between the two pairs. So it is literally just a crack in correlation between NQ and ES. One pair is temporarily a little bit more bullish compared to another pair, or one pair is a little bit more bearish compared to another pair, just a tiny bit. So if we look at these examples right here, basically you have a high, you have two highs over here, and you have two lows over here, all right? A bearish SMT forms when we take out highs, a prominent high on one pair, and ES doesn't take out the other pair, or the other way around. NQ doesn't take out a high, and ES takes out a high. So what does that mean? I'm going to mark out both of these drawings that I have. One is NQ, and then one is ES, all right? One is ES, as we can see right here. So we have two prominent highs that are next to each other. We have this high, and then we have this high over here. What does NQ do? We go out and we sweep this high over here, while ES fails to sweep out that same higher point, right? What does that mean? There is a SMT because ES fails to take out this high, NQ takes out this high, and then we move lower off of that, all right? SMTs are very, very important when they are at important areas. So this has to do with swing highs, swing lows, previous day high, previous day low, and all these session highs and lows that I was talking about, right? Those are the best way to use SMTs. There's also SMTs that form within higher time frame fair value gaps or mid time frame fair value gaps, such as within a 15-minute gap, hourly gap, 4-hour gap, 5-minute gap, 1-minute gap. That's what you can use for more of entries within the 1-minute, 5-minute, 15-minute. When they end up forming within fair value gaps, and then you get a reaction out of it, you are able to get entries off of it. Now, one thing to notice and one thing to note is that with SMTs, you do not need a SMT to get into a trade. It is just an extra confluence. You can use it for more logic-based, more condition and logic-based areas of interest. So when you're looking at the hourly, 4-hour, and daily, when you're trying to find a bias for the day, or when you're trying to find some sort of area of potential rejection, if there's SMTs at previous day high, previous day low, etc., you can use that as more of a bearish confluence or more of a bullish confluence. Same thing if there is an SMT at Asia high or Asia low, or London high or London low, or New York AM high, New York PM low, something like that, right? All those session highs and lows, if there are SMTs between the two, you can use that as a confluence as to, okay, whether you want to be more long biased or short biased, all right? So this is the same thing in the bullish case scenario. Bearish case scenario is when we take out highs and fail to take out highs. This can also be swapped as well, where ES, let's say ES goes and takes out a high over here, right? This same high. NQ doesn't go and take out the same high that ES took out. That is now a bearish SMT as well, right? It can be basically flip-flopped around when you're looking at NQ and ES. Same thing with bullish SMTs as well. It doesn't matter what pair takes out the high or the low. All that matters is that one pair takes out the high or the low and the other pair doesn't. That's what forms an SMT. Now you have a bullish SMT, same thing at the low. Let's call this NQ over here. NQ goes out and takes out this low. ES fails to do that, as we see over here. All right, boom, bullish SMT. We get structure based off of that, and then we move higher. Okay, same thing. ES takes out this low over here. NQ doesn't, and that is now a bullish SMT as well, right? Basically, again, like I said, you're just looking at pairs taking out some sort of liquidity points and the other pair that doesn't, all right? Now let's go get into some examples of what SMTs look like. So the first example that I wanna show actually is on Friday. So we actually have to pull up both of these pairs really quick so we can see what the SMT looks at real time, okay? Looks like at real time. So we need to also line it up with time as well. They need to be at the same exact time, the same exact candle. So at 8:29, what do we see? We have this high over here. Look at how the cursors line up. Also, if you see, the other pair, it says 5:29. It's just because I'm on Pacific time. I guess I didn't switch it for ES, but on NQ, I'm on Eastern time, right? So this is still basically just converted 3 hours. So this is still the same high that we're talking about. And look at the line that I drew out. NQ went ahead and took out this high over here. Now, this is not any random high as well. This is the highest point of the overall range that we are basically trading in, right? All the way over here, this is our range. This is the highest point in our range. So that is an important area to form an SMT, right? There will also be, random SMTs that kind of form in with, like random candles, within, let me just spot one here really quick, right? Basically, SMTs that aren't really that important because they're not basically at any key areas. Right here, for example, all right, we have an SMT. Technically speaking, we will have an SMT with ES and NQ. As we see over here, ES actually fails to take out this low. Right here, we create equal lows with ES, and then NQ takes out this low. So this is technically a bullish SMT, but there's no real significance in this SMT because it is not at a swing point. It's not at a swing high, swing low, etc. compared to this SMT over here, right? This is the highest point of the range. Over here, we have an SMT because NQ takes out the high, ES doesn't. And then what do we get off of that? Boom, we get movement lower, right? So this is a crack in correlation between the two pairs, and then we still dump in the same direction, right? We use SMTs as qualifiers, essentially. Let's say both pairs took out this high over here, right? And we still got the same rejection. We would still be taking an entry short if it's still presented, right? This basically just gives us extra confidence that, oh, we put in an SMT at the high, we still have this entry over here, right? Once we reject off of this 1 minute gap over here, and then we execute on the candle closure, now we can be more confident in our stop loss because we have SMT'd the high with ES, right? And we can still go ahead and target our drawn liquidity, all right? Same thing here. On the same day, we also have an example of a bullish SMT as well, okay? So we see this overall consolidation over here. We have two little swing points that are created within this consolidation. We have one swing point that is created over here, and then we have another swing point that is created as well, right? We have a SMT that is essentially formed at this area. So yeah, this was one example on Friday where we had a bearish SMT. Now I want to show you guys another example. Now going into the second example of a bearish SMT over here. So we are on Tuesday's price action of this week. It is the same basic thought process where we have a clear high over here, and then we have another clear high over here at 9:30 open. What do we see price do? We go out and take this high, and NQ fails to do this, or sorry, ES fails to do this, right? So now we have a bearish SMT that is formed after we put in this high, right? And we swept out this high, and ES failed to take out this high. So that is a bearish SMT. Now this is more a little bit of an advanced entry, but basically you're using an SMT paired with the rejection that we're seeing off of this to take an entry basically lower, all right? With that being said, you can potentially get a short entry around this area over here. You can put your stop at this high, and then what else would you potentially be targeting? It would be targeting these lows, but when you are overall trading based off of reactions paired with SMTs and paired with swing highs that we are taking out, you don't always need to wait for candle closure. That's just going to be a little bit more advanced when you basically are able to take these mid-candle entries based off of you having more market experience. But essentially, when you're targeting opposing liquidity, it would be this right here, right? You can target this low, stop at the highs, playing out price action. What do we end up seeing? Price ends up eventually delivering back lower to this low over here, right? Yeah, so that is another example of basically a bearish SMT. We can go and target this low over here. There's also Asia low for us to target as well. That's another drawn liquidity from yesterday, or you can target previous day low all the way over here, right? Very major drawn liquidities that are forming. You can see with market structure over here, we have this hourly gap over here, hourly bearish gap over here that we created, and we actually have a double SMT that's formed, right? That's actually an example right there I just remembered on Tuesday. So going actually into the market on Tuesday, we already have one bearish SMT that is formed that gives us the directional bias, all right? So I showed you guys a little bit more of an entry in the previous example, the very first example that I showed you. And I also showed you another example of you potentially taking an entry off of this example right here as well. But to also find a direction and see where the market overall wants to go on the higher time frame, you can look at SMTs that occur with key points or key areas. For example, previous day high is a key area, right? This is a strong drawn liquidity over here. What do we see? ES takes out previous day high, NQ doesn't. This is still a bearish SMT that is formed, right? This gives us the direction. What is the confirmation? We get an hourly strong candle closure over here, an aggressive move lower after we put in the SMT. What do we have in terms of drawn liquidities? We have this low that's marked out over here. We also have this low, and then we have previous day low as a nice drawn liquidity, right? This is the major drawn liquidity that we want to be targeting. If we also look at the 4-hour time frame, this aligns over here as well, right, with previous day low. Daily time frame, same thing. It is the same exact low because again, it is previous day low. So we got the direction based off of the hourly or based off of the higher time frame SMT that we saw with previous day high. Now we can see if we can get an entry as well. All right. And it just happens to be that we had an SMT at our entry area with this hourly gap that was formed, right? So that just made the trade a whole lot better for us to potentially take. All right. Let's say you didn't enter exactly off of market open, off of this reaction over here. No worries. Again, you can use SMTs as overall directional confirmation and just giving you more confidence that the trade is just going to go in the bearish direction, right? With that being said, we put in this SMT, we go lower, we create bearish structure, and then we get a pullback over here. Cool. You can potentially take an entry over here, knowing that we have an SMT at these highs over here. Again, looking at ES, and it just gives you a lot more confirmation that we do want to go lower, right? So we can potentially go and take out these lows over here. Boom, perfect. Actually, no, it's supposed to be this low all the way over here, but we can go and take out these lows. And then what is the major drawn liquidity lower? Previous day low, right? So you can get an entry like this. You can put your stop at the swing point. Why are you getting an entry over here? Because this is your inverse fair value gap entry, or actually just displacement off of the area of interest. But this is a little fair value gap that's formed, right? So if you want to get a little bit more technical with it, we have a bullish fair value gap that is formed, and then we get a strong bearish closure off of that. If you look at the 5-minute time frame or the 15-minute time frame as well, right, we see that we have a strong bearish candle close after we put in this SMT at these highs over here, right? This bearish SMT. Okay, look at the 1-minute time frame. You see this correlation. We see a little bit of a pullback, and then you get a displacement candle over here. Strong volume candle right here. You can take your entry, stop at the highs, targeting previous day low, right? That is just an example of another potential entry. This actually ends up retracing once again, and then we overall end up delivering, right? This takes a while to deliver, but again, we still end up delivering to previous day low, right? And there's also another potential entry that forms once we actually retrace into an area of interest, which is in this case, this 15-minute gap that overall forms, right? Boom, we form this 15-minute gap over here, and then we get some sort of rejection out of it, and then we can potentially take a trade to previous day low off of this rejection that occurs. Yeah, so that is an example of more of a directional SMT that occurs on the higher time frame with previous day high, which is a major key liquidity point. And then we get into New York AM session open. We have another SMT that forms over here within these highs that form another bearish SMT. And then this is more in terms of you finding an entry after we make the move lower, right? So those are two examples of bearish SMTs. I do want to show you guys a bullish SMT. Honestly, you just have to apply it the same way. You know, with the bearish SMT, you apply it the same way with the bullish SMT. If we take out lows and the other pair doesn't take out that low, then you get a rejection off of it. You're able to overall understand, okay, is this a bullish SMT versus a bearish SMT? If we're taking out lows versus taking out highs, you're going to be able to tell. Yeah, but with that being said, that is the overall gist with SMTs in general, right? Very, very simple. You don't need to overcomplicate it. Once again, you're looking at prominent highs and prominent lows to get taken out. You can look at it as more directional, or you can look at it as more entry based as well. Just depends on what time frame you're looking at and overall what the direction is, right? Are we bearish? Are we bullish? Do we have SMTs that correlate with that area or not? All right. With that being said, that is SMTs. As we see it on our screen right now, we have two things in front of us. We are going to be talking more about range-based structure versus trending structure. I want to focus a little bit more and tie this back to market structure as well. Not only we're going to be talking about this, but we're also going to be talking about premium versus discount of ranges. We're going to be talking about equilibrium and why it's super important. And we're also going to be using the Fibonacci tool as well to basically mark out equilibrium of these ranges, okay? We're going to be dabbling a little bit more into the advanced side of concepts as well with this video, with this clip over here. Let's get right into it, okay? This is very, very important stuff to talk about, so make sure you guys pay very close attention, all right? Rewatch it a couple of times if you don't understand, but I am going to be explaining it as thoroughly as possible, all right? So I think I touched up on this a little bit, talking about range-based structure when we talk about consolidation, right? When we're ranging, that is the equivalent of consolidation / accumulation, prices moving sideways. Now, you may have seen, if this is your first video that you've watched, basically a lot of people, they say, oh, you can't trade within consolidation, you can't trade within range-based markets, it's best to stay out of it. All right, for beginners, I would agree, right? It is best to stay out of it, but that doesn't mean you cannot trade these conditions at all whatsoever. And for the people that have watched, previous videos on YouTube, and maybe this isn't your first introductory video, people will say, oh, accumulation is bad. All right, I want to overall change the stigma around it. You can trade within ranges, but the thing is, you cannot be greedy, right? You can't target past your, you can't have more of external based liquidity TPs rather than, more internal based take profits, right? Where you're take profiting at an internal low or an internal high over here, or, the range low or the range high. You need to keep your TPs and your stop losses within the range, right? Otherwise, you will get swept out, as we see right here. Price sweeps out a high, sweeps out a low, and then we get an automatic rejection, right? Because we are overall moving sideways. So it is harder to predict when price is overall going to break out of that range. So this is range-based structure, and then this is trending structure. Obviously, we have a bullish structure over here, and we have bearish structure as well. Now, when we're marking out premium and discount, it can be marked out with both in a range-based market and in a trending-based market as well. So it is very, very easy to use this Fibonacci tool right here. So if we go to this drop down and then we click Fib retracement, we mark this out right here. This is what we see, all right? I'm gonna mark it out first in a range, and I'm gonna show you guys what premium is versus discount, all right? So premium, you mark it out from the lowest point of the range, which would be right here, to the highest point of the range. So the lowest point is right here, and then the highest point is over here. So this is now your overall range, okay? This blue line right here, basically what it is the optimal trade entry. It is just overall based off of math. This is a reactive spot where price can go ahead and tap into this. It's called optimal trade entry, OTE, of the range. That is what people refer to this as. All right, it is just based off of math sequences, Fibonacci sequences, as you see right here. There's all of these different numbers. The only things that I use is 0, 1, which would be the bottom and the top, and then we have 0.5, and then we have 0.786. All right, main thing that we only really need to focus on, at least for this example right here, is just 0.5. All right, what is premium and what is discount? So premium of a range would be anything above the 0.5 area. So as you guys can see, if I draw out with a box or with just a measuring tool right here, all of this is premium, okay? From this area up is premium. Now discount is anything that is below. All of this right here is discount, okay, of a range. Now, how do we actually use it in our trading? All right, so this is equilibrium, by the way, if you guys haven't already picked up. This is equilibrium. 0.5 is 50% of the range. Whenever you are trying to short within a range, you want to be executing more in the premium of a range. Why is that? Because once you get lower and lower and lower into discount, or when you get lower into equilibrium as well, price is very unpredictable, right? Because you could get swept out because you have tighter stop losses when you're trying to execute more into a discount of a range, because price will basically just wick you out, right? It's moving sideways, it's very choppy, all right? There aren't really cleaner moves. So to protect yourself from getting stopped out abruptly within a discount of a range when you're trying to short, people will short within a premium, right? That is your optimal entry. Why? Because you have a protected stop loss. Once we take out highs, previous highs, as we see right here, we took out this previous high over here, and then we also took out this previous high as well, right? So that is very, very important to basically understand, because you're pairing this with reactions, you're understanding, okay, I'm executing within the premium of the range, and I will be targeting the opposite side, right? Same thing if we're going for longs as well. You want to be executing more in the discount of a range when you're targeting opposing liquidity, right? So let's say we go and take out this low over here, boom, let me just remove all of these drawings really quick. We go out and we take out these lows to the left right here. Let's say we get a sharp reaction out of it, all right? Since we understand price is just overall going to be bouncing up and down and we're going to be consolidating, once we get a sharp reaction out of this area, you can potentially get an entry back up to these internal structure and external structure highs, right? Again, just a refresher, what would be internal in this case right here? This internal high would be a drawn liquidity, and then obviously we have this external high as your take profit, right? So we could go ahead, enter a position somewhere over here. Once we get a reaction, right? We need to prioritize reactions from lows and from highs, because again, if we're targeting the opposing side of the range, we either want to be in premium or discount if we're shorting or if we're longing, and B, we need to have a protected stop loss at real structure, right? So let's say you execute off of this first reaction, and then you will get your stop loss at the lows, TP at the highs over here. All right, yeah, so this is more about trading within a range-based market, and this is premium versus discount, and this is equilibrium. And yeah, now when we go to the trending markets, when we talk more about the trending markets, you can still do the same thing with the Fibonacci tool. All right, so I'm going to remove this over here, and I'm going to take out my Fib tool and mark it from the lowest point to the highest point. All right, now whenever you're taking out your Fibonacci tool, especially more in a trending market, when you're marking it out to the low to the high, you overall want to be marking it whenever you see a retrace that comes in, right? So let's say this is the highest point, and then you see prices starting to retrace a little bit over here. Then you take out your Fibonacci tool, mark it from the low to the high, because now you're identifying the retrace, price is going lower, and then you can see where the equilibrium of a range will be. What does price like to do around equilibrium as well? This also goes with the range-based market. We like to reject off of it, all right? We can potentially react off of it and create and respect the bullish trend and go higher if there is an overall reason for price to go higher, right? Again, relating it back to drawn liquidity and liquidity in general. If there is liquidity that is resting higher, price still wants to be bullish, we will get a retracement into the 0.50 or the 0.5 area of the Fibonacci tool of the range, and then we will reject sharply off of it, and then you can potentially get entries off of that as well, back to external structure, right? So that sometimes happens as well. Same thing with the bearish trend as well. Again, when we get that retrace back up after we put in the lowest point, then you can look to potentially see price retrace into the 50% mark of the range, and then we go lower back again, right? This is just an overall pullback. Boom, looks like we want to create a bullish trend over here. No, boom. We end up rejecting off the 50% mark, and then we take out external structure, right? So this is more of a trending market. Again, you can use the Fib tool for bullish case scenarios, bearish case scenarios, and also range-based conditions, right? Same thing applies with premium and discount, even in a trending market as well. If you're able to snag an entry more around the discount, let's say we get more of a deeper retrace over here, if you're able to snag an entry somewhere over here, that is ideal. Now, you can be a little bit more loose when it comes to getting your entries in a trending market, because technically executing in premium and more of a trending market isn't going to hurt you as much compared to a range-based market, right? Because over here, price is moving sideways. You can't really expect price to do what you want. It's pretty unpredictable because we can get some sort of internal manipulation, or basically where price goes and takes you out before the move actually occurs. Compared to here, where you've already established a trend, you can kind of assume and expect that even if we go more into premium of a range over here or of the trending market, we're still going to continue higher, right? Because we are respecting structure. We are creating lows, highs, higher lows, higher highs, higher lows, higher highs, right? Just because we get a little dip over here isn't really going to change much, because we get a quick reaction, and then again, look at what we do. We respect this low over here that's got put in. We don't break past these lows, and it doesn't look like we want to go and take out this low, and then we create a higher low over here. As soon as you see this, oh, I could potentially take an entry somewhere over here, and it doesn't really matter that I'm executing more into a premium of a range, because there is structure for us to follow, right? There is clear market structure, and it is a lot more predictable to trade, right? Same thing when it comes to a bearish case scenario. You can execute more into a discount of the range over here, just getting a simple continuation, because again, what do you understand? Even though we retrace into the 0.50 mark of the area and then we get a rejection out of it, It's not like we went and, you know, continued to go and break past these highs to take out external liquidity in the opposing side. With that being said, you could potentially get an entry over here, stop at the highs that tapped into the 0.5 mark of the overall bearish trend. And again, we're still creating lower highs and lower lows, and then you're expecting external liquidity to get taken out, right? With that being said, these are just diagram examples, but now we want to go ahead and look at real-time chart examples. First thing that I want to look at is Friday over here, right? So this is Friday's price action. 9:30 ends up opening around right here, okay? So pay attention, pay very, very close attention to this because this is important, okay? So this overall is describing more of a range, all right? But we need to figure out what is our range low versus our range high, okay? 9:30 open is right here, smack dab at this candle. This is where 9:30 ends up opening. What do we end up doing? Boom, we go higher. It looks like we want to go out and take out these highs, but we don't, all right? In terms of entries, there really isn't anything that's significant for us to potentially take, all right? At least from a beginner perspective. Now, we see prices consolidating a little bit. It is ranging. Again, we haven't really created a very nice swing low point, right, where price is overall reacting from yet. Over here, you don't see any of that. If we actually go into replay mode and just play through price action from 9:30, so you guys can see it more visually. Okay, looks like we have liquidity over here. We have some sort of external liquidity over here. Cool. We see prices shooting up, but again, in terms of an entry, we don't really get anything that's significant, right? And in terms of strong drawn liquidities as well, we don't have session lows for us to target that's nearby. The only session lows that we have is London low, and that's already pretty far away, right? So you also want to be careful when you are comparing and trying to correlate price action that you're seeing right now, the volatility, the volume that you're seeing from market open to the drawn liquidities that you're targeting. So from this area, we are around a good 100 points away. Price isn't really moving. It's not breaking any sort of structure to basically confirm that we want to go lower to London low, which is why we have to wait for more confirmation. And we actually have to wait for the range to form, right? Where is the range going to form after 9:30 opens? When we get some sort of swing low that's put in, a low point of a range, and then we get that instant reaction out of it, potentially creating the high, and then that's when we can take our Fibonacci tool, right? So we keep playing out price action over here. Boom, what do we see? A bunch of consolidation, right? Now we are starting to range. But again, this is more of a tight range. So in terms of taking trades within this area, there is nothing really significant, right? We want the range to be a little bit wider. What ends up happening over here, this is what happens, right? Now we are forming that range. What do? Boom, we go lower, we break past these lows a little bit, and then we get an instant reaction out of this right here. This high takes out this previous high over here, and then now, right, now it looks like we want to do something. So with that being said, we keep playing out price action more and more and more. Once we take out this high over here, if we get a reaction out of taking this high, we can potentially find a trade to the opposing side of the range, right? What happens here over here? We take out this high, now we can take out our tool, mark it from the New York AM low to the New York AM high, which is over here. Well, technically it is over here, but this is the high of day after we swept it out. What do we see? If we go to the 5-minute time frame as well, look at what we see, right? A bunch of consolidation, right? We don't exactly know where price wants to go. Looking at the 15-minute time frame as well, we see price is just choppy. It is moving sideways, all right? So with that being said, this is still tradable conditions just due to the fact that price is overall rejecting from this high. Okay, this is the highest point of the range that we created. Over here, 830, boom, and then we have this low that is created, boom. This is the overall range, initial range right here, okay? I'll mark it out once again so you guys can see. Boom, from this high to this low over here, this is our range, our dealing range, our trading range that we are in. Once we see price go up and sweep this high, there is no liquidity on the left for us to go and take, right? Again, we are bouncing off of taking lows over here. We're bouncing off of taking highs over here. Boom, we get retracements. We can expect the same once we go and take out this high. We're expecting price to overall revert and go lower, okay? So This is now the high of day right here at this high. With that being said, where can we potentially get an entry? It'll be in the premium of this range, right, of this consolidation that we're seeing. All right, when do we end up breaking structure? When do we get displacement? Look at these candles right here. Boom, we're going lower. We're breaking past this low as well. It looks like we finally want to go lower, okay? What do we also get over here? We get a little bit of an entry, which is our inverse fair value gap that I was talking about, where we disrespect this little fair value gap and then we get a good displacement candle below. All right, there's also some external factors between this trade as well, which SMT. Now, in terms of you potentially catching a trade, more in terms of a premium versus a discount, not even talking about specifically about entries, but just in terms of price action and structure in general. When you see these candles close over here strongly below these lows, or even playing another candle over here where we respect bearish structure, right, which is this bearish fair value gap that is created, you can potentially find an opportunity to take a trade over here. You would put your stop at the high that swept this high over here and work in your TPB at New York AM low, right? You're not targeting any other low. You're not targeting London lows over here, anything else, any of these lows over here as well. You are just targeting the range low, right? Because you don't know what price is going to do after we take out this low. We can take it out and then reject back higher into this range. Again, you do not want to be targeting anything else past either range highs or range lows. With that being said, we play out price action and then obviously price ends up delivering. Again, your job isn't to predict what price is going to do past this range, right? You are just trying to take your profit at the most secured area. In this case, it is New York AM low. What ends up happening, we end up retracing back into the range as well. I think we go lower this day, but again, you are not trying to predict that. You are just overall catching your piece of the pie, right? So you were able to potentially catch a 1 to 2.3 risk to reward trade just by these concepts that I was talking about, right? We have bearish fair value gaps that are being respected over here. Again, you're only using fair value gaps, liquidity sweeps, and premium and discount to catch a trade like this. I didn't even get more into depth about how you can combine different concepts and get a lot more confirmation and get a little bit of earlier entries as well. I didn't even talk about that yet, and you were still potentially able to take trades like this, right? With that being said, that is one of those examples where we are trading within a range-based market. Now, let's say if I look at another example and then we see more of a trending market, this would be right here as well, okay? What do we end up seeing? We have New York AM high as a drawn liquidity over here, okay? Price is going lower, and then it looks like we want to go back higher and take out this high, right? It looks like we're overall in bullish structure. Once we put in this low, we put in this high, put in this low, put in this high, put in this low, and then finally we take out this high over here. Now, how can you use your Fibonacci tool in order to mark out where price wants to overall go, okay? Or where can we retrace into? We want to mark it out at swing points, all right? So let's say you're trying to find an entry somewhere over here, right? Back up to these highs. What do we end up seeing? We put in a swing low over here, all right? Now we put in a swing high, and then we see prices now starting to retrace. This is where you can take out your Fibonacci tool. This is already bullish structure, by the way. You mark it out from the low to the high over here, and look at what we do, right? We respect equilibrium, the 0.5 point of this range right here, right? From the low to the high that was put in before we got a retracement, right? So we go down, we tap into the 0.5 area. What do? We respect it, and then we push back up, and then we take out external liquidity over here, right? Now you may be asking, oh, well, what about from this high to this low? Why didn't you mark out equilibrium from this high to this low? Well, that is a good question. You have to overall correlate it with your bias for the day, right? Your bias, the overall direction that you want to see the market go. If you're bullish in this case, you're not going to mark out an equilibrium tool or the Fibonacci tool from the high to the low, because in this case, you would be expecting the 0.5 area to get respected for us to go lower and take out this low. But we don't want that to happen. Why? Because we are bullish on the day, right? Looking at the 15-minute time frame, looking at the 15-minute time frame, or 5-minute, 15-minute time frame, whatever you want to look at, essentially, We are consolidating, yes, on the overall 15-minute time frame, but again, we have drawn liquidities higher, which is New York AM high, and then we have these New York PM high equal highs as well, which is another strong drawn liquidity, right? We look like we are shifting structure. Why? Because we put in this low, we put in this low, we put in this low, and we put in this low as well. Look at what we're doing. Even though we are moving sideways, we are not breaking past these lows over here. We are creating higher lows, higher lows, higher lows, right? And then we get displacement out of that. We see prices moving up off of that. So naturally, we want to be targeting higher prices, which is what we have in terms of New York AM high. So when we're drawing out our Fibonacci tool, there is no point in trying to look for more of a bearish rejection from this low to this high, because we're not looking for shorts, right? So we're looking for bullish entries, and when we see bullish structure that is also forming on the lower time frame, that is exactly where we can actually see if price is going to rebalance into the 0.5 mark of the range or not. All right. With that being said, those are two examples.
So now, since we have that established, let's go ahead and establish the continuation framework, okay? Number one, we want to be identifying our trend. This is not only on the higher time frame, but on the lower time frame as well, okay? We need to be focusing on time frame alignment. Now, what is time frame alignment specifically? So we start off with the daily time frame, okay? The daily corresponds with the 4 hour. The 4 hour corresponds with the hourly. It corresponds with the 15-minute and the 5-minute and the 1-minute time frame. Now, what does this specifically mean? For every 4 hour candle close, we get a hourly close as well. We also get a 15-minute candle close and a 5-minute candle close and a 1-minute candle closure as well. Now, it is important that we focus on these time frames, because when these new 4 hour candles open, or when these new hourly candles open, 15-minute candles open, 5-minute or 1-minute candles open, that overall aligns with us potentially taking an entry, right? This is aligned with the higher time frame, and this is also aligned with the lower time frame as well, where eventually we are looking to take a trade off of the 1-minute time frame that correlates with all these other time frames that I mentioned before, right? Now, number two, we want to be identifying our draw on liquidity, right? This is very, very important. Okay, our drawn liquidities we've already established. We have swing highs and lows, session highs and lows, and unfilled higher time frame for value gaps. Okay, now we wait for our pullback. So pullback is very, very important in order for us to take a trade. It can again be in the distribution phase of the leg, where we pull back into these fair value gaps in order for us to take a trade. I'll also get a little bit more advanced and show you guys examples of trades that we don't necessarily need to pull back into either a higher time frame for a value gap or even a lower time frame for a value gap, and we're just solely trading based off of structure. Okay, that gets a little bit more complicated, but don't worry, we will overall cover that. All right, now step 4, obviously we just want to be entering, and then step 5, we want to be managing risk. How are we going to properly manage risk? We are going to be putting it at protected structure, okay? Structural highs or structural lows. Now, what does that look like? All right, these structural highs and lows are part of the overall pullback, right? So this is the pullback right here, where we've pulled back into the gap, and then we have a structural high over here. So if you get an entry somewhere over here, your stop loss wants to be at this structural high, right? Same thing if you get an entry somewhere over here. Let's say you have drawn liquidities lower, you want your stop loss to be at a structural high, which is over here. This is the point of invalidation, right? Now it's the same thing with a bullish continuation. If we look over here, it can be a little bit more clearer compared to the bearish continuation example that we have there, right? So we have a very prominent pullback right here. We put in a swing low. This is where our stop losses is going to be, because it is at a structural low. It is at a pivot point, right? So once we see that move back higher, we can assume that price doesn't want to go back lower and sweep this low, because this is parts of the higher low that we've created, right? And we're looking at this higher low to sponsor this higher high. And we've seen a history of price doing that before, right? We put in higher lows, higher highs, higher lows, and then higher highs, higher lows, and higher highs. Every time you put in a higher low in a bullish continuation, we have never went back and reverted to it and swept out the low, right? The structural point. So we're expecting price to do the same thing here as well, right? So now that we've established all of these things, we've managed risk, right? We've identified the overall trend. We've identified the drawn liquidity, waited for the pullback, and we got our entry over here. And then we managed our risk by putting our stops at these internal or at these structural lows and these structural highs. So for today's video, we're going to be going over the strategy that has gotten me from 0 to 50K in a month trading with one prop firm. And that one prop firm is Top Step. All right. So even before getting into the charts, we're going to go over my type of trading. So I trade a continuation strategy, a continuation model, where I'm catching like the last leg to my drawn liquidity that I pick out. So what does this consist of? Let's first start with my targets, okay? I target swing highs and lows, session highs and lows, unfilled high time frame fair value gaps. These are the three things that I target. All right, and let's actually just draw out how it looks like, okay? The main thing is drawn liquidity, okay? I prioritize drawn liquidity, prioritize DOL, okay? Without drawn liquidity, my strategy is literally nothing. So there's two types of ways that I trade a continuation. One of them is where I'm catching the last leg to my drawn liquidity, right? Right here, we have this high right here. So let this high be my drawn liquidity. All right, and then we have now an uptrend, okay? So what I'm actually catching is the last leg to this drawn liquidity, right? So this is my DOL right here, and this can be a swing high, a session high or low, or an unfilled high time frame fair value gap. Now I'll show you guys some in-chart examples, but I want you guys to actually kind of visualize this first before I actually hop on the charts and show you guys. So right here, right? Let's go over my entry points actually before that. Let's go over my entry points really quick. Entries. So 1, inverse fair value gaps. 2, reaction off fair value gaps, right? So this can be the main fair value gaps that I look for is on like the mid time frame or the lower time frame. So it can be anywhere between the 1 minute time frame to the 15-minute time frame. So I'm looking for a reaction off of any of these fair value gaps within this time frame. And basically the way I trade is discretionary. So I'm not going to specifically look at one time frame and like let's say the 5-minute, for example. I'm not going to specifically look at the 5-minute time frame and see if there are 5-minute fair value gaps and see price wanting to retrace into a 5-minute fair value gap, and then we have to get a inverse fair value gap, right? It doesn't always need to be an inverse fair value gap. So I play it by sight, basically. I know that's a little weird to say, but one thing that you can't teach, that nobody will teach, is market experience, right? Because you literally cannot teach that. It is the amount of time that you spend watching the charts. So when people say market intuition, or if you've ever heard that, yes, that is a real thing. But obviously, market intuition doesn't mean anything if you don't have some criteria built over it. And that is the beauty of discretionary trading, where you're able to tell what works and what doesn't work, and you're not really sticking to one like set model. Third entry would be, well, I don't even know if it's like actually a third entry because this kind of goes with the reaction off the fair value gaps, but it's displacement, right? So after I get a reaction off of a fair value gap in any of these time frames, I'm looking for a displacing candle off of the reaction that, validates this reaction, right? So I need a displacing candle close, and that will be one of my entries if there is no inverse fair value gap present. Let's look at it in this example that I drew up right here, right? So we have this fair value gap right here. Let's say this is a bearish fair value gap. We see price invert it, right? Price inverts this, and I'll take my entry off of the inverse, and then my stop will be at the low of the fair value gap that it reacted off, right? So we'll have, let's say, a higher time frame fair value gap right here. So, well, not like a higher time frame like 1 hour or 4 hour. I'm talking like a 5-minute fair value gap, right? So let's say this is just a 5-minute fair value gap. It's a bullish fair value gap, and price rejects off of it. And then we drop down to, let's say, the 1 minute, right? The 1 minute time frame. So this is a 1 minute fair value gap, right? And then that becomes an 1 minute inverse fair value gap right here. So we react off of the 5-minute fair value gap, and then we drop down to the 1 minute time frame to see if there's any fair value gaps in this leg down that has retraced into the 5-minute fair value gap. I look for the highest time frame fair value gap in this leg down to get inverse. So it needs to be a singular fair value gap in the leg, right, in the leg down, and it needs to have a nice clean displacing close. Or if there is no fair value gaps created on the leg down, I just need a nice reaction off of the 5-minute fair value gap on the 1-minute time frame, or the 2-minute time frame, or the 3-minute time frame. I just need a nice displacing candle that shows that we're going to go higher to this drawn liquidity. So this is my entry right here. I put my stop at the low right here, and yeah, that's basically it. And then I go break even at the internal high right here. So break even at the internal high. And yeah, that's basically what it looks like for a bullish case scenario. Now, for a bearish case scenario, it's literally the same thing, but inverted. So you have your drawn liquidity, which is that first point right here. And then you're going to be now in a downtrend, right? Boom, boom. So my drawn liquidity is right here, DOL. And then where is my entry? Okay, well, we have a fair value gap right here, a lower time frame fair value gap right here, right? And then let's do something like this. Let's do something like this actually, because this will be our internal low that we go break even at, right? So we have this fair value gap right here that gets inverted with displacement, and boom, entry right here, stop right here at the point where price rejects off of on like a 5-minute time frame, 15-minute time frame. Let's say this is a 15-minute fair value gap right here. All right, 15-minute fair value gap, boom, right here. So price is rejecting off the 15-minute fair value gap, and then you drop down to the 1 minute again, let's say for example, and then you get a 1-minute inverse fair value gap right here. Boom, take your entry, and then drawn liquidity. What is this drawn liquidity? Okay, session lows, session highs. So this can be London lows, this can be Asia lows, this can be a random swing high, a random swing low, or this can be some sort of unfilled high time frame fair value gap on the hourly time frame or the 4-hour time frame. So this is a bearish case scenario, and this is a bullish case scenario, right? I'm looking for displacement, or I'm looking for an inverse fair value gap, one of those things. Now, this is my break-even point right here, because this is an internal low. Now, this is one of the things that I trade. Now, there's also another way that I trade, which is a little bit more rare, but you can think of it kind of as support and resistance almost, I guess you could say. It kind of looks a little bit similar, but I'll show you guys one example of that after I erase all of this stuff. Now, for this term of trading style, or this style of trading, basically you'll have, still a high time frame drawn liquidity, which is this point right here. But the thing is, price is going to be ranging, right? We're going to be ranging a little bit. We're going to be in consolidation, and price doesn't really know what to pick, okay? And what we're looking for is a breakout. We're looking for a breakout of this consolidation right here, and then a retest, I guess you could say, to the drawn liquidity, okay? So this is the drawn liquidity right here, and then we're looking for a retest to the drawn liquidity, which is right here, to take to your target. So what are we identifying? Okay, we're identifying a range high, and then we're identifying a range low, right, in this consolidation. So right here is our range high, and then right here is our range low. All three of those drawings can be applied to literally any time frame, right? You can trade a continuation model on a higher time frame, on a lower time frame. You can trade this on a lower time frame. You can trade this on a higher time frame. It doesn't really matter, because all time frames are fractal, right? So all of this can be applied on any single time frame. It doesn't really matter. But what matters the most is your drawn liquidity. Now, we see price has broken out of this range high with a nice displacing candle right here. So price breaks out of the range right here. We get a nice displacing close above this range high. And then now we're looking for a retest, which is just a retracement back into this zone right here. It doesn't need to be in the zone, but usually when you get a displacing candle that breaks out of the range high, you get a fair value gap that's created. So instead of looking for a retest back into this zone, my entry would actually be on the fair value gap that's created. So we'll draw a fair value gap, right? Actually, let's draw a fair value gap a little bit lower, like right here, okay? So we have our fair value gap right here. And what I like to do is I actually just set limit orders on this. So I'll set a limit order on the top of the fair value gap, and then my stop will be at the bottom right here. And then boom, I'm targeting the drawn liquidity. Let me draw this a little bit higher. All right, boom. That's my target. My stop is right below the candle that broke out of this range high. And then this is my drawn liquidity. Let me move all of this stuff up right here. Boom, there we go. All right, so we get a breakout of the range high, retest, entry, limit order at this high time frame, or not high time frame, at this fair value gap right here. And then we target our drawn liquidity, which is again, swing high, swing low, session high, session low, unfilled high time frame fair value gap. Now for a bearish case scenario, it's literally flipped once again, right? So let me erase this really quick and show you guys what I'm talking about. All right, so this is my drawn liquidity again, this point right here, consolidation, consolidation, consolidation. This is my breakout point, and then retest, and then boom. Take that last leg to your drawn liquidity right here. This is your drawn liquidity, and then this will be your range high, this will be your range low, right? So range high right here, and then range low right here, all right? So once again, I'm looking for a nice displacing close below the range low, right? And then I look for a retest into a fair value gap that is created off of this displacing candle, right? Or candles. And then I set a limit order on the fair value gap that was created. So literally the exact opposite of the bullish case scenario, where instead I'm targeting lower, and then my stop is right above the candle, the displacing candle, right? So I guess this is the displacing candle, right? So that's basically the two models that I trade. I guess you could say models, whatever. There's still a continuation either way. It's just different ways to look at it, right? You have a consolidation type situation, and then you just have a trend type situation, right? So now let's get into examples of this. Let's go into replay mode for this one. So this one is a little bit unique because we are at all-time highs in this situation. So I just want to tell you guys, when you're in all-time highs, you really just want to this long, right? Because you don't know how long or how far all-time highs can go. But let me just break this down to you really quick, right? So as you can see, we're clearly bullish, right? We're identifying a trend. What is the trend? We're clearly bullish, right? We have all-time highs right here. This is all-time highs. We're respecting off of a 4-hour gap right here, and we're just gonna go higher, right? It's pretty self-explanatory. I don't need to explain much. I talk about this in my trade recaps as well. I go over all of my trades, so you can also go back to my trade recaps and learn from there. But let's go now into market open. So we displace higher right here. We consolidate a little bit, and then boom, we have a retracement. Go to the 5-minute. Okay, cool. We have a 5-minute fair value gap right here. Well, look at this rejection. Wow, what a nice rejection that we get out of the 5-minute time frame. Okay, now we need some sort of validation candle to get our entry. So let's see if we get that validation candle or that displacement candle or that inverse fair value gap. So right here we see we have one fair value gap right here, another fair value gap right here, and a potential other fair value gap that's created in this 1-minute time frame. Now, looking at this, we can probably go up a time frame and see that, oh, look, there is one singular fair value gap that's created in this move down right here. Boom. We are looking for this fair value gap to get inverse pretty nicely to take an entry higher. So let's see if we get that. Okay, we see a reaction now. Okay, a displacing candle, but we need to look for some confirmation still. Look at the 2-minute time frame. Okay, we see that we're wicking right now, and this candle actually doesn't even close above it, but it would have, right? It would have closed, but it didn't close. So we were close to closing above it, but we didn't, and we closed within this 2-minute fair value gap. Now, the old me would wait for another close for this 2-minute fair value gap, but I'll show you guys what I took instead. I went over this in my trade recap as well. So we get a rejection right here, boom, rejection. And then we see right here, we have this 1-minute fair value gap right here that opens up. Okay, let me remove this real quick. It's kind of confusing. So we have this 1-minute fair value gap that opens up, and basically this should hold if we're still bullish, right? Because on the 5-minute, we are in this 5-minute fair value gap. We rejected off of it, and we should see all bullish fair value gaps hold if we want to continue higher. So we get a nice reaction, a very nice reaction off of this fair value gap. And instead of waiting for that 2-minute candle to close above this fair value gap, I use my discretion, right? Because of my market experience throughout the last almost 2 years, where I know that if this holds, I'm willing to take a long to the next high, which is right here, or in this case, I actually held a little bit longer to 23K. That's because of psychological levels. That's something else. But we get a reaction right here. And then my entry was in real time was right here after that candle close. And then my stop is at the bodies, or it can be at the swing low. That doesn't really matter. But when the wicks are usually long, I usually put them at the bodies, because if we go all the way here, my trade idea is basically invalidated, since we're going to inverse this bullish fair value gap. And if there's displacement lower, then even if I put it at this low, we're probably going to go and take out this low anyway, right? So I might as well put it at the body to risk less. But I don't put it at the body every single time, right? There's different scenarios. So that's my entry right here. And then boom, TP hits, right? My break even point is at this internal high right here, break even, boom. And then I'm targeting that psychological level of 23,000. Okay. This is a little bit unique because in all-time highs, there isn't really like a specific target, because, you know, you are literally targeting thin air, and this is thin air. But there's ways to trade all-time highs, and this is one way to trade all-time high, which is literally just longing everything and targeting a little bit above the structured high that is presented, right? Now, let's go into the next trade that I took really quick. Actually, I don't even need to remove all that. Let's just go to the next trade. 15-minute time frame. Let's go to 9:35, okay? All right, so on this day, Powell was speaking, so price was a little bit choppy right here. But we're looking for a little bit of a breakout, right? Where will we get a breakout? Okay, we have a breakout right here out of this range. We get a nice close above, you know, this high right here. And actually, it was like a false breakout, right? We literally had two breakouts, because technically, starting from 9:30 right here, we have this low right here, and then this is your range low, this is your range high, boom. We break lower, but we don't see a follow through, right? There is no follow through. So we're not going to take anything lower. And over here, there is no follow through either. So there's nothing to take. We just end up chopping, right? Swing high, swing low, chop. Or range high, range low, chop. Okay? But let's go to the higher time frames and see what we have. So on the 5-minute, all right, cool. We see that we are rejecting off of this 5-minute gap right here. Now we're looking for our drawn liquidities. Okay, let's go to the hourly time frame. Cool. We have London high that's marked out right here, which is within this fair value gap right here, and it is a swing high. That's perfect. That looks like a good target. But we need to see some confirmation. So what is that confirmation? Okay, right here. We're in this 5-minute fair value gap, so we have to see if this 5-minute rejects. Does it reject? Yes, we have this nice displacing candle off of a retest of this 5-minute fair value gap. So my stop is at this swing low, or the low that tapped into the 5-minute fair value gap, and then I'm targeting London highs, and then my break-even point is at these equal highs, or this internal high right here. So this is where I go break even. And this trade doesn't end up playing out because we actually formed a SMT with ES, where ES took out this London high and NQ didn't, which is why we rejected, and I ended up getting break even on this trade. Now, it happens, right? You're not going to win every trade, and this is just an example of a trade that I took that ended up getting break even, but it was still a good setup, right? And it fit my model. Let's go into another trade that I took really quick. So this is actually part of the breakout strategy. I guess you could say the support and resistance type strategy. So for this right here, this was in Asia session. I don't stick to just New York session. I recommend you guys should just stick to New York session if you're just starting out, because usually Asia session is pretty ass. There is no volatility, but recently there has been pretty nice volatility, and I was able to take advantage of that in like the last month. But anyways, let's go and break down this trade. So I'm not even going to go away from the 15-minute time frame on this one. So this was more a little bit of a swing trade that I took, and basically we had a we had some big war news that happened where the US dropped bombs on Israel's missile bases or whatever. All right, they dropped like airstrikes on their nuclear bases, and basically Asia opened pretty low. So Asia opened low, and then we got a nice rebound, and that created a big new week opening gap right here. Now, a new week opening gap is literally what it sounds like. On Sunday, price opens with a gap, literally a gap like this, right? It is usually it's not this big, but there will be a gap between the closing candlestick on Friday and the opening candlestick on Sunday in Asia session. So usually these gaps get filled, and that's what I was looking for. Now, on the 15-minute time frame, we see this range high formed right here, range high, and then we have this range low right here. Now, since I want to see this gap get filled, I'm more bullish, and I want to see a displacing candle close above this range high. So on the 15-minute time frame, boom, what do we get? A 15-minute candle close above this range high right here. And then boom, what do we get again? A 15-minute fair value gap right here. So I set a limit order after this, after I see another 15 minutes go by and we form this fair value gap, and then I put a limit order at the top of the 15-minute fair value gap, and then my stop is at the candle low, right? So whatever low this candle formed, that's my stop loss. So, and it's also below this fair value gap. So we get a retest into this 15-minute fair value gap, and then boom, price just rips and takes out and fills the new week opening gap right here. So that's an example of the, I guess, support and resistance type model. Yeah, let's go on to the next trade now. Okay, so let's go all the way back to 9:30, or actually, yes, Asia open. Yeah, so this is another Asia trade. All right, so what do we have right here? Hourly time frame. We have this hourly swing high inside of this hourly fair value gap right here. What a great target. Now we're looking for some displacement to this high right here that we marked out, which is that hourly high. So we see Asia opens pretty strong, right? We see this strong open right here, and then we don't see any sort of like validation that we're gonna go lower, right? Because we do have this new day opening gap, which is the same thing as a new week opening gap. It's just from Thursday to Friday. Like in between days, you'll get a gap that opens, right? Just like blank space. And usually they get filled. But if I want to target that on the same day, I want to see something lower, right? To like some continuation lower to fill this gap, which we didn't end up getting. But this is also kind of another example of a little consolidation situation that we're seeing right here, right? We displace higher, we see a little bit of consolidation, and then now we need some confirmation. What is that confirmation? All right, cool. We break out of this range that we're in. So we have this range high right here, range high, and then we have, I guess right here, you could say is the range low. We have this range low right here. Boom. Now we get a nice displacing candle out of it, but I was waiting for a little bit more confirmation to this high, which is literally just a retrace off of a fair value gap, which is what we get right here. Boom, we have this 1 minute fair value gap right here. We retrace into it, and then we get a nice displacing candle close right here. And then where is my stop? Okay, at the low that retrace into this fair value gap. And we're really close to that target right here. We're really close to that swing high right here. And we've already seen that we've created another fair value gap right here, and we see a rejection off of it, and then boom, we get a displacing close right here, and then another fair value gap rejection, boom, displacing candle close right here. But this time, this displacing candle close is reasonable, right? It's not, because like there's a point where I can go break even at, which is this internal high right here. So I have a point to go break even at. Now, you may be asking, okay, well, why didn't I take an entry like over here? Well, where would I go break even at, right? I need a place to protect myself. And this is a entry where I can still protect myself in case we wick this and then go lower to my entry point, and then I won't be taking a loss. So that's my entry, and then you see it plays out. Boom, we take out the high. That's it. Let's see if I marked out another example. Okay, yeah, this is the last example that I marked out right here. This is actually one of like the best days in a long time. So this is probably the clearest example actually. We'll go through this one right here. So if we actually start from the hourly time frame, you see that we have this hourly gap right here. We're clearly bullish, right?
If we go to the 4-hour time frame, you see that price is trending higher and higher, right? These candles right here were trending higher, and then we're respecting gaps. So we take out internal liquidity right here and right here inside of this hourly gap, and we're rejecting higher, right? So we have this target right here, which is this swing high inside of an hourly fair value gap right here. Boom, that's our target. So what are we looking for? Okay, we see displacement, or we see a reaction out of this hourly fair value gap, but there isn't really entry in anything right here because there's no retrace, all right? But we do get a retrace right here into a 5-minute fair value gap right here, and we want to see a reaction out of this 5-minute fair value gap right about, right? So now we're in this 5-minute fair value gap. Now we want to see some sort of reaction out of it on the 1-minute time frame. Okay, what do we get? Boom. Beautiful candle right here. This is a nice displacing candle that also inverts this little 1-minute fair value gap right here, if you can see. So you basically get the best of both worlds. You get a fair value gap that's created that gets inverted. You get a nice displacing close. And then where is your break-even point? My break-even point is right here. And then I'm targeting that swing high all the way over here. So play out the candles. We take this out, and then we almost get break even, but then we end up going out and taking out this swing high. So those were 5 examples of how I trade and what I look for when I trade. Hopefully this long ass video was able to help you guys. Holy shit, 37-minute long video. But yeah, this is exactly how I trade. So go ahead and back test this. Go ahead and apply this in the live markets. Let me know if you guys have any questions down below in the comment section. And if you're already not in my Discord, go ahead and join that. But yeah, I hope you guys were able to learn something from this video, and I will see you guys in the next video.
Okay, so we've covered all of these different concepts in terms of fair value gaps, liquidity, break of structure. We also talked about ranges, market structure in general, but now we actually need to understand how the market moves. The market moves in 3 cycles, and it moves in accumulation, manipulation, and distribution as presented right here. I'm going to show you guys a good amount of examples. Actually, this will be a little bit of the longer portion of the entire video, this entire course that I am teaching. And we are going to be focusing on these 3 things: accumulation, manipulation, distribution, and how to spot it in the markets in real time. This is very, very important. Actually, out of everything that you take away from this video, focus on this specifically: accumulation, manipulation, and distribution. If you're able to accurately spot this in the market, you will be in a much better position to trade in general, and you will be understanding in general how the market moves. All right, with this being said, let's go ahead and break down this little diagram that I drew out that accurately describes accumulation, manipulation, and distribution. So with this first example right here, obviously price will accumulate. Okay, this can happen on any single time frame. And obviously you can use it in terms of entries, and you can use it in terms of directional bias as well, depending if you're on the higher time frames or if you're on more of the lower time frames. It all depends, right? So think about this as a universal thing. Accumulation occurs, and then we have manipulation past the accumulation lows. This is more of a bullish AMD sequence where we have accumulation, manipulation past lows, basically faking out sellers, thinking that we're going to break out of this range and then go lower. What ends up happening, we manipulate, and this can usually be also supported with some sort of fair value gap, all right? We can have accumulation resting above a fair value gap. It can be any fair value gap: 1 minute, 5 minute, 15 minute, hourly, 4-hour, daily, whatever it may be. Price then manipulates lower past the lows into the fair value gap, and then we distribute back higher. Or we can manipulate past a key low, right? It can be a session low, such as previously low. It can be Asia low, London low, New York AM low, New York PM low. Any of these lows we can manipulate past. We can also form a SMT divergence with ES as well, where we have the same thing that goes on with ES, but let's say NQ takes out previously low and we manipulate past previously low, and ES doesn't, and we still get the same reaction. That makes the probabilities of us reversing and going in a bullish direction a lot more probable, right? With that being said, we manipulate past lows. This could be supported by a higher time frame gap. It could be supported by a major draw on liquidity that we manipulate past.
and then we end up distributing, right? So this is a distribution phase. Ideally, we want to be cashing the trade after the manipulation phase is over, and then we cash the distribution back up to the highs if we're overall trending bullish, right? Same thing, except on the bearish case scenario where we have accumulation, we manipulate past highs. Same thing that goes with the bearish case scenario. If we take out some sort of major drawn liquidity higher, like session highs, or if we tap into a higher time frame unfilled fair value gap, so it can be like a daily, it can be an hourly, 4-hour, whatever it may be, or even a 15-minute gap, or even a 5-minute gap, right? Any supporting gaps with this accumulation right here, we can manipulate into, and then we get the actual move, right? This actual move as well is supported, the distribution is supported by a break of structure on any time frame, again, lower time frame or higher time frame, and then we can get basically bearish structure that is forming with fair value gaps within this move lower, right? Yeah, with that being said, that is just typical accumulation, manipulation, and distribution. Very, very important to understand, and this is just the overall basic diagram, right? You can get tons of entries based off of this. You just need to know what you're looking for. Now, let's go ahead and look at these two examples that I drew out, right? One from Friday and one from Tuesday. There was actually a good amount of accumulation, there was manipulation, and there was distribution that overall occurred in these markets on these days. On top of that, I'm also going to be getting deeper into examples from other weeks as well after we break down these two examples, because again, I do really want to focus a lot more on accumulation, manipulation, and distribution. And if you guys can understand this, you guys can overall understand honestly anything, right? The concepts will come, understanding the concepts will come, understanding price action will come as well if you overall understand AMD. With that being said, where is the accumulation within Friday's market over here? Where is the manipulation and where is the distribution? Okay, this is also paired with the SMT. So keep in mind we have this SMT over here. What is the actual accumulation, manipulation, distribution? All of this right here is accumulation. When do we end up manipulating? Past this high over here, right? We have a move taking out this high. Boom, we have an SMT as well. Let me actually just go ahead and mark it out with the brush, okay? All of this is 9:30 open right here, okay? Actually, hold on. There's actually two areas of accumulation, manipulation, and distribution that occurs. There's number one, with this high that we have over here, okay? Let's actually go into market replay so we can overall dissect this even further, all right? We have this high as a potential area for us to go and take, right? Because this is a liquidity point. Where do we see accumulation over here? We see accumulation over here, right? This is a good amount of accumulation. And this is also before 9:30 open. 9:30 ends up opening in 3 minutes. And at 9:30, price is the most volatile, right? We can manipulate in opposing directions, and then we can go to our drawn liquidity. So ideally, we would like to see 9:30 manipulate past these lows and then go back higher, right? Or we can have basically market open, just pump up, and we can break out of the accumulation as well, right? That can also be manipulation to this area. We fail to take out this high, and then we go back lower, right, for the distribution. And that is exactly what happened in this market. But to be on the right side, we basically want to understand where can price potentially manipulate towards and where can it distribute after, all right? Playing out price action over here, 9:30 ends up opening up. We manipulate to this area over here, accumulation. We manipulate towards these highs. What ends up happening? We don't actually go and take out this high. And then what happens after this? We end up distributing back lower and taking out these lows over here, right? And then we go a little bit lower as well. We failed to take out this low, but basically the point still stands in terms of accumulation, manipulation at 9:30, and then we have a distribution back lower to reclaim these lows over here, right? This is just more in a short-term sequence, and it's not a huge accumulation, manipulation, and distribution, right? The sizes of AMD can obviously differ, but the overall concept will remain the same, right? If I take out my rectangle as well, and then we just mark it out a little bit more in depth, this is the accumulation. I'll just change this to yellow. Boom. What is the manipulation that occurs at this leg right here, right? Manipulating over here, we failed to take out this high, and then we have the distribution back lower, right? The distribution then occurs once we end up shifting structure, right? I'm actually just going to make this a little bit more narrow. Hopefully you guys can still understand the point. But essentially, distribution now occurs over here, right? This is now all the distribution. Where are we distributing to, and what liquidity are we taking out in the opposing side? Well, we are taking out this liquidity, right? We are taking out this low over here, right? This nice little low that we have. Let me actually just remove this. Okay, you guys can see it, right? So I actually just want to mark out the liquidity point really quick so you guys can see what we're targeting. This border is kind of messing it up, but yes, we are going and taking out this little low right here, right? So this is where liquidity rests. Liquidity, right? Boom, perfect. Put at the right. There we go. That is our sell side liquidity, right? There is buy side liquidity, and then there is sell side liquidity. That should be pretty obvious what buy side and sell side is. I didn't really explain that in the liquidity portion, but essentially buy side liquidity is highs, and then sell side liquidity is lows, right? Those are just fancy terms to mark out liquidity. So technically speaking, this is SSL. That's what they abbreviate it as, and then buy side is BSL. With that being said, we have accumulation, manipulation, and distribution right here. Just a little bit, right? We don't have a major AMD, but we still have some sort of AMD. With that being said, we have another AMD that forms, right? So this is now accumulation over here. This rectangle is now accumulation because as we see, we are chopping around, right? We have this high that we still have not went and taken out. What do we see? Boom, price goes back higher over here. We have accumulation, and then we have a manipulation past this high over here. Once we keep playing out more and more price action, where do we take out the high? Boom. All of this right here is accumulation. We manipulate past these highs over here, and then what do we see? Paired with the SMT at these highs, we get that distribution back again lower, right? All of this is now turned into accumulation, right? Market open, we had accumulation over here, manipulation and distribution back lower. And after the distribution, the cycle resets once again. We need to accumulate, we need to manipulate, and then distribute once again. And this works very well in range-based markets, right? We will have potentially multiple scenarios where we have AMD that occurs, all right? This is the obviously manipulation, or sorry, this is the distribution back lower. And then what do we see? Price is now overall accumulating. We go to these highs, we take it out, we put in an SMT, we get the manipulation past these highs, and then now we get the distribution back lower, as we overall see right here when we end up moving, right? This is now the distribution, right? So we can take all of this, or actually all of this over here, technically speaking, as accumulation over here, right? This may look a little bit complicated because price isn't moving exactly how I drew it out, but we can have accumulation over here, and then we can have manipulation past these highs, and then distribution, right? So I'll actually just mark it out kind of like this right here, right? As we see, price is just overall chopping. So we can mark this as accumulation. Obviously, this isn't the cleanest example, but the price still ended up moving based off of this, right? And then we have manipulation at this area right here. Boom, we go and manipulate past these highs over here. Perfect. We also put in an SMT, which makes things, a lot better, gives us a lot more confidence, a lot more, just a lot more confidence like I was talking about earlier. And then what do we see? We have the distribution back lower, finally, to these lows over here, right? Boom, perfect, right? Accumulation, manipulation, tiny little manipulation, and then we have a distribution back lower, right? And taking out New York AM low. There we go, accumulation, manipulation, and distribution. All right, that's one example. Now I want to go into the next example really quick, just really quick, wherever we were at. This should be a lot more clear to basically spot with the accumulation, manipulation, distribution concept that I was talking about, because this happens at market open. All right, what do we see right here? Boom, accumulation, perfect, right? We also put in another SMT as well. So we have all of this as accumulation. Boom, this also lines up with a time-based open to have our manipulation higher. So accumulation right here. Where is the manipulation? Right at 930. This is the 930 candle right here, okay? As you guys can see, what is this? Pure manipulation higher, all right? This is a textbook example. Pure manipulation higher. You can see that we have, it looks like we want to break past these highs, but we don't. We end up rejecting past it. We are faking out basically buyers to think that, oh, we're going to go long off of 930. No, that's not the case. what immediately ends up happening after we put in this little manipulation at 9:30, we end up distributing back lower. Cool, this is good. We have a little bit of manipulation over here, and then we have the distribution back lower all the way over here, right? Where can we potentially be targeting? Obviously, we were looking at previous day low as our target, right? Which was like somewhere over here, okay? Boom, price ends up now distributing, all right? There you go. 2 textbook examples right there, or actually 3 in this case that I marked out. This is on Tuesday, and then there was also one that happened on Friday as well, right? Accumulation, manipulation, distribution, SMTs are obviously optional, but it just makes things easier and a lot more probable when we do have SMTs at the key manipulation highs or lows, right? So this was more of a bearish AMD, and then the one that I showed, the second example that I showed was a bullish AMD as well. Bullish AMD and then a bearish AMD for the first example that I showed, right? First example was a bearish AMD. Second example was a bullish AMD, right? And then third example was another bearish AMD. And then I will be showing you guys more examples in a little bit. Yeah, actually, I'm just going to show you guys examples right now. My bad. I'm low-key blanking out right now. Yeah, but that is basically AMD for this week, describing the overall concepts. And then let's get into more examples. All right. So I'll see you guys when I cut, and I'll show you guys more examples. Peace.
All right, so now we made our way onto the charts, but before we get into the examples of this week, I want to focus on the 3 specific types of continuation entries and focus more on the key opens as well. So we are going to be getting a little bit more advanced into continuations here, and I will show you guys obviously the in-chart examples in a little bit, but let's go over this really quick, right? So we've established, going over the presentation, that we covered accumulation, manipulation, and distribution, and that we should be entering in the distribution leg, right? So whenever we have distribution, we can either get our pullback immediately once we see displacement in the distribution leg, or we can get a continuation when we get a retracement into a lower time frame fair value gap, right, that aligns up with the distribution leg. So these 2 things are basically almost the same. It is just when we overall get our entry. Is it right after the accumulation and manipulation phase ends and then we get that distribution back in the same direction, or B, we still get the accumulation and manipulation and we get the same distribution, but we get, this is paired with a retracement into a lower time frame gap, such as a 5-minute gap, 15-minute gap, or even a 1-minute fair value gap, right? And then we overall get that pullback, and then we get that displacement, we get that inverse fair value gap, whatever it may be, we get our overall entry paired with the accumulation, manipulation, and distribution cycle. Number 3, we get continuation based off of momentum and volume, and we're just purely focused on our drawn liquidities. So we don't need to have a retracement into a lower time frame or higher time frame gap. Sometimes we may edge it, and then we will have momentum, we will have displacement that is just overall trumping the retracement into our higher time frame or lower time frame gaps. Now, when this occurs, this is a lot more discretionary. This is a very discretionary, right? And we might not see this happen often, but if we're able to adapt to market conditions, and if we're able to understand that our drawn liquidity is very prominent and it is very important, we potentially are able to get a continuation entry based off of this. All right, now number 3 is also paired with number 1. So all 3 of these things, actually I should say 2 of these things, have to do with number 1, right? Without accumulation, manipulation, and distribution, you usually do not find your entry in, at all, right? Because the market runs on accumulation, manipulation, and distribution. All right, so now that we covered that, let's go over these key opens. So any session open is very, very important. So it can be New York AM session, it can be New York PM session, it can be London session, Asia session, and also new day open. Now, new day open is only realistically very, very important. Also, I forgot to add, we have midnight open as well, right? So these are key opens. I have indicators for that as well. I'll go over that in a little bit, but to actually track these session opens. But new day open is really only important when we see the new day candle. So the daily candle opens with no wick on one side. All right, same thing with the 4-hour candle. That's for another video. I won't get too in depth into that, but I at least first want to go over overall and cover the new day opening candle, and just show you guys really quick why it's super important. So if you just look at basic candle anatomy, right, you want to see wicks form on both sides of the candle, right? A wick higher and then a wick lower. All right, and just basic candle anatomy also says that it should form either in an open high, right? The candlestick should either open higher and then we close lower, right? If we want to have a bearish candle, this is a bearish candle sequence, or we either open lower and then we close higher, that is forming a bullish candle sequence, right? With that being said, if we ever have a daily candle that opens with no wick on one side, we want to see this happen essentially, right? Where we're targeting the opposing side, we're targeting this open, which is called a devil's mark, where we put a wick on the opposing side. It's the same thing in a, on the other side as well, where we open lower and we're trying to, see a wick on the other side, right? So that means we open completely bearish. We want to see this overall candle flip and then close higher on the daily candle, and then this is all like lower time frame price action, on the 5-minute or 15-minute price action, right, where we can get an entry on our lower time frame to correspond with the higher time frame and us putting a wick on the opposing side, right? So now that we've established that, that's why new day open is very important. Now midnight open, that is that is obviously the new day, right? There's a new day open that occurs at 6 p.m. Eastern when we open the new session and the new daily candle, and then we have midnight open is when we actually overall transition into the next day, right? So we tend to see price react off of this midnight opening price. So this is also very ideal to understand, right? This is crucial to understand that price is going to potentially react off of midnight open. All right, just by collecting data, you will see that price, and just observing it in the live markets, you will see that price reacts off of midnight open. All right, now last thing is 10 a.m. open. This is very important to understand. Okay, so 10 a.m. open marks the new 4-hour candle open as well, and this is where price starts to be very manipulative. All right, so we factor this in with overall higher time frame price action and lower time frame price action as well, and we can kind of understand where this 4-hour candle is going to end up going. Again, paired with higher time frame draws and liquidity that we've talked about, session highs, session lows, swing highs, swing lows, higher time frame unfilled fair value gaps, right? We are able to now align this with our 10 a.m. opening candle, opening price, and the 4-hour candle where it wants to specifically go based off of previous structure. All right, so now that we've established this, we can overall go and get right into the first example. All right, now on Monday we went over example 1. If I can go back to it right here, right? Continuation after AMD, and we're entering right in the distribution leg. So over here specifically, we got a very early entry right here. If you entered mid candle, you were able to enter right here, which is also nice to get, right? If you're able to get mid candle entries just by observing that price is already done with the accumulation phase, manipulation phase, and distribution phase, then you are able to get that nice little mid candle entry just based off of understanding that. Now SMT, we have a SMT with ES at this specific moment, and this is also paired with the accumulation, manipulation, and distribution phases. Basically, that happened simultaneously, right next to each other. So where is the accumulation phase? Right here. This overall is our accumulation phase, right? All of this price action, this is pre-market. We see prices just zigzagging up and down, right? Obviously, we do not want to be participating in this price action since this is pre-market, but this is a good thing because this sets us up for the manipulation that happens at 9:30 open, and then for us to distribute back lower, right? Targeting these accumulation lows. So this looks a lot more clear on the 5-minute time frame where price is very bunched up right here, right? So as we see, we accumulate, and then 9:30 at this area right here manipulates past these pre-market highs. We also put in an SMT with ES, which is a added confluence, and then we get that distribution back lower to these accumulation lows. All right, going back to the 1-minute time frame to get your specific entry, if I can just overall go back here, getting our specific entry, there are multiple things that we can overall look to enter off of, right? So obviously we have the classic inverse right here where we end up, getting our bullish fair value gap that forms, boom, right here. And then if we just go into market replay, just breaking down price action from 9:30 open, right? As we see, this is the open of New York session. So we're looking at this to manipulate past these highs right here. So we not only manipulate past these highs, but we also put in a SMT with ES, right? So this is very, very open. And then this is obviously 9:30 opening price right here as well, right? So I'll mark this out, 9:30 open. This is key, right, to see if we also respect open or if we do not respect open. That is also a key area to see if we do want to go lower, right? So we have the accumulation, we have the manipulation. Now where do we have the distribution? All right, this is where we now reject off of this SMT, putting in this bearish candle right here. We go lower. We're now respecting this gap initially, this fair value gap initially, but we put in this retrace leg right here, right? We have these two retracement candles right here, and then boom, we get a nice sharp bearish candle inverting this gap right here. Now, if you are more advanced, you are able to get a mid candle entry off of this displacement candle right here. Why? Because you've established that we've already accumulated pre-market, we've already manipulated off of 9:30 open, taking out these highs and putting in an SMT, which is not needed, but it is an extra added bonus confluence. And then we see price reject off of this SMT, off of taking those highs. We have these accumulation lows as our strong draw on liquidity, and then we go lower initially. We fail to inverse this gap right off the bat. We put in this retrace here, and then boom, we get a displacement candle. Now with your mid candle entries, you want to be focusing also not only mid candle entries, but just any entry, even if you get it right here, right? You want to be putting your stop at a protected area. Where is the protected area in this scenario, you may ask? It is at the swing high, right? This is the extreme point of invalidation because, again, 9:30 manipulated past these highs. We already took out these highs right here, right? This high right here. We put in an SMT. So after seeing this displacement, if price wants to go back higher and take out this high, this trade is now invalidated because it is a swing high. It is a structural high that should not be broken, right? If we want to continue lower, okay? So it's either you get your mid candle entry here and then you get a nice 1 to 2 RR, putting your stop at the structural highs, or you wait for the inverse fair value gap that happens right here. You enter right here, and then you can put your stop at the bodies, to get to 1 to 1 RR. If you put your stop at the ultimate high, right, you don't get that 1 to 1. So you can be a little bit cheeky with it and then put your stop at the bodies because ideally price shouldn't even go above this area right here. Why? Because this is the retrace leg that has occurred before putting in this point of invalidation, right? We invalidate this retrace with this bearish candle right here, causing our inverse. So realistically, price should not go above this general area at all, right? So this is our protected structural stop. And then now we play out price action and we go and overall take this low, right? Now, in terms of your break even point, you can go break even at this low right here. You can go break even, at these equal lows right here. You can go break even at this little low right here as well. Or you can just let the trade play out because you realize that it is just a 1 to 1 RR and you might as well, let the probabilities play out, right? With the 1 to 1 RR, realistically, your win rate should be anywhere between a 65 to a 70% because your stop loss is the same amount as your take profit, or at least near, right? Which increases the probabilities because you're giving room more time to breathe, or sorry, you're giving price more room to breathe, right? Essentially speaking. So that was the first trade. Again, this is a clear textbook example of accumulation, manipulation, and distribution, where we have the accumulation over here, the manipulation occurring that's lining up with 9:30 open, right? New York AM session opening, and then we have the distribution phase, which is our entry, right? So this is more of getting your continuation entry earlier, right? Just based off of very minimal structure on the 1 minute time frame, but overall corresponds with structure that we've been seeing pre-market and these structural highs that we end up not only sweeping but putting in SMT with. All right, so that is the first example that I wanted to show. Now let's go ahead and get into the second example. All right, so now we are looking at example 2 over here. This is Tuesday of this week, Tuesday, March 10th. So let's break it down in terms of looking initially at the higher time frame and then also looking at the lower time frame to get this entry right here. So this overall falls with example 3, where we're not retracing into any higher time frame gaps initially for us, to set a condition for a price to have this big impulse move here, right? This impulse move here right off the bat occurred just basically out of thin air, right? But it doesn't mean we can't get an entry, because overall, right, since we're entering all the way over here, we've established that price does not want to retrace into a higher time frame gap. So let me show you what higher time frame gap specifically I was talking about. So for this, we need to be going all the way to 9 a.m. And we need to be looking at the higher time frame right here. So if we look at the hourly time frame, we have multiple things to take care of. All right, number one, looking at the overall higher time frame, this bullish leg, we fill in this new week opening gap in price right here. We move higher as well, and it looks like we take out some points of liquidity right here, right? So once we fill this gap right here, we also take out these highs right here as well. As we see, we take out these highs. It looks like we want to see some sort of potential retracement, right? Again, what we want to be looking for after we take out external draws on liquidity is a retracement back into internal draws on liquidity. Now, what are internal draws on liquidity? Retracements into fair value gaps, higher time frame fair value gaps. Once we take out external structure, we want to see retracements into internal structure. What is the internal structure that we have right here? Okay, we have this low that aligns with this 4-hour gap right here, right? We want to see price overall retrace into this 4-hour gap. Not only that, but this 4-hour gap also lines up on the 15-minute time frame. If we see, it lines up with Asia low. And what did we say about Asia low, Asia high, London lower, London high? These are very prominent draws on liquidities, right? Session highs and session lows, and also unfilled higher time frame gaps. Now, once we see both of these things stacked together, that is just an ultimate very strong draw on liquidity. All right, so we want to be targeting this after we take out external liquidity. We see structure is overall forming bearish, and this looks like a very clear draw on liquidity for us to target if a market open wants to go lower and dump to this area, right? One thing we also have to notice is that price action is a little bit wonky over here. We're not moving efficiently, but after we take out this high, we are now displacing in one direction, right? So we can view it one of two ways. If we get, number one, if we get a continuation entry to Asia low / this unfilled higher time frame fair value gap, we would very well like to take it. Or B, we can use this as a condition to, us tapping into this area, and then we get some sort of displacement and us pushing back higher to target London high, which is again a very strong draw on liquidity, and this overall aligns with the higher time frame trend that we've seen right here. Right now, what we need to do is go to market open and see what we end up doing. So playing out price action right here, what do we specifically see? All right, we see price is just not really doing that much right off the bat. We end up consolidating, which isn't really that ideal, right? But this accumulation right here could set up for some sort of manipulation into this gap right here, and then we can get the distribution back to this area right here. So again, like I said, accumulation, manipulation, and distribution. Not all accumulation is bad. You just have to let it play out and then wait for the manipulation and then wait for the distribution to get your entry. All right. Playing out more price action right here. We see prices just overall stalling. We end up chopping lower and lower and lower. Now, this is where things go a little bit south. All right. We do not end up tapping into this higher time frame fair value gap in order to, confirm the manipulation. But what we do end up doing is that with ES at this specific moment, we put in a SMT with the swing low right here, an external SMT, which causes us to move higher initially, right? Now, off of this, we are seeing momentum. We are starting to see some sort of volume in the area of intent, right, which is London high. And ideally, we would like to see us retrace into this higher time frame gap. But again, adapting to market conditions, we essentially don't need to retrace into this gap, right? Is it improbable for us not to retrace into this gap, especially after the external draws that we've taken out? Yes, it is. But again, if you're able to adapt, you're still able to overall get an entry, right? Now, again, like I said, this is rare. I've said this earlier when I was going over the presentation. This is rare to see, but it doesn't mean you know, it is a no trade day. You can potentially still take a trade. You just have to be patient. All right. Playing out more price action, what do we end up seeing? We're starting to invalidate bearish structure right here. Okay, we invalidate this bearish gap. We're pushing higher. Again, this could just form as some sort of manipulation higher for us to go back lower and tap into this higher time frame gap right here, right? Which is why, again, we want to stay patient. We potentially do not want to be getting any entries over here, even though it looks like on the 1 minute time frame or the 5 minute time frame that we may be displacing, right? Until we have invalidated a good amount of structure, then we are able to potentially take our entry. Okay, first sign of us respecting bullish structure is right here off of this 1 minute gap right here. We don't disrespect it, we don't invert it, we just react off of it and push higher, right? Same thing over here. We also have this 1 minute gap right here that we respect, boom, and then we push higher off of that, right? So we're continuing to do that. We are creating bullish structure. Now at this point right here, it is now safe for us to potentially take a trade to London high, which is a strong drawn liquidity, right? Could you have potentially taken trades right here as well? Yes. You know, we respect this 1 minute gap, we push up higher. Okay, maybe you don't take a trade off of this, but we respect this 1 minute gap right here, and then maybe you get a mid candle entry, since again you've established that we are displacing in this current direction. We have a very strong drawn liquidity, which is London high, and then potentially you can get an entry, you know, off of this candle closure right here. Boom, you have your stop at the lows, and then you're overall just targeting, you know, London high right here. Maybe you're going break even at New York AM session high, and then you're just letting the trade play out for a nice, you know, 1 to 2.5 RR, right? So this is a potential entry, and then now we have this entry right here where price has overall broken out of this range right here, and then now we're looking for some sort of mini continuation to this high right here, right? So now this is lining up also with the second type of continuation entry, which is a retracement into a lower time frame gap. So again, we have established that price is showing shallow retraces, so we're expecting this to hold as well as a shallow retrace. What is the shallow retrace that we are seeing? We see this 3 minute fair value gap right here that opens up, right? If I actually make this a little bit better, we have this 3 minute fair value gap that opens up. As soon as we tap into it and we get some sort of displacement higher, that is our entry trigger. So playing out price action here, boom, we get that displacement entry over here, and then you can just hold it to London high right here, and then you can put your stops at the area of invalidation. You can either put it here, or if you're not that confident in this low, you can put it below the 3 minute gap right here, right? Because realistically, price should just respect this area and then go back up, because that is what we've been doing overall, looking at this leg higher, right? Again, these are more rare entries because ideally you would like to see price retrace into a higher time frame gap before creating the distribution leg, right? So we have the accumulation here, the manipulation occurs at this SMT, and then we get the distribution back higher, right? Now playing out price action, what do? We end up taking out our drawn liquidity, our strong drawn liquidity, which is London high. All right, so that was example number 2 that you could have taken for the week or for the day Tuesday of this week. All right, now let's go into our third example. All right, going on to example number 3, we are now on Wednesday, March 11th, and this was the day of CPI. All right, so we need to establish a few things first on the higher time frame before we get into this entry right here. So if we look at the 15-minute time frame right here, we overall see that we are in ranging price action, right? From this low to this high, we have been accumulating in one direction, right? Or not in one direction, but again, we've been accumulating sideways. We've been moving sideways. All right. So in terms of our targets, we probably don't want to be targeting these extreme highs right here, but instead we want to be targeting internal highs, right? So this right here, Asia high, is not only a strong draw on liquidity because it is a session high, but it is also a nice structural swing high, right? So we see a little mountain peak right here. That is the formation that shows us that it is a swing high, right? Another mountain peak formation right here, a nice swing high. But the reason why we're targeting this and not this is because this is the external range high. We can easily go up and take out Asia and reject back lower, which is why we want to be careful when we are in range-based conditions. Now, just because we are in range-based conditions on the higher time frame, it doesn't mean that it is a no trade day. We can potentially still see an entry on the lower time frame when it comes to us retracing into 5-minute gaps, 15-minute gaps, or us just taking out liquidity in opposing direction and getting a V-shaped recovery. So with that being said, we can now go into market open and see the potential entries that we are getting. All right. Off of this 930 open right here, we have data high. Okay, so data high is a very, very strong draw on liquidity. This aligns with the CPI, CPI candle. This is one thing that I forgot to mention as well. Another strong draw on liquidity are data highs and data lows. Okay, so these form with red folder candles. Essentially, whenever you see them, you want to be ideally targeting them if we are trending in that direction. This is pre-market, so obviously you're not going to be taking a trade to these data highs, but we can see what 930 does right off the bat with data high right here. Okay, we go pump up, we manipulate past data high, and then we look like we want to go and take out Asia high right off the bat, but we end up forming structure first before we end up taking out data high, right? So we start to accumulate right here, right? So we manipulate, and then we have accumulation right here, and then now we want to retrace into a fair value gap, right? What is that overall fair value gap that we retrace into? So we have this 15-minute gap right here, or I think we retrace into a 5-minute, something of those sorts. Yes, we retrace into this 15-minute gap right here that I marked out. So if we look at the 15-minute time frame, what do we end up seeing? We are in this 15-minute gap, we took out data high, and then we have this structural range high, which is also Asia high, a strong draw on liquidity. So what are we expecting? A reaction out of this 15-minute gap for us to push and take out data high, right? This is exactly what we get. Not only a push up higher, but we get a nice V-shaped recovery as well. So we tap into the midpoint of the 15-minute gap. Essentially what the midpoint is just the 50% mark of a fair value gap, right? These are very important because this allows us to have the most efficient stop loss, right? If we tap into the equilibrium of a higher time frame gap or of a 5-minute or a 15-minute or even a 1-minute gap, essentially price should not go back and revert if we get our confirmation off of the midpoints of gaps, off of equilibriums of gaps. What do we see right here? We see a nice V-shaped recovery causing our inverse fair value gap at this area right here. I will overall just remove this 15-minute gap retrace, but we get this inverse fair value gap right here. We can put our stops at the protected low, right? This is our pullback, and then now we are getting our confirmation with this inverse, and then we are going to be targeting the Asia session high, right? What do we end up doing? Boom, we end up going up and just taking this area out, right? We take out this draw on liquidity, right? So this nets you a nice almost 1 to 3 RR. And if you're just able to identify pre-market structure, and if you're able to correspond that with New York open and identify what strong draw on liquidities there are, your entries get a lot simpler, right? So this is the textbook continuation entry off of 5-minute, off of 15-minute gaps. In this case, it was a 15-minute gap that aligned with the 5-minute gap, but realistically, you should be looking at the higher time frame, always the highest time frame gaps. So we retrace into this 15-minute gap, which is the highest time frame gap, and then we get that nice V-shaped recovery. Overall, just continuing the trend that we see in this ranging market, right? So that was example number 3, very straightforward. Just to play out more price action, what do we end up doing? We end up retracing back into this range, and then we don't take out this high right here, right? It is very important that we understand that in range-based conditions, not to target the extreme highs or the extreme lows when we are pretty much, a good amount away from that area, right? In this case, from, our entry, we were a good 170 points away, which is pretty far, which is why you want to be targeting the nearest strong liquidities. And regardless, this nets you almost a 1 to 3 RR regardless, right? So you should be content with that anyway, right? Targeting 81 points, risking around 30 points. That is example number 3. Now let's go into Thursday, the final day, where we had multiple examples that I do want to show you. Okay, so now we are specifically looking at Thursday's price action. So this is Thursday, March 12th, and before we get into our entry, we have to look at the higher time frame once again, right? So, or the mid time frame in this case, because it is a lot more clearer than looking at the hourly or the 4-hour in this case, because you guys can distinguish what is going on a lot more clear. So we see that we have this accumulation, right? On a larger scale, we have accumulation, we're moving sideways. Where do we see the manipulation? Right, the manipulation occurs, or the breakout first is what happens, right? We break out of this accumulation right here, and then we retrace into the 4-hour gap. Remember with the previous example that I was talking about, I think, on Tuesday, where we were initially trying to target this 4-hour unfilled. We did not do that, and we finally ended up accumulating, and then we finally broke out and filled the 4-hour unfilled gap right here, right? With that being said, what do we see? We see a manipulation back into this area, and then now we are trying to see a distribution back lower into Asia low, right? Accumulation right here, and then we see a breakout of the accumulation. We see a manipulation back into the range, distribution back lower, right? Where do we manipulate back into after breaking out of this range and then filling this unfilled 4-hour gap right here? That is a good question. If you look at the 4-hour time frame, we end up manipulating into this 4-hour gap right here. Now, it may look like we have inverted this gap, but ideally we are not going to be taking an entry off of this, right? Because this is the 4-hour time frame. So this inverse doesn't really hold much power if the next candle is overall opening bearish, and this is aligned with the accumulation that we've seen right here. We see the breakout of the accumulation, and then we manipulate back higher instantly, right? This manipulation causing this 4-hour inverse is used to fake traders out, thinking that we are going to go back higher to these recently taken out highs right here, right? Taken out draws on liquidity, okay? But as we see with this next 4-hour candle, we are distributing lower, and then this is where we are going to get our continuation entry based off of this distribution leg, right? But obviously we need to see this on a lower scale, not on, we need to see this on a smaller scale rather than a larger scale on the higher time frame. So this is where we go into market open. We obviously are doing our analysis where we see a manipulation into this 4-hour gap. We now see that London on a smaller scale is accumulating, right? So we want to see price break out of this accumulation, and we want to see a distribution back to London low and Asia low, which are very strong draws on liquidity. Okay, so in this day there are multiple examples as we see that we have drawn out right here. Okay, let's go ahead and get into both. So right off of market open, what we see clearly that oh, why are we on XAU USD? Why are we on gold? All right, anyways, back to what I was saying. Playing out price action right here, what do we do initially? We manipulate higher, right? We go out, we take out London low, and then we get a manipulation into what? We see a 5-minute gap right here, okay? So we take out a strong draw on liquidity, which is London low, but overall we have a stronger draw on liquidity as well. That is not only a swing low, but we have Asia low, and this aligns with overall structure lower. Once we've seen that we've manipulated into the 4-hour gap, and we're expecting price to distribute lower, right? Accumulation, manipulation, distribution on that larger scale. We've identified that. Now we want to identify this on a smaller scale. Over here, we are accumulating in this little zone. We are manipulating into this 5-minute gap, as we see right here, and we're expecting this to cause the distribution back lower to Asia low, right? This is where we get our entry. Right now we go to the 1-minute time frame to get into a larger scale, right? We get that manipulation, and then we stall for a little bit around the 5-minute gap, right? This accumulation is good because it sets up for us to distribute back lower to Asia low, which is our strong draw on liquidity, right? So as soon as we see this displacing candle from this accumulation period right here, we can now put our stops at the protected high that tapped into the 5-minute gap. We see this displacing candle, we get our entry, and we're expecting price to distribute back to this to Asia low, right, which is our strong draw on liquidity. What do we end up doing? We can go break even at this low right here. Perfect. And then after we take out Asia low, what do? We go back higher, right? And then we go back lower off of that. No entries over here that formed. Now, what do we see at this area? Okay, we are 3 minutes away. We are 3 minutes away from opening a new 4-hour candle, right? So like I was saying earlier in the presentation, this is very important to note, because if we manipulate higher off of 10 a.m. open, we are looking at this 4-hour candle to close lower. Why? Because look at overall price action. We are moving lower. If you look at the 4-hour time frame as well, it will be a lot more apparent that we want to see this next 4-hour candle open bullish and close bearish. Why? Because we have lower targets. We want to rebalance this overall leg because we've taken out a bunch of draws in liquidity higher, and then now we've had this accumulation, we've broken out of the higher time frame accumulation, and now we want to rebalance this overall range. So this is where we take out our fib tool, we mark it from the low to the high right here, and then we see that we are very, very close to the equilibrium of this overall leg. Now we align this with the 10 a.m. open, where if we see the new 4-hour candle open bullish, we are now expecting to potentially find an entry to the equilibrium of this range right here, of this leg, right? Playing out price action, we see immediately that the 10 a.m. open manipulates higher, right? We push higher, we have a drastic push higher as well to area of interest. This is our 10 a.m. open. So this is also very, very important to note, right? 10 a.m. open. Very, very important to note. I'm going to put this to the right here. And then we need to see where we are manipulating into. All right. Looking at the 5-minute time frame, I think 15-minute as well, we see that we open higher, right? With this 15-minute candle, we open higher. Also, the 4-hour candle as well, you probably can't see it. Actually, you can. You see with this 4-hour candle, we are opening higher. So we're expecting this to be the highest wick and then pushing us lower to finally tap into the equilibrium of this range. All right, playing out more price action. Again, note that we have 10 a.m. open right here. So I want you to see what price ends up doing in this area, right? 15-minute time frame, do we still have anything? Okay, no. 5-minute time frame, do we have anything? Also, no, right? So we go back lower. Look at what we do. We tap into the 10 a.m. open, we respect it, and then we manipulate higher after this, okay? This is where we get our entry. Where is our entry? This pairs with the 5-minute gap right here, okay? We've seen us manipulate higher with the 10 a.m. opening candle, right? We push higher, we put in this higher 4-hour wick, and then now we get instant displacement lower, okay? We are now aligning this with the overall 4-hour candle, where we want to see this, since again, we've made this open high, we've put in this wick higher, we want to see this flip bearish and then tap into this area. Not only the 50% mark of this range, but this overall 4-hour unfilled gap, right? So this is a very strong draw on liquidity as well. All right, we've established that. We've seen us manipulate on the lower time frame as well into this 5-minute gap, and then we get an instant flip lower, right? So this is where personally I got my entry off of the wick here. I was entering expecting price to distribute lower after we've manipulated into the 5-minute. So this is more of an advanced entry. This is where I got my entry in today's market, because at the time of recording it is the 12th on Thursday. So this is where I got my overall entry, and then I was just targeting this internal low because I did not want to be too greedy, right? So I had my stops at the highs as well, and then I was able to secure a nice 1 to 5 RR. But for people that were waiting for more confirmation, you were able to get an entry here as well. You saw we reject, we see a sharp displacement lower as well with the next candle, and then you could be targeting here, or you could be targeting the equilibrium of the range as well for a nice 1 to 2 RR. Playing out price action, what do we see? Price just overall delivers smooth as butter, right? That was the last example for the video. So yeah, that's basically it for the video. I hope you guys were able to learn something from this. Again, if you're not in the free Discord, go ahead and join. I'll leave it in the description below. But informative video, informative style of video. If you guys have any questions, leave it in the comment section below.
All right, so now we're going to be talking about the major time frames to be focusing on and time frame alignment. So these are two very important concepts because for certain time frames, you will be using them for more of analysis-based reasons, and then you'll use certain time frames for execution. So to look at the major time frames, we're only going to be focusing on the daily for our analysis, 4-hour for our analysis as well, hourly and 15-minute. Those are all going to be mostly your analysis-based time frames. And then when we get to the 5-minute and the 1-minute, this is going to be more of your execution-based time frames. So these arrows that I drew out, basically, all these time frames are correlated in the sense that when the daily time frame, when the daily candle closes and a new daily candle opens, there is a new 4-hour candle that opens. And then there is a new hourly candle that opens in the same time. A new 15-minute, a new 5-minute, and a new 1-minute candle that also opens. What does this mean? That means you are able to check these different time frames whenever a new candle opens up. All right, you need to understand when a new 4-hour candle is opening up, when a new daily, when a new 15-minute. These are all very important, especially on the higher time frames. So let's say you're executing on the 1 minute time frame or the 5 minute time frame. If there is a new 4-hour candle that is about to open, you probably do not want to take an execution, because at certain times, 4-hour candles, they can manipulate in certain directions and you can get stopped out of your potential trade. All right, this is very common, and this is known as 10 a.m. open, where you have 9:30 opening price, that is New York AM session, and then at 10 a.m. a new 4-hour candle opens. All right, go back to when we were talking about open high low close and open low high close. With a 4-hour candle, let's actually just go and use this as an example. If we go to price action at 10 a.m. This is actually very textbook. This is perfect right here. All right. Talking about the 4-hour candle open at 10 a.m. Let's say you wanted to take a position somewhere over here. Let's say you wanted to target this external liquidity that we have spotted right here. Okay. 1 minute before the new 4-hour candle opens. All right. So you take a long position somewhere over here, let's say, right? You take a long position here, you ever stop at the lows, and then you want to be targeting this external liquidity right here. Now, the thing is, at 10 a.m., we tend to manipulate in one direction. Again, think about open high low close, open low high close. We want to be putting in on a 4-hour candle, we want to be putting in a wick lower or higher before making a move. So if you're trying to correlate the 4-hour time frame with the 1 minute time frame and you're trying to get an entry, you want to be a lot more careful and you want to be cognizant of the different time-based opens, right? 10 a.m. is a very, very key open. I should have honestly included this in, when we were talking about the different sessions. 10 a.m. is still part of New York AM session, but it is something to look out for, because at 10 a.m. we get more of a manipulation and then we get a distribution within that hour, all right, and within that 4-hour candle. So 10 a.m. ends up opening. What ends up happening, we go lower and you get stopped out. And then after the manipulation has occurred with the 4-hour candle, we've put in this lower wick initially, we now get that distribution back higher up to these highs over here, up to our liquidity point, right? With that being said, that is just one little example. There's tons of more examples that you will be able to find out on your own as well, where just with your own trading, you're trying to take a trade and you see that the 10 a.m. candle opens in like 2 minutes, and you see a setup and you decide not to take it because you don't know what the 4-hour candle is going to do, the new 10 a.m. 4-hour candle is going to do. With that being said, right, back to time frame alignment, very, very simple. Just look at the different time frames, especially when you're trying to execute on the 1 minute. Take a look at the hourly, where it's potentially going to close and when it's going to open. Think about, is my stop protected if I enter right now 5 minutes before the new hourly open, 5 minutes before the new 4-hour open? All right. The daily time frame, obviously you don't need to really worry about that since you're trading New York AM session. You don't need to worry about, a new daily candle basically opening. But you should be doing top-down analysis, that's what we call it, from looking at the daily initially, then looking at the 4-hour, the hourly, 15-minute, 5-minute, and 1 minute, right? That's where you get your executions, like I said earlier. Also, in terms of market structure, you will see that these time frames are basically, they overall consist within each other, right? So the daily, you'll have a bunch of 4-hour candles within the single daily candle, and then within the hourly time frame, you will have a bunch of 15-minute, 5-minute, and 1 minute candles that basically make up the hourly structure, right? Same with the 4-hour, you will have all of this that basically makes up the 4-hour structure, right? So if I look at an example right here, we look at the daily time frame. Okay, cool. Let's look at the daily candle over here, right? This is just 1 day's worth of price action. Obviously, we cannot tell that much off of this singular daily candle. So what do? We drop down to the lower time frame. So we look at the 4-hour. See within this 4-hour or within this daily candle on the daily time frame, what are we overall presenting within the day within this 4-hour time frame? Okay, not really that much. But again, this is still within the day over here, right? Now we can go down to the hourly time frame to see, okay, what are we actually doing in this daily candle, right? Now it becomes a little bit more clear, right? We have a little bit more structure that is presented over here. Oh, look, we have us tapping into this hourly gap over here. We're pushing higher, and then now we can see some sort of trend that is forming, right? Same thing with the 15-minute time frame. It just breaks down all the other time frames, all like, you know, the bigger time frames like the hourly, the 4 hour. It just breaks it down and you're able to look at more precise price action. And then eventually you correlate these time frames and you drop down to the 5-minute, you drop down to the 1-minute to potentially take your entry on the 1-minute time frame based off of structure on all the different time frames, right? Off the 5-minute, 15-minute, hourly, 4 hour. That is how you do top-down analysis, right? Mark out your drawn liquidities, mark out your liquidity points on the higher time frames, so the hourly or the 4 hour, or to rely on the indicator as well, looking at the session lows and session highs, right? Look at the 15-minute time frame. These session highs and session lows, they are not overall correspondent to one singular time frame. Just because you see at the 15-minute, you see, let's say I mark out this low over here, it doesn't mean that this is a 15-minute drawn liquidity, right? If you look at the hourly, pay attention to this line. This line will still remain the same if I go to the hourly. Look, this is the hourly low over here, but this lines up with London low, right? Same thing with the 4 hour. This line will still remain. This is still a point, right? But it just becomes more clear to basically look at, is this a swing low? Is this a prominent low? You know, either it being a session low or a session high, etc. On the lower time frames, right? Hourly over here, okay, it looks a little bit more apparent that this is a swing point in the market. 15-minute, it looks a lot more clear that this is a swing point, right? So you're just breaking it down based off of the different time frames. Time frame alignment, super simple. I do not honestly need to explain more than that. Yeah, that is basically it when we talk about time frame alignment. Okay, ladies and gentlemen, so we are going to be talking about risk management. Let's keep it very short. Let's keep it very concise. Not really much to talk about, just a few things as you guys can see here on the screen. So first thing is, especially for the beginners out there, you are always going to have consistent risk. Make sure you are abiding to a strict plan. All right, you're going to be risking around $350 to $500 per trade. Obviously, you guys are going to be on 50K accounts. And your main focus should be developing the skill of trading. Don't worry about the P&L. Don't worry about how fast you're going to pass this evaluation account. None of that matters for right now. All you need to worry about is, how am I going to get better at the skill? How am I going to gain more experience? And you risking less on these accounts as well will allow you to make more mistakes, will allow you to make more trades, take more trades in general, and overall help you understand the skill a lot better. Now, when you end up passing those evaluation accounts and then you're on the funded accounts, then you can risk a standard amount around $500 per trade. With these 50K accounts, like I was talking about in the prop firm section when I was explaining the different account sizes, with the 50K account, you get a $2,000 drawdown. With that being said, you get a 4-trade buffer before you end up blowing the account. And that should be more than enough, obviously, because you'll get to the point where you've already risked around $300 to $500 per trade on your evaluation account. The profit target is 3K. So you've been trading for a good amount of time, obviously factoring the fact that you've taken losses, right, on those accounts, wins and losses, and then overall just building your way to either passing the account or blowing the account. Another thing you have to realize as well with risk management that I did not list on here is just the fact that you are going to blow accounts. It is standard, it is part of the game. Even I blow accounts to this day as well. You have to understand that with prop firms, it is an overall return on investment game. Obviously, once you understand the skill, you should be focusing on the skill as a beginner. But once you understand the skill, you're able to size heavier. You're able to basically take more setups in a way and still be able to risk heavier, just knowing the fact that, okay, is this setup worth putting risk on or not? All right. Once you understand, you will understand that later on when you place more trades, but let's just keep it more beginner friendly in this case right here. And then, we'll kind of branch off from that. So going down the list, always have consistent risk, especially as a beginner. You don't want to focus on specific contract sizes. You want to be correlating the amount of dollars that you're risking to the number of points that you are basically risking for your stop loss, right? A lot of mental math, not a lot of mental math, but a good amount of mental math, I would say, is required. So what I like to do is that I have a calculator in hand right next to me while I trade. So I know how many contracts to put according to the amount of dollars that I want to risk on the trade. So with that being said, let's go ahead and walk through an example really quick, right? If I am going into a trade understanding that I have 25 points of risk on the table and I want to risk around $500 per trade, and if I'm on NQ instead of MNQ, right? Let's say I'm on NQ, one mini contract, not a micro, but one mini contract. I understand per point increment, we move $20 per point. So if I multiply $20 times 25, that is $450. All right, that is relative around $500 in that trade. Another thing to understand as well, when you're trading on minis, you are not going to have the most accurate dollar amount of risk. It'll be a little bit of a difference, I would say around like $50 to $100, which isn't that bad. You want to have somewhat of a relative risk. Now, with you guys that are going to be trading on 50K accounts, you don't really need to worry about that because you're going to be trading on micros, which is a lot more precise because the actual difference between each micro contract is very minimal compared to mini contracts. So for example, a mini contract, one mini versus two minis, it doubles in size. Obviously micros also doubles in size as well, but it is divided by 10. So like I said earlier, one mini contract, $20 per point, and then two mini contracts would be $40 per point increment up and down versus a micro contract where it's $2 for one mini and it is one micro, and then it is $4 for two micros. So with that being said, you can kind of do the math. When you're risking around $350 to $500 per trade on your evaluation accounts, you can be a lot more flexible because you are sticking to micros. What I will say in general is that when you are trading 50K accounts, you should be on MNQ1 exclamation mark, not NQ1 exclamation mark. It is simply just due to the fact that you are exposing yourself too much. There's too much risk exposure when you're on NQ. You should leave those for more of the 100K accounts and the 150K accounts, or when you get to the point when you're on the funded account and then you've built a good balance, I would say like a 4K balance, even like a 3K balance, I would say, on the funded account after you pass the evaluation, then you can think about upping your size and going to NQ1. But again, for the beginners, risk consistently. Understand that, build good habits, and move on from that. All right, now we want to be talking about stop losses. They should always be at protected structure. I did cover swing lows and swing highs. Yeah, I covered everything about swing lows and swing highs. So your stop losses shouldn't be below fair value gaps. It shouldn't be at any sort of random areas. Put it at protected structure at your entries, right? So when you have your swing lows, they're going to look something like this, just to kind of draw it out with the brush, right? Your swing lows will look something like this, and then your swing highs will look something like this. You want to be putting your stop loss at the actual swing points that occur with the candlesticks that form, right? Because that is where your trade is going to be invalidated, right? Let's say you put your stop somewhere over here, right? You could get swept out and then price ends up dumping, all right? Same thing with these lows over here. Let's say you put your stop somewhere in the middle. You get swept out, we respect the swing low that we put in, and then we go back higher, right? That is exactly what you don't want happening to you. So with that being said, always put your stop losses at protected structure, no matter what. That is a non-negotiable. All right. Last thing that we want to be talking about is the amount of trades that you're taking. We already talked about how much you're going to be risking per trade. That is just very standard. Now you're going to be taking 1 to 2 trades per day. The way that I love to go about it, even to this day, if I take a win, I'm done for the day. The way that I view it, and the way that you should be viewing it as well, is you took your win, you beat the market for that day. So what is the point in trying to risk that profit to make more? Okay, there will be times where you get, a very, very good setup to take, and you're like, okay, this is worth trying to risk my profits to make more. But even then, greed is just going to overall take over. There is no point in trying to risk your profits for no reason. You take your win, you're done for the day, enjoy the rest of your day, right? Don't let trading control you. You should be in control of your own trading and most importantly, yourself. Trading is only a part of your day. Now, if you take an L, you look for another trade potentially, and if it's a win, loss, doesn't matter, you're going to be done for the day no matter what. And that second trade is optional as well. You will have days where there are no setups that are forming, and you just have to have the willpower to essentially not take that trade because there's no setup forming, right? I see a lot of traders, they also mess up when they have, you know, a 2 trade limit per day, where they just decide they take a loss and then they're looking for another trade. They don't see anything significant that forms, but they still decide to execute regardless because they mentally have the 2 trade limit in their head and they want to utilize it. Now, unfortunately, that is not the case with trading, right? If you're not actually taking proper setups, you are not going to see any sort of reward out of it. So my piece of advice is just to be careful with that 2 trade limit, have the willpower, have the discipline, build the good habits of understanding. You take a win, you're off for the day, you take a loss, and if there is no trade setup that is presented, no need to execute, right? You're good, move on. There will be more opportunities in the market later on. That is always the mindset and the pretense that you should be under. With that being said, this is just a very basic risk management plan. Obviously with more advanced people as well, you just have to overall just follow the 1 to 2 trade per day limit. I mean, to this day, I still kind of follow that as well, right? I don't risk more than I need to. Obviously, I'm on 150K accounts, so it's a little bit more risk exposure for me, but I have a bigger drawdown, so I don't really have to, you know, worry about risking $500 per trade. But anyways, though, I'm getting a little bit off topic over here. This is just the overall risk management plan. Stick to this, especially as a beginner. Risk $350 to $500 per trade. Don't risk that much and focus on developing the skill. All right, with that being said, that is it for this clip, and I will see you guys in the next clip when we're talking about something else. So in today's video, as you guys can see right here, I've constructed a nice presentation for you guys going over the main psychological reasons as to why you are failing in your trading. I decided to make this video because me personally, I know that I have struggled through with these main things that I'm going to be talking about later in this video for a very, very long time. And it is very, very important to realize exactly where you're going wrong in your trading emotionally, psychologically, so you can know exactly what you need to fix. So without further ado, let's go ahead and get right into it. First thing that I want to talk about is every trade is executed inside a human nervous system. But what does this actually mean? When I say this, I mean that every trade, what's going on, guys? Welcome back to another video. I hope you guys are all doing well. So in today's video, as you guys can see right here, I've constructed a nice presentation for you guys going over the main psychological reasons as to why you are failing in your trading. I decided to make this video because me personally, I know that I have struggled through with these main things that I'm going to be talking about later in this video for a very, very long time. And it is very, very important to realize exactly where you're going wrong in your trading emotionally, psychologically, so you can know exactly what you need to fix. So without further ado, let's go ahead and get right into it. And by the way, if you guys aren't already in the free Discord, go ahead and join it. I'll leave it in the description below. I'll also leave this template in the Discord as well if you guys ever want to go back and look at it. So if this is useful for you guys. So yeah. Anyways, let's go ahead and break down this entire board that we have constructed right here. All right. First thing that I want to talk about is every trade is executed inside a human nervous system. But what does this actually mean? When I say this, I mean that every trade, when it is executed on the charts, it is executed in your body first, right? So it is filtered through every trade that you take. It is filtered through fear, excitement, stress, impatience, confidence, and doubt, and even more things, right? These are physical signals that are all going through your body that then translate to you pressing the button on the charts, either pressing buy or pressing sell, right? Your body is reacting first before your logic finishes speaking, right? And now, why does this actually matter in trading? Because if we have 2 traders lined up, one over here, one over here, they take the same entry, they have the same stop loss, they have the same target, but let's say you had a wall in between them, right? Split straight down the middle. One's on the left side, one's on the right side. They can't see what the other person is doing. There will be one trader whose nervous system is regulated, and there will be another trader, let's say the left trader, their nervous system is regulated. the right trader, their nervous system isn't regulated, right? It's overstimulated because they do it to themselves. Now, what will you end up seeing? What is the result of this? Okay, the first trader on the left is holding their trade to take profit, okay? Or even if it's a loss, they're holding their trade to stop loss, right? And then for the person on the right, they're either cutting their winners early, or if they see their trade is going to stop loss, they end up removing it, right? Or the same setup could appear, one person executes and the other person doesn't, right? This is because the person on the right is overstimulated due to their own actions, right? Many people are in a loop that they don't even realize that they're in, right? Where, for example, price is just moving very, very fast, and your nervous system fires up, and then you think that there's either a threat since it's going closer and closer to your stop loss, or there's opportunity presented because it's moving very fast, and you think, if you enter at a random time, price is just going to continue to rip, right? But tell me, how many of you guys, and how many times has this happened where you try to enter, right, thinking price is just going to continue up, it's just going to skyrocket up, or even down if you're trying to short? How many times have you guys gotten stopped out or just blown accounts because of those reasons? Probably a lot, right? Same thing has happened to me as well. The thing is with us is that we will always try to justify reasons as to why a trade is valid, or we'll try to justify some sort of reason as for if we take a loss, why it was a valid loss, or the specific reasons as to why we lose. But we stray away less and less and less from the actual probabilistic reasons as to why a trade won or lost, right? Which is what we need to be focusing on, because at the end of the day, we can lose a trade and our analysis could be right, everything could be right, we could be facing an A+ setup and it could still lose. But the problem is we cannot handle it, right? Because again, we do it to ourselves. So it is very, very important to regulate our nervous system first, to be able to trade, in a calm environment, to be able to be in a place or environment in general where we are calm, collected, and we aren't able to think irrationally, right? Another thing is market data is neutral, but emotions are not, right? Quite literally what I have talked about in the last 4 minutes, right? Emotions will always be sporadic. Some days we might be feeling good, some days we might be feeling bad, but at the end of the day, if you're not able to regulate your emotions, you cannot be successful in a field like this, where it is probably the hardest way to make easy money, right? Because again, if you can master your emotions, you're able to master your craft. Most of the times, it's not a strategy problem. It is just a you problem. Now, I want to go down and break down the brain, right? What our brain thinks when it comes to trading. Now, specifically focusing on the two systems in our brain. The first side is the emotional brain, okay? When we are tapped into our emotions, or when we are feeling emotions, obviously we tend to act, sporadically. We tend to act irrationally. When we are emotional, we don't think straight, right? We are thinking fast. We are thinking very reactive based off of, what the markets are doing, the volatility that's presented. We don't think logically, right? We always want to seek comfort. And every time that we take a loss or do something stupid, we want to seek comfort in the sense of us taking a trade that will allow us to go back to break even or allow us to be green on the day. We always want to avoid pain, right? And all of these things is just a form of us chasing dopamine, right? Which is exactly what we need to avoid. Every time that we're under stress, our emotional brain is triggered, right? Now, if we compare this to the logical side, whenever we're thinking logically, we're always thinking slow, right? We're always thinking on a more analytical basis. We're taking our time, we're thinking in terms of probabilities, we're calm, and we're more process-based. Imagine if you could do this day after day after day after day. Imagine in a year, if you were able to follow your rules, if you're able to follow your system, not do anything stupid, not crash out. Imagine where you would be from the start of the year to the end of the year. Imagine how much progress you would make. The very The most important thing that you guys need to realize when it comes to the brain in trading or utilizing the logical side of your brain in trading is every time you're about to do something stupid, every single time you're about to crash out, every single time that you think that a trade looks good when in reality it isn't because it doesn't follow your system, it doesn't follow your model. What if you just took an extra 5 seconds? What if you just took an extra 10 seconds to switch from you using your emotional side of your brain to you using the logical side of your brain, right? Is this really the right position that I want to enter, right? Is this the decision that I want to make that could potentially drastically change the fate of the accounts that I'm trading on right now? The answer is it is never worth it. It is never worth that extra little bit of profit on that day. It is never worth potentially changing a red day to a break even to a green day when the downside is much worse because you understand that the probabilities of you executing that trade in that moment is quite literally, or you winning while you're executing that trade in the moment is quite literally almost zero. Because again, you don't have data backed behind it, which is why I preach journaling very, very heavily, right? Because then you're able to absolutely dissect exactly where you're going wrong. And that's exactly how I created this presentation as well, with all of these things presented, because I was able to journal consistently and look back at exactly where I went wrong, not only technically, right, technical analysis wise, but also psychologically as well. Because I took the time out of my day to journal my trades and reflect on it on a daily basis, which is exactly what you guys should do as well. Now, if we go and talk about the fear, okay, there are 3 types of fears that we face in our trading, all right? Like I said earlier, we fear losing, right? Obviously, just basic human psychology, we don't like to lose, okay? We don't like to be wrong, and just overall, we want to keep winning. But just like anything in life, right, have you ever faced something where you're just always, doing the right thing and you've never faced setbacks in your life? No. You have quite literally. I can promise you there aren't a lot of things in your life where, you've done something new and you haven't faced setbacks. It's the same thing with trading as well. There is absolutely no reason as to why you should think that your trading is going to be smooth 100% of the time. Now, when it comes to finances, when it comes to things that deal with money, there are more stakes on the line, right? Because money, finances, all of these things are able to set you up for a better life, right? There is a lot of control when it comes to money, just in general, not even talking about trading, right? Trading is just one of those paths to where you can, make, again, like I said earlier, you can make easy money, but it is the hardest way to make easy money. Now, my question to you guys is, why are you guys making it exponentially harder by, again, doing the things that I was talking about, right? You are trying to avoid pain. You're trying to, do things that you're not supposed to do. You are tapped into the emotional side of your brain, which makes it, again, exponentially harder to see success in this field when trading already is hard enough, right? So my question to you guys is, again, once again, why are you putting yourself in a position where you are causing yourself to be vulnerable, right? You are causing yourself to be vulnerable and you are susceptible to blowing your accounts just because you cannot control yourself. You cannot control your emotions. Now, if we go down and break down the overall resulting behavior of these 3 things, which again, I know a lot of you guys have dealt with this before and are dealing with this right now. You guys ask yourself, you just don't want to face another red trade. What happens if this loses? And you just want to be green at the end of the day. What happens because of this? You either get late entries, you skip trades entirely, and then you see valid setups. But again, with all of these past experiences, you don't take it, you hesitate on these valid setups because once again, you are not confident in yourself, right? You focus too much on individual trades, which as a result cause you to do these things. Number 2, fear of being wrong, right? Fear of making mistakes. Now, I can't even tell you how actually stupid this is. looking back at it, right, and not even just talking about trading, but anything else in life. How are you going to learn if you're not making mistakes? It's the same exact thing in your trading. How are you going to learn if you don't execute, if you don't make mistakes? Now, there is a difference between making mistakes repeatedly over and over and over and over again and not learning from it, or you make mistakes, you journal it, you look back at it, and you realize, okay, this is exactly where I'm going wrong. Let me do less of this. Okay, you journal your trades, you journal your wins. Okay, this is exactly what I'm doing right. Let me do more of this. Again, if you just thought about it on a more logical side, right? If even not looking at the live markets, right? Even when you're journaling, if you look at it and if you think from a more logical perspective, if you're journaling and reflecting on your trades in a slow manner, in an analytical manner, in a probabilistic manner, if you're calm and you're process-based, you will be able to retain information that you're gathering on a day-to-day basis, and you're also going to be able to not make the same mistakes that you have been repetitively making, right? Now, the resulting behavior of you not allowing yourself to make mistakes is overconfirmation, analysis paralysis, and you just miss moves in general. A lot of people don't talk about how bad it is to wait for more and more confirmation. I think that is one specific thing that a lot of people don't talk about. Because again, on days where, the market can be absolutely pristine, prices trending in one direction, you have a nice retrace, confirmation, everything, and you don't take that initial confirmation. And then you wait more and more and more and more until price, again, skyrockets and we're closer and closer to your drawn liquidity. And then you execute right before we're about to take our drawn liquidity. You are actually, you may be tricking your brain into thinking that that trade is valid, but majority of the time you end up losing. Now, why is that? Because what you don't realize is that you waiting and waiting and waiting, and you missing the first presented most probable setup that you thought was good that ended up playing out, you missing that trade causes you to tap into your emotional brain, right? You are now just thinking more reactive based off of what price is doing. You're thinking fast, and you don't really care about anything else, right? So now, again, like I was talking about earlier, imagine if you thought about trading and just in the markets on a day-to-day basis. If you were slow, if you thought about it, if you were very slow when you were thinking about your analysis, right? If you were calm and if you focused more on the process rather than just squeezing a little bit of profit in a day, imagine how far you could come in a year, right? Imagine how far you could go in a year. Now, talking about the third thing, right? Fear of giving back profits, okay? Fear of, potentially being up on the day and losing it, all right? There is a very, very simple fix for this. I don't even really need to talk about this, okay? Once you're up on a day, lock yourself out of the account. There are multiple resources out there. There are prop firms out there that offer daily loss limits, trailing daily loss limits as well if you're up on a day, to where you're able to just be liquidated and locked out of your account and you can't trade for the rest of the trading day if you enable those settings, right? As humans, we are not perfect, but we have resources that are available in this day and age, and we should be thankful that we have these resources, and we should not be neglecting implementing them into our trading, such as daily loss limits, such as trade limits. All of these things are there to help us regulate our emotions and keep us in check. And overall, keep our accounts active and alive for the next day, right? Which is the main goal. Fight to trade for another day. Now, the resulting behavior, just based off of you taking multiple trades in a day, very simple, right? You cut winners early, and then you just don't really maximize your RR, your risk to reward, right? Now, this isn't really that big of a deal, but because again, there are just resources that are there in order to make sure you don't do this, all right? Now, let's go ahead and talk about greed, okay? There are three types of greed that we all face: outcome, time, and validation, okay?
Talking about outcomes specifically, the behavior that we face from this is oversizing and ignoring stops. Now, how do we fix this? Okay, what is the proper way to fix outcome greed? Okay, very, very simple. Again, there are resources out there that allow you to restrict yourself to only placing a certain amount of contracts. Now, it all ties back, even if you don't have these resources available. Let's say there were not these resources available or these tools available to stop you from oversizing or ignoring your stops. What can you do to make sure that you do not do these things on a repeated basis, right? Learning from your mistakes, okay? This ties back directly to number 2, fear of being wrong, okay? And also fear of losing, all right? But you may be asking, how does oversizing and how does ignoring your stop loss have to do with the fear of being wrong and the fear of loss? Well, again, if you are afraid to make mistakes, right? Fear of being wrong. If you are afraid to make mistakes, you will never learn from them. If you don't execute, again, if you do not go through situations where exactly what I was talking about, right? Where you oversize, where you ignore your stops, when you blow your accounts, when you do something stupid, if you do not go through these situations, you will not be able to become a successful trader. It is that simple. It is as simple as that, right? Like I said, there is a difference between making mistakes, and there is a difference between making mistakes and not learning from these mistakes. The mistake that you are making in this case is not taking the time to learn from your mistakes and never repeating that same mistake again. That's what you should be focusing on. So the best way to deal with outcome greed is actually by doing these things, all right? It may sound counterintuitive, but if you do these things on a repeated basis and you're telling me you won't be able to learn from these things, then that means you should not be trading in the first place, right? For me personally, I got to the point where I was oversizing, right? I was over leveraging. I was full porting my, evals. I was letting my stops. I had a stop loss set. I ignored it completely, removed it, and I ended up blowing my accounts. But the difference is I learned from the mistake. Okay, I allowed myself to do these things so I could go ahead and reflect on it and say, okay, I am fed up with myself. I am not going to be doing these things anymore because I've seen firsthand experience that this quite literally has almost a 0% win rate, right? A 0.0% chance of me being successful in the long term. It is as simple as that, right? Going back to emotional versus logical brain thinking, right? You want to be thinking more logically in these cases, okay? You start from thinking emotionally, then you transition into thinking logically. Same thing applies, when you're talking about fear, greed, and now we're going to be talking about ego in a little bit, right? Time greed. A lot of you guys that I see really, really want to prove things to not only yourself, but to other people as well, right? A lot of you guys want to prove things to your parents, maybe to your relatives, your family members, whatever it may be. You want to prove that you were right all along. Why does that matter? Tell me what really changes. What really changes? They end up supporting you, and that's it. Nothing else really changes, right? Prove it to yourself. Prove it to yourself first that you can do this, all right? And if you try to rush things and if you try to rush the process, you're not going to build the skill as efficiently as you can. Matter of fact, you won't even build the skill at all because you're just going to be focused more on the outcome, right? Tying back to this. Over here, we're just talking about the outcome of a specific trade, but you're going to be tied to the outcome overall. You care more about what trading can get you, but you don't care more about the journey, what the journey actually provides for you, right? What does following your rules, following your system, and actually learning the skill change your life outside of trading in general, right? Because I promise you, the journey that you will be experiencing, the journey that you guys are going through, it is far more impactful on your life and your character in general than the fruits of your labor at the end of it. I promise you that, because you achieve all of these things that you've always wanted to achieve when you got into trading in the first place, and then realize, damn, it's kind of boring. I don't want to, this is not really giving me enjoyment.
The journey is actually what allowed me to feel enjoyment, right? When I ended up, getting the thing that I wanted the most, right? So again, there is no rush. There is no rush when it comes to the things that you want to achieve in, your life and trading. There is no rush in general when it comes to even scaling with prop firms, buying multiple accounts. You don't need to make this work now. You don't need results this month or next month. All you need is results in progress, right? And when I say progress, I mean following your rules, following your system, doing the things that you should be doing in order to make yourself a profitable trader. Again, tying it back once again to a logical brain, process-based thinking. Now, talking about validation greed, all right? Same thing, kind of almost, there is a little bit of a relevance in terms of time greed. There is a little bit of a relevance, right? Again, you don't need to prove that this works, okay? Again, you do not need to prove that it works. Prove it to yourself first, and then everything else will follow, all right? You don't need green days every day. Obviously, you've heard this saying 1,000 times, right? Losing trades are a part of a winning system. Losing trades will always be part of a winning system. So if you were able to be green every single day, then you would be rich, right? Everybody would be rich, right? If everybody could have a green day every single day. You need to face setbacks in order to see success. That goes with anything, not even just trading, anything in life. You need to face some sort of setbacks, all right? Now, the behavior for all of these things is you end up revenge trading, you end up trading emotionally after losses, same thing as revenge trading or over leveraging, all of these things. But again, if you just decided to think more logically, none of this would be occurring right now, right? Now, if we talk about ego, okay, this is probably the biggest thing, okay? Because you can get to a point where you're profitable in your trading, you're getting payouts, you're doing all of these things, but at the end of the day, you can go from profitable to being unprofitable just due to the sole reason of you not caring, okay? You become comfortable. That is where your ego comes into play, okay? This is the silent killer, all right? Now, I've listed some things, some common things that we all think about, talking about, okay, yeah, that the setup works, right? You know that your strategy is profitable. If you know that your strategy is profitable, if you know that you had the skill of trading, why do you care if you get stopped out? Why do you care if you're wrong? Again, if you backtested your setup, if you backtested your strategy over multiple years worth of data, and you understand the probabilities, and if you understand that you're going to take losses, why is that not translating in the live markets? That is what I want each and every one of you guys to ask yourself. You are not obeying the data that you've collected during backtesting when you are, again, thinking in with the emotional side of your brain, right? You are not thinking process-based, which is the main reason, honestly, probably the main reason why you are losing in your trading, right? Why you're not seeing success, because you're not thinking process-based. You're not thinking calm. You're not thinking analytically, right? It doesn't matter. Your emotions don't matter. Okay, the market does not care about your emotions. So why should you let your emotions control your trading? Okay, you need to toughen up. You need to realize that not only in trading, like I've said this probably a couple of times earlier, there will be setbacks. There will be hard times in every field that you face. Trading is no different. Trading is no different, right? Now, the behavior of you building an ego, it's quite simple. You hold losers, remove stops, break your rules, and you don't journal honestly, okay? That, I can say from my personal experience, that was probably the biggest struggle that I faced with my trading. I did not journal my trades honestly for almost an entire year. 2024, start to almost the finish of 2024. I'd only journaled the trades that I thought were good to journal, that I thought that followed my system, my model, right? My strategy that I was trading. But every time I took a bad trade, I took a trade that didn't follow my system, didn't follow my rules. The days that I blew a bunch of accounts, I didn't journal it because why? I decided to avoid the pain. right? I decided to avoid the pain and I wanted to seek safety. Thinking more emotionally, which is exactly what we need to avoid. We want to face adversity. You are never going to get ahead in your life in general if you aren't willing to face adversity. And when you are in a profession, a $1 trillion profession like trading, when everything can go wrong, right? You can lose all of your money. You always need to be on your A game. Otherwise, you will never make it work. And that is something that I will always stand by. And that is something that you will always need to stand by as well. I promise you, you will never make it work if you don't realize that one thing. Now, let's go ahead and talk about the emotional trade sequence, okay? So we start off by taking a good setup. All right, everything is good. One thing that I like to say is that the problem isn't you winning more, right? The problem, you're not actually going to learn a lot from your winners because you can learn, you can take as many A+ setups as you can, all right? It is so easy to recognize A+ setups, the textbook setups. That is not the problem. The problem is everything else below, right? You take emotional entries, you see, where you over leverage, you size up, you do something stupid because you miss the good setup. What does this cause you to do? When you see some sort of small pullback, some sort of, candle that isn't forming in the right direction, right? You end up tweaking out. You do something stupid. This spikes your anxiety, you start micromanaging, and then you exit early, or you just completely get liquidated, right? Price goes without you, hit TP, and your whole day is ruined. Now, all of this right here can be solved if you just waited for the good setup, or if you ended up missing the good setup of the day and you didn't want to do any of these things. All you had to do was realize that you will get another good setup later on in your trading career. The market does not disappear the next day. It doesn't disappear. You will get the same setup eventually and you'll execute it. That is one of the most important things that has kept me in this game long term and allowed me to see success, because I realized if I have the skill, why am I allowing myself to self-sabotage? It doesn't logically make sense, right? Now, this is also another big thing, talking about identity and self-worth when it comes to trading. I've dealt with this for a very, very long time, And one thing that I can say right off the bat is if you allow trading to be a very big part of your day on a day-to-day basis, you will deal with these things. And I have dealt with these things as well. Now, the best way to combat it is just honestly by having hobbies, right? One thing that I did was every time, I'd take a trade, and I saw myself go down this pattern early on where I wouldn't be able to stop myself from doing stupid things in the market, right? Over leveraging, oversizing, or same thing, over leveraging, revenge trading, all of these things. I wasn't able to stop myself from doing these things. So again, what I did was face adversity. I realized, okay, is this going to make me profitable? Because again, I wasn't afraid to make mistakes because I did these things quite frequently. And then it just took one day for me to sit down and realize, holy crap, I have spent so much money on evaluations, I cannot go down this path. So I decided to be brutally honest with myself and strict with myself, okay? I need to set some sort of rules. I need to set some sort of boundaries. So what I did was, back when I was in college, back in 2024, what I did was at 11 a.m. every single day, I would make sure to go to the gym. No matter what, if I was in a position or if I wasn't in a position, I wouldn't even look at the charts. Even if I was in a position at 11 a.m., I wouldn't manage my position, okay? So break even, TP, stop loss, it didn't matter. It was either TP or stop loss. I didn't even go break even, all right? I had to be so strict with myself to make sure that I built the good habits that were necessary to keep me in this game long term. And if you are never brutally honest with yourself, nothing will change, which is why the saying is there. Nothing changes if nothing changes, right? You need to change crucial things in your life that are holding you back from being successful in your trading, right? Do not tie your trading with your self-worth. Do not make it the most important part of your day, right? Just because you have a green day, do not develop an ego and say, yeah, you know what, I can do this for the rest of my trading career. No, you will take a red day and you won't be prepared for it, and then you'll end up crashing out. You'll end up blowing your accounts. Is that really the life that you want to lead? Is that really the trading, journey that you want to go down? Is that the trading journey that you want to experience? You don't. So the simple question is, why do you do it to yourself? Why do you make trading more complicated than it needs to be, right? You know that you are cooked when losses feel completely personal. You think that, the market has come out to get you and it's just taking what you thought was yours. That money was never yours to begin with. Okay, you have to realize that. Okay, that was the money, that was the market's money. All right, you are just there. You are there to capture it when it is necessary, right? When it is presented to you. That is all you should be thinking about. Okay, and whenever you take a loss, whenever you take a loss, you blow an account, just think of it as tuition. Okay, you're paying tuition to the markets. That's just the best way to think about it, because at the end of the day, again, if you have the skill, you will never lose the skill. The only thing you will lose is your mental, right? You can go completely insane and go 2 years, 3 years without seeing progress, and it's all because you didn't realize that you are a skilled trader and you know what you're doing, which causes you to do stupid things, to crash out, blow accounts, do all of these things. When again, you've built the skill, you know what you need to do, you are just not executing it, and you just do not know how to face adversity when it is presented. And then when it comes to the point where trading becomes emotionally exhausting, that's when most people end up quitting, right? So once you get to this point right here, overall, you're basically done for. So which is why I recommend overall to just have hobbies, right? Pick up hobbies which allow you to kind of forget about trading in general, what you did in the trading day, and completely be able to detach from the charts. Now, talking about the illusion of control, okay? One thing that I like to say is being able to focus on the controllables, okay? And that is really the only thing that you can do, not only in trading, but in life in general. What is the point of focusing on the uncontrollable aspects in trading and in life in general? It will do you no good, okay? So let's break down what are the uncontrollable and controllable aspects in trading specifically, all right? Individual trade outcome. You cannot control whether it is a win or a loss, all right? But what you can control is your discipline when it comes to execution, okay? You can control when you decide to execute, but you cannot control the outcome of that specific trade, okay? You cannot control news events, all right? Obviously, they're just going to be out there. They're going to release, but what you can control is you not executing when news events drop, right? You also cannot control random volatility. But again, what can you control? Your discipline when it comes to executing your trades, right? You can control the risk. You can control the amount of trades that you're taking, and you can ultimately control when you decide to press the button versus not, all right? Now, final things that I want to talk about, all right? Process will always be greater than the outcome, all right? You want to reprogram your brain into thinking along these lines, rewire your brain. One trade will never mean anything, all right? If one trade meant something, then we would all be rich, okay? Let's say we took one trade, it was a win. If we relied on that specific trade's data, we would all be rich. Everybody would be rich, okay? Even for the people that take losses, okay? If they relied on that specific trade's data, from them taking one singular loss, then they would be dead, right? They wouldn't even exist on this earth, right? Just due to the fact that literally one trade means nothing. You need multiple trades. You need tons and tons and tons of trades to look back on and realize, okay, I know my probabilities, I know my tendencies, I know what exactly I need to do and what exactly I don't need to do. It all comes down to that, right? The amount of trades matters. You need to collect a vast amount of trades to actually understand what your tendencies are in the markets. And at the end of the day, if you just think about losses as being data, right? They're just data points. Emotions won't even play a factor, right? And that's one big thing that I changed with my trading in terms of psychologically speaking. I viewed every single loss as a data point because, again, I was so focused and I was so locked in on journaling because I always wanted to improve, right? I just always wanted to mitigate the amount of losses, mitigate the amount of stupid things that I was doing in my trading. And it played out, right? Look where I am right now, all right? It's because I decided to absolutely lock in with journaling and understand that everything is based off of statistics and trading. Now, we want to talk about consistency, right? A lot of people try to rush things. They think that they can still be consistent when, they scale and buy a bunch of accounts and they do all of these things. But at the end of the day, you are not being consistent. You are putting yourself under the illusion that you're seeing consistency just because you go on a win streak. Just because you're going on a win streak, you're passing accounts, you're scaling up fast, doesn't mean you are seeing consistency. That can all crash in a matter of the next day, right? And then you'll realize, damn, this was just a fluke. And then you start getting into your head and then you start looking at all of these other things that I was talking about, right? You start being fearful, you start being greedy, then you build an ego, which is the killer, the silent killer of a lot of traders. At the end of the day, good things come slow, right? Which is the saying that has been there for a while, right? Good things come slow. They do not come fast, they come slow, all right? You need to realize that before it is too late and you end up going down a path, a very dark path that you should not have went down in the first place. Now, you want to reframe your brain and reframe your thinking in general, which is what I was talking about earlier. Every loss, treat it as tuition. It's the same thing as, going to college, paying tuition, going to medical school, you're paying tuition, you're gathering information. Every loss is an opportunity for you to gather information. And what is the tuition you're paying? The money that you're losing, that you're giving to the market, okay? You're gathering information every time you take a loss. That's the way I view it, and that is what exactly has allowed me to lock in with my journaling, right? Every time I take a loss, every time I take something stupid, the first thing that I do is go to my journal and see, okay, what did I do wrong? How can I improve? If there was anything to improve on. That's all I care about, process-based thinking. Now, another thing is taking a trade every single day, right? You don't need to execute every single day. There are opportunities that could potentially be presented every single day, but just because you miss a few opportunities doesn't mean that you are a failure. Doesn't mean that you need to do something different, okay? Discipline will always be key. It will always be key. If you can go an entire day, if you can go an entire hour and 30 minutes without executing, without pressing a button, that is a win in itself, right? You don't need to be green to say that you have won. That is a winning day. Break-even days are a win. Anything besides you breaking your rules, you breaking a system, right? Anything beside that will always be a win. Always. I actually challenge you guys to do this, okay? I challenge you guys to go an entire day, even if there is the most beautiful setup that is presented that you've never seen before in your life, and you're like, damn, I really want to take this. I need to take this. I know that it will play. It is a very high probability setup. I challenge you guys to not take that setup and just sit on your hands for an entire session. For an entire session. What if you did that? A lot of you guys may also be good traders, but the only thing that is just stopping you, that is preventing you from getting to the next level, is the fact that you guys cannot go a single day without taking a trade. You guys cannot go a single session without taking a trade. You guys look at multiple sessions and you guys think that you guys can find opportunity in every single session. Maybe you didn't see opportunity in New York AM session, and then you go into Asia session. And then what does that lead to? all of the things that I... All right, you finally made it to the end of the video. I just wanted to come on here and congratulate you guys for finishing the full course. I hope I was able to give you genuine value, but I do want to be honest with you guys. Everything that I was talking about in this free course, it's all publicly available on the internet, and that should be no secret. Essentially what I've done is basically I took everything that I've learned from my trading over the past 2 years and tried to simplify it as much as possible and package it in a way where you don't need to go and filter through all the noise. But there's a problem with this. More information isn't what is going to make you profitable. And a lot of you guys already know this. Some of you guys have been trading for 6 months, a year, even longer than that, and you already know all the concepts, you understand risk management, and you know how to trade in general. And the problem is, more information, again, is not what is going to get you profitable. The knowledge isn't what is missing. It is just the lack of execution. I've had students that came to me after blowing 3, 4, 5, even a countless number of accounts. And the problem isn't that they don't have enough knowledge. They know how to trade. They understand all the concepts. They can explain every single setup on a chart. But the real problem is when it comes to trading with prop firms, when it comes to trading a funded account, they lose all track of focus. They are not able to properly execute their plan. They revenge trade, they overtrade, they over leverage, and they think that switching their strategy is the solution to their problems. But in reality, the problem was never the strategy. The problem was them. And this cycle is exactly why I started the syndicate. So let me go ahead and walk you through it. So in the syndicate, you get access to a plethora of channels, as you guys can see in front of you right here. Let's go ahead and start off with the main thing, which is the market recaps that we have on a daily basis. Monday through Friday, we have these market recaps where I personally go over the market, any trades that I took, and also I review all of your guys' trades that you may have taken in the executions tab, as we see right here. All of these executions tab are forwarded from their individual channels or in their individual journals, and I go ahead and give them feedback in these market recap calls. All the recordings are also posted right here if you're not able to make it to the call. As we can see right here, there are over 154 market recaps listed in this channel right here. Now, the second thing that I want to talk about is the channels. There's overall a good amount of channels. I have my coach Tariq, which I will be talking about a little bit later. Basically, he's just my coach. He helps out with the program, very, very active in the group. But we have a lot of accountability features in the group that I think that are very, very important and that have overall helped the students see success. Now, main thing besides the other channels like the check-in, the journals that we have over here as well, we have journals. Each member is required to create their own personal journal. As you see, there's hundreds and hundreds and hundreds of journals. Everybody is very, very consistent with it. Now, the last thing that I want to talk about with the channels is the accountability program that I have implemented into this group, and I have seen tons of great feedback from my students. So in the syndicate accountability program, essentially I assign you a partner and you get access to a private channel. As you see right here, you check in with the bot every single day and you basically upload screenshots that are prompted by the bot. His name is Powell, and overall it has been a success. Everybody is holding each other accountable and you're trying to achieve the same goals together, which is profitability. Essentially, you go ahead in this chat right here and then you go ahead and look for a partner, and then I overall assign you guys partners. This has been a huge success once again, and you're not basically hiding from yourself. That is the reason why I created this accountability program. You can't hide from yourself. You can't hide from me. You have to hold yourself accountable and you have to hold your partner accountable as well. Now, the fourth and last thing that I want to cover is the one-on-one access to me. When you join, you get direct one-on-one access to me. You can message me whenever you want, send me your trades, I'll review them, even in the executions tab. Again, on these calls, Monday through Friday, I go ahead and review your guys' trades. If you're about to do something stupid as well, go ahead, text me, right? I'm there for your personal success and I am personally invested in your results. Now, with all this being said, I want to show you guys the wins that we have been taking in the syndicate. So literally today, we've had a good amount of payouts, 3 payouts today. Right here, Mohammed, he made around 5K. He joined 15 days ago. Sky over here, he got scammed by another mentor. He got his first payout and then he got his second payout over here. Rad, he got his second payout. Overall, the group has been killing it. Dates back all the way to the end of last year. It's It's absolutely beautiful, right? The entire group has been killing it, putting a lot of work with these guys. So it feels good to see my work basically playing an effect on my students, and they're overall able to capitalize after joining. So very, very nice to see. Super, super proud of these guys. And yeah, absolutely beautiful. Planning to get a lot more payout within the rest of this month. Honestly, the entire group has been killing it. We have a few people that are approaching 5 figures a month as well. You guys have seen through my case studies as well. New people coming in, new case studies, and new killers that are just joining very, very frequently, right? And now to wrap everything up, I want to tell you about one of my first students, Tariq, and he is now a coach in the program as well. He's one of my most successful students. Essentially, after he joined the syndicate, within 2 weeks, he got his first ever 5-figure month. I do want to be completely transparent with you guys. He was getting a few payouts before joining the syndicate, but essentially I was able to scale him and he was able to scale himself to making over $25,000 a month. And it's not because he learned some sort of magic strategy. It's just solely because he stopped strategy hopping and he stopped second guessing himself and he actually decided to execute. So he's at 25K a month now. Super, super proud of him. And he's honestly just become one of my closest friends in the syndicate, which is why I have him as a coach. He's very, very active in the group. He actively helps all of the students out because he knows exactly what it's like to be stuck. And on top of that, he also bought one of his dream cars. He actually bought a BMW for himself after getting consistent with payouts. So that's also very, very nice to see. All right, you guys, that is everything for me. I hope you're overall able to apply every single thing that I taught you guys in this video. But if you're still sitting there and you're thinking, I've tried everything on my own, but nothing seems to work out, then you know what the answer is. Apply for the syndicate. I will leave a link in the description below. I will see you inside. All right, peace.